Good morning, friends. Okay, so today we are going to cover the entire AFM in a shorter span of time. Plan is very simple. Discuss the concept. So whatever I am doing now will also come as a recorded video to you. The purpose is very simple. Whenever you are doing your revision, it is not possible for you to go through a lengthy video and track what has happened in that chapter. So I have two types of concept revision. There is one video which goes on for around 40 hours, the playlist, which covers all the concepts of AFM. But even 40 hours is difficult for a student when they are trying to go through the revision mode. Second, if you recollect all the concepts on your own, it is still very easy. You go through the concept book, you're able to recollect. Okay. The purpose today is to discuss every chapter in a span of around 30 minutes. Certain will go for 50 minutes or 1 hour also, and some will be for even less than 30 minutes also. This will come in handy whenever you are doing your revision. So whenever you do preparation next time, let's assume you are doing mutual funds chapter, you will go to this video, look at the mutual fund section, hear it maybe once, and then start doing questions on your own. Then you start doing questions, then you start reading concepts, then you do whatever you want to do. Can I use it day before exam? Students have used it in the past, but ideally I wouldn't prefer you to look at anything day before exam other than your concept book. Other than the book, nothing needs to be seen day before exam. But people have used it even the day before exam because I track the views of the video, and generally the views are higher the day before exam. So people do see it day before exam. But generally the purpose of this video which we are creating, it's more of a video. You are in the class, because when I am with the student, my delivery changes little bit. So this will come back to you, and many of you would be consuming this again in the form of a recorded video later on. It will go in YouTube. In YouTube, you will see it. So, and this video is applicable only if you know the concept. Somebody is a first time learner and looks at the video, he'll not understand anything. So when you came to the class a month back, you had maybe some knowledge of AFM or you had no knowledge of AFM, whatever it is. That time when I would have explained concept, my delivery would have been totally different. Now I'm going to discuss the same concept, same thing, but it'll be 1/10 of that time. It'll be only 1/10 of that time. I'll not explain what is mutual fund and all. There I would have spent time on what is mutual fund, what is this, what is that, and then we would have gone. So this is the basic context setting of the video. The context is very clear. This would be seen by students before exams, and with the going through this you will have comfort to face your exams or whenever you do your revision. Ideally I wouldn't want students to see this day before exam, but students do still see it because they want to recollect at that point of time. And this video obviously is going to be maximum around 6.5 hours, so something which can be seen at different points of time. We are going to start with first chapter. I'm going to start with mutual funds, and then I'll keep proceeding forward. As we keep proceeding, every chapter in between I may give some gap if needed, or we keep moving in the direction. So let's start with chapter 8, mutual funds. You just need to open your concept book, keep it with you. I don't think you'll be seeing your concept book also. You'll only be listening to me, looking at the screen, and keep participating. Participation is 100% needed. Okay. Okay, let's start with mutual funds. We learned that mutual fund is basically an instrument which collects money from investor, pools that money together, and invest them as per an investment objective. There are two expenses a mutual fund incurs. What are the two expenses called? Initial expense ratio, annual expense ratio. These two expenses will impact the returns of the mutual fund. So the first concept said, how much should I earn, so that how much should mutual fund earn so that they generate the return I want. So we had a formula called MF return is equal to, what is the formula? Own return divided by 1 minus initial expense ratio plus the annual expense ratio. This is what the mutual fund has to earn for them to give the return which I want. I am not going to even explain what is IER, what is AER, what is own return. Basic thing is to discuss quickly everything. This is if there is no opportunity cost. Sometimes there can be an opportunity cost of investing in the mutual fund. What is opportunity cost? I am investing in direct equity vis-a-vis an investment in mutual fund. When I invest in direct equity, I have to spend time. If I spend time, I cannot take one batch of AFM and I miss out on that income from the AFM batch. So cost benefit analysis basically says two things: MF, own. MF will give you 14%, own will give you 18%. But there is a bigger problem. The bigger problem is when you do own investing, there is an opportunity cost. I lose out the income from one batch of AFM, or this is a benefit from the MF investing. Either it is a benefit for the mutual fund investing or it is a disadvantage for the own investing. Whichever way we want to consider, we can consider in our computation. Clear? Any doubts on this? You have a doubt, you keep asking me, but otherwise you'll keep moving forward. Okay. Then we learned about holding period return versus annual return. Return which I earn. What is the formula? What is the formula for return? What I get back minus what I give divided by what I give into 100 for holding period return into 12 by m into 100 for annual return. What I get back is called what? NAV 1, D1, CG1 and NAV 0 is what I give, or I can write NAV 0 in the beginning also. NAV 1 minus NAV 0, D1. Keep participating with me because you know the concept. You keep telling it with me. D1 CG1 divided by what? NAV 0 into 100. If you do into 12 by n on top of it, it is called what? Annual return. I can say annual return is equal to holding period return multiplied with 12 by m. What is the use of this? With this formula, I can get m. M is the period of holding. M is the period of holding, or it can be 365 by D also. 365 by number of days. So period of holding through holding period return and annual return. The period of holding is that M in the formula or D, M or D in the formula. Don't worry about the formula which is mentioned there. It is the same thing. We are just changing that formula and writing. Generally write annual return is equal to holding period return into 12 by M. M is equal to holding period return by annual return into 12 or into 365 if you want to do in number of days. In the entire AFM, wherever you see the word called, question specifies a year consists of what? 360 or 365 days. You have to do days computation. Where did we use this? We have employed it in derivatives futures valuation. We have employed it in interest rate swaps problem. We have employed in interest rate collars problem. We have employed it in maybe some other place. Wherever question says it consists of 360 or 365 days, do the calculation in days. If they don't mention, do the calculation in number of days. But this leads to one problem. The problem is I invest on March 1, exit on March 31. If it's months, it is 1 month. But if it's days, it can be 31 days. I can say I want to exclude March 1. It is 30 days. I want to exclude March 31 but include March 1. Again 30 days. Exclude both March 1 and March 31. It is only 29 days. So this is a problem I will face when I have to calculate the number of days. Do I consider the start date and the end date? Do I ignore the start date and the end date? Do I ignore one of them? Generally, I ignore one and consider one in my calculation wherever we are doing this. Next, there are two types of plan. One is called dividend payout plan and dividend reinvestment plan. In dividend payout plan, dividend is coming in the form of cash. Coming in the form of cash. What is the formula for dividend payout plan? What I get back minus what I give divided by what I give. Payout same formula. NAV1, NAV0, D1, CG1 divided by NAV0 into 12 by M into 100. But if it's a reinvestment plan, I have to first get the closing units. For getting the closing units, closing units, multiple dividends could be paid, which are reinvested into what? Additional units. So we have a format called date. What is the next thing? Opening, keep participating, whatever you remember. Opening units. Then there was dividend percentage. Then there was a dividend percentage. Then we had dividend in rupees. Dividend in rupees. Then there was a reinvestment NAV. This gave us units allotted, and you get the closing units. You get the closing units. You will start with 1/4/2020. I had opening units of 10,000. Dividend is 20%. 10,000 into 20% into face value. 10,000 into 20% into face value. I don't want any calculation. Okay, don't worry. I'll write random numbers. I'm not bothered about any numbers here. 10,000 into 20% into the face value. It should be 20,000, but any number. I'm not bothered. Okay, there will be a reinvestment NAV on that date when the dividend is paid. There will be a reinvestment NAV which is 40. Divide, you get 500. Closing units 10,500. Keep repeating, keep repeating, keep repeating. When I do this, ultimately return for a reinvestment plan is what I get back minus what I give divided by what I give into 12 by M, or without 12 by M, into 100. What I get back is called closing units into what? Closing NAV. What I give is called what? Opening units into opening NAV divided by opening units into opening NAV. Opening units into opening NAV, and the return is computed. But here, dividend, if it is rate is multiplied with face value. If it's yield is multiplied with NAV. Yield is multiplied with the NAV. Rate is multiplied with the face value. Yield is multiplied with the NAV. And in normal security valuation, dividend payout is multiplied with earnings per share. Payout is multiplied with earnings per share. Rate is multiplied with face value of the share. Yield is multiplied with market price of the share. Then this is dividend reinvestment analysis to calculate the closing units. Four types of plans are there. Growth plan, start with 1 units, end with the same units. Start with 1 units and end with the same units. No increase in units, no decrease in units. Bonus plan, units will change. Bonus plan, units will change. For bonus plan, date, opening units, bonus ratio, units allotted, closing units. 1/4/2020, I had 5,000 units. Bonus is 2:1. 2 units for every 1 unit. It can be any ratio. 2 units for every 1 unit. So I am allotted 5,000 into what? 2 by 1, which is extra units. How much? 10,000. Closing is 15,000, and keep going on. Closing is 15,000 and keep going. Keep participating with me. Then only you will find it. You will be able to relate to what I'm discussing. Okay, 15,000 units. Dividend reinvestment we have discussed. Payout plan, no change in units, but dividend will come. Dividend will come in the form of cash. Okay, when we are doing investment, there are two types of scheme: open-ended scheme and close-ended scheme. Open-ended, entry at any time, exit at any time. For open-ended, the formula is NAV1, NAV0, D1, CG1 by NAV0. For close-ended, NAV1 will be called P1 and P0. What is P1 is, it may be slightly different from NAV1. It may be slightly close-ended, means you can't enter at any time. So it is traded in the stock market. NAV 20 rupees, but the price in the market could be extra 5%, lesser 5%, some number different. P1 minus P0 plus D1 plus CG1 divided by P0 into 100 into 100. Taxation impact: if there are any bonus units allotted for calculating short-term capital gain or long-term capital gain, the cost of acquisition of bonus units is what? 0, and STT is not a tax deductible expense. Now, the return which we calculate, We generally use a formula called NAV1, NAV0, D1, CG1 by NAV0 into what we do? 12 by M. Or I use a formula called what I get back minus what I give. So I got back 20 lakhs. I gave 1 lakh. 20 years is the investment. We just do 12 by M. This formula ignores time value of money. This formula ignores the time value of money. What is other option? IRR. Year, cash flow, PVF, DCF. Year 0 investment 1 lakh. Year 0 investment 1 lakh. After 10 years, got back 20 lakh. Do NPV with one discount rate, another discount rate, one positive NPV, one negative NPV, one positive NPV and one negative NPV and IRR is done. One positive NPV and one negative NPV and IRR is done. That is called effective yield through IRR approach. This is also called as geometric mean as per the May 26 exam. The word used was geometric mean, where basically you will have to use the IRR formula. You will have to use the IRR formula. Yep. Next, front end load and back end load. What is the other name for front end load? Entry load. Back end load is called exit load. Front end load is called entry load. Back end load is called exit load. The NAV is 10, but please pay extra 2%. Please pay extra 2% and 10.2 is called public offer price. 10.2 is called public offer price. So this is 10.2 minus 10 divided by 10 into 100 is the front end load. Is front end load extra 2%. ICSS you can divide by 10 also. You can also divide by 10.2 also. 10.2 also. Back end load is same 10, but when you exit, I will subtract some percentage. I'm subtracting 5%. And this is called redemption price. This is called redemption price. So here it is 10 minus 9.5 divided by 10 or divided by 9.5. Divided by 10 or divided by 9.5. Divided by 10 or divided by 9.5. So you can divide by NAV, or you can also divide by public offer price or the redemption price. Either ways you can do. ICI gives both the answer. Clear? Any doubts on this? Okay. NAV computation. How do I calculate NAV? NAV is basically the real value of the mutual fund unit. Real value of the mutual fund unit. In companies we call shares. Here we call number of units. Here we call number of units. To calculate the NAV, I have a formula 1. I have a formula 2. I have a formula 1 and I have a formula 2. Formula 1 is very simple. Realizable value of asset, or you can call it as real value of asset. Real value of asset minus real value of liability divided by what? Number of units. What is real value of asset? I've invested in shares of TCS. Take TCS share price and multiply. I've invested in shares of HDFC. Take the HDFC price and multiply. I've invested in bonds, debentures. I've invested in multiple places. Take their real value. Subtract any liabilities. What can be liability? Expenses payable, dividends payable, some other expenses payable. Subtract all that. Divide by what? Number of units. Divide by number of units. Or opening net assets. What is opening net assets? Is units into NAV. On the day 0, I had some units and I had some NAV. Multiply them together. That is called opening net assets. That is called opening net assets. This net assets will increase by income, will increase by appreciation, will increase if inflow of unit holders. If somebody is coming into the fund, all this will go up. It will go up. The assets will go up if I earn any income. If I earn income, cash increases. If portfolio appreciates, the value of the assets appreciate. So what are increasing the assets? Minus expenses, minus depreciation, minus outflow, minus dividend paid. All this will reduce the number of amount of net assets. All this will reduce the amount of net assets divided by opening units plus what? Addition minus deletion. Minus deletion means people going out, and this is another way of calculating the NAV per unit. Another way of calculating the NAV per unit. Another thing is there is no link between unit of the mutual fund and shares of the company. There is zero linkage between the two. Unit of mutual fund and shares of the company. Unit is different, shares are different. And whenever you are watching this video later, you keep going through with the concept book. I'm writing something because I don't want to look at an answer. Basic thing is, when you have done your AFM without looking at this, can you keep explaining? I'm not looking at this and explaining. That is what the comfort you need to have to understand the subject really well. Next concept, impact of events on NAV. Whenever a mutual fund has an inflow of a person, inflow means person is coming out, asset increases, units increases, NAV same. NAV remains same. No change in the NAV. No change in the NAV. Asset increases, units increases. Person going out. Asset decreases, units decreases, NAV same. NAV same. But if there is any dividend declared, if there is any dividend declared, dividend will reduce the assets of the mutual fund. So any dividend declared will reduce the assets, and NAV will fall by the amount of dividend. NAV will fall by the amount of dividend. And this is little critical. If you are doing a dividend reinvestment plan, NAV declared, sorry, dividend declared, NAV fell, and reinvestment will happen at the lower NAV. Reinvestment will happen at the post dividend, NAV. Why is this needed? To get the extra units. To get the extra units, it is what NAV? Post dividend NAV. It is at post dividend NAV. Total yield of investor. I am invested in multiple mutual funds. Take MFA, MFB, MFC. Write what I get back, what I give, profit or loss for all of them. What I get back, what I give. What I get back is dividend I may get back, capital appreciation may be there, closing value will be there. Do calculation for A separately, B separately, C separately, calculate their percentage and put a total. All the three put together, I get back 12 lakh. All put together, I gave 10 lakh. Profit is 2 lakh, and overall profit is 20%. Overall profit is 20%. Total yield means doing for all the three funds together. All the 3, 4, 5, 6, whatever funds together. We generally do individually for every mutual fund. Exit load versus lower return from the mutual fund. We have invested in A, B, C. A will give 24%, B will give 18%, C will give 12%. If the same is going to repeat in future, exit, increase here, exit and increase here. Because if same is going to continue, why should I invest in B and C? But the question says, if you are exiting, you may incur some exit load. In this place, we compare two things. One is the exit load percentage, and second is the proportionate loss in return by continuing with the bad fund. For example, if I continue with this, my loss is 24 minus 18. 24 minus 18 is the loss. Loss is how much? 6%. Loss is 6%. I want to continue for another 365 minus 265. 265 days already over. Another 100 days I continue, I can save the exit load. Another 100 days I continue, I can save the exit load. 365 minus 265 divided by 365 into 100. Divided by 365 into 100, and this will give us the number 24 minus 18. This is called proportionate loss on return. Return of the good fund minus return of the bad fund into the balance days by 365 into 100. If this is 1%, exit load is 2%. Let us continue with the bad fund. Let us continue with the bad fund, else shift to the good fund if exit load is lower. Yep. Okay. Cash balance computation. If I am doing a problem and I can prepare a cash book. What is cash book is? I know the inflow, I know the outflow. If I can track them, if I can track the inflows and the outflows, if I can track the inflows and the outflows separately, if I can track them separately, go ahead and track it, go ahead and track it, go ahead and track it. Track the inflow separately, track the outflow separately, track the inflow separately, track the outflow separately, get the closing cash balance. And this is one of the asset for NAV computation. Not able to track cash balance given, take it. Not able to track, not given, ignore it. Not able to track, not given, ignore it. Clear? Any doubts in this? Okay. Dividend income on equity share. I am investing in companies in a mutual fund and there is a dividend declared. There are two types of investments which can happen. One is the original share and second maybe some rights or bonus. Rights are bonuses declared. Some rights are bonuses declared. Own shares, original shares, you will get dividend, but the rights are bonus shares, you will not get the dividend, or you may get the dividend depending on timing of the dividend and timing of the rights issue. Rights issue happened earlier, dividend declared later, get dividend even on this. Dividend is declared first or together, then you will not get dividend on this extra shares, dividend on the extra. Why do I need this? Because this will be added to my cash balance. This will be added to my cash balance. So what amount do I add to the cash balance? Which dividend do I add? Original share dividend 100% will come. Right share and bonus shares may or may not come. May or may not. Impact of dividend equalization. Generally, mutual fund reports NAV daily. But if you are not reporting NAV daily, there's a concept called dividend equalization. What does the concept say is, I have an income, April month income, 300 people are there, 600 is the overall income. Per unit, the income is 2. Per unit, the income is 2. 300 units are there, 600 is the income earned in April. If somebody is coming inside in April month, he has to bring his share of income. He has to bring his share of income. So 5 people came inside, everybody brings 2 and 10 has to come inside. 10 has to come inside. Now the total income is 305 people, 2 and 610 and 610. This is April. The income is not 300 into 2. Now the income is 305 into 2. Income is 305 into 2. May month, 305 people are there and we earned 305, 1 rupee. 1 rupee. Together now, 305 people are there, 3 rupees 915. If you exit now, take 3 and go out. Take 3 and go out. So person are going out now. 10, 10 people went out. They are taking their 3 and going out. They are taking their 3 and going out. Leftover now is 295 into 3 will continue to be there. This number is 885. You earn June income which will be distributed among 295 people, which will be distributed, and post this you may distribute any dividend. Post that you may distribute. So if you are coming inside, you have to pay opening NAV. There could be some entry load and you have to give dividend equalization. You have to give dividend equalization. If you are coming in April, give April income. Coming in May, give April and May income. Coming in June, give April, May, June income. April, May and June income. If you are exiting, opening NAV minus exit load, but take your dividend equalization go. Take your dividend equalization and go. Take your dividend equalization and go. Take means it will be added to the exit price. Added to the exit price. If you are coming in opening NAV, entry load, dividend equalization. If you are going out opening NAV, exit load and dividend equalization is plus dividend equalization is plus and plus, and this is the format for income available for distribution which I've just now discussed. Add the inflow, take the outflow, final income is there, give it to people, dividend out of realized earnings. One question said that company wants to pay dividend out of the realized earnings of the mutual fund. Dividend out of the realized earnings of the mutual fund. Realized earnings of mutual fund is equal to dividend, interest, rent income. I'm just talking about income, okay? There are something called INVIT and all. If at all, whatever income you are generating, plus realized capital gain, plus what? Realized capital gain. All this is part of the income of the mutual fund. On this, you can pay 10%, 20%, 30%, 40%, 50%, 60%, and this will become the income for the investor. Dividend paid out of this is called D1. Dividend paid out of this is technically called CG1 by ICI. Dividend paid out of the realized capital gain. Dividend paid out of the realized capital gain is ICI word is what? CG1. ICI word is CG1. Clear? Next point, you want to do valuation of equity share. You want to value best way. Number of shares. Go to the stock market and multiply with the price. Go to the stock market and multiply with the price. I am not giving you the price, but what I give you is when you enter Nifty 20,000 on valuation date, Nifty 24,000 on valuation date, Nifty is 24. When you entered 20 crore invested, today the value is 24 crore. Today the value is 24 crore. 20,000 equal to 20 crore, 24,000 equal to 24 crore. The increase here is 20%. Increase here is also 20%. I suddenly want to say the increase in the share is double of the increase, double of the increase, double of the increase. Here 20% increase, here will be 40%. 20 plus 40% is 28. 20 plus 40% is 28 crore. 28 crore. Then I want to do bond valuation. Do very simple. Year, cash flow, PVF, DCF. This is the general formula. Year, cash flow, PVF and DCF. But I don't give so much information. I give you some interest rates. There was a formula called current yield. There was a formula called current yield. What is the formula for current yield? Interest divided by current market price. This is given in the question. Interest you can calculate, current market prices balancing figure. Current market prices balancing figure. Interest divided by CMP. Interest divided by CMP. Expense ratio. Expense ratio is very critical because this can have an impact on the returns of the investor. Now, expense ratio is very simple. All expenses divided by AUM. What is AUM? Is net assets. AUM is the denominator is called net assets of the mutual fund. Net assets of the mutual fund. I want to divide this by number of units. I also want to divide this by number of units. That is called expense per unit, NAV per unit. Expense per unit and NAV per unit. Expense per unit and NAV. Which NAV do I take? You can take opening NAV. You can take closing NAV. Practical world, we take average NAV. Listen, if they say expense ratio is 1%, if you spend anything above 1%, that will be disallowed and not considered as the expense for NAV calculation. Not considered as the expense for NAV. You have paid the money. Promoter or somebody has to replenish that money. That will not be allowed as an expense for calculating the NAV. That will not be allowed as a expense for, and nobody in the practical world will go above the expense ratio. They will not go above the expense ratio. Next point, how do I evaluate the performance of a mutual fund? Anyways, Sharpe, Einor and Jensen's alpha. Sharpe basically says denominator is standard deviation. Trainor says denominator is beta. For Sharpe, the numerator is actual return minus risk-free return. For Trainor, actual return minus risk-free return. Alpha says actual return minus CAPM return. CAPM return. What is CAPM return? RF plus beta into RM minus RF. How beta is calculated, how SD is calculated, all that we are aware. So now I am able to discuss this. When I discussed earlier, I said I will not do it together. But now I can discuss anything because we are aware of all the concepts. So you can divide by standard deviation. Standard deviation is for undiversified. This is for diversified. If you have gone through the theory video, you would have seen a category of mutual fund called sector mutual fund. Sector mutual fund means it will invest in only one sector, and those are undiversified mutual fund. They are technically undiversified because there's no diversification. You're putting only in one sector. You're putting the money in only one sector. So for undiversified, Sharpe is useful. For diversified, Trainor is useful, and others one is Jensen's alpha can be used for both. This is also called as reward to variability. This is called reward to volatility. Higher the better. Higher the better, and the values can be negative also in case the actual return is lower than the risk-free return. Actual return is lower than the risk-free return. Then we learned that with this data, question gives me Sharpe, gives me Trainor, and the balancing figure could be standard deviation, balancing figure could be beta, and NAV has two components. There's a cash component, there's a equity component. Cash component will go down or go up by the amount of income or expense. By the amount of income or expense, we'll have expense only, so it will go down by the amount of expense per unit. Equity component may go up or go down depending on the stock market. Stock market has what beta? 1. 1 is equal to 10% fall. Our portfolio 1.5 beta. Be ready, 15% fall. Our portfolio will have a 15% fall. Cash will go down by the amount of expense. Equity will go down by the amount of 15%. Club it together and calculate the NAV. Club it together and calculate the NAV. So this is the next part, breakup of NAV. Cash component will decline by expense, can increase if there is an income per unit, will increase or decrease based on the market change. And the last component we learned is tracking error. Tracking error is something called as a passive mutual fund. Again, in the theory video, you would have understood a word called passive mutual fund. Passive mutual fund are those which are just investing in an index. An index example is Nifty 50. So I have Nifty 50, which gives 10, 12, 15. My mutual fund gives 11, 11, 16. The difference, you will have to find out the difference, which formula, either ways. You can do 10 minus 11 or 12 minus, whichever way you want to do. So the difference is minus 1, 1, minus 1. The difference is minus 1, 1 and minus 1. On this differential return, you have to calculate the standard deviation. For calculating standard deviation, what is the format we use? Return, probability, product, deviation, PD square. Ignore the probability part, okay? Without the probability part. The return column is this. The return column is minus 1, 1, minus 1. Take an average for this. Get the deviation. And then do deviation square. Put a total of the deviation square, and we generally divide by n. Here the deviation square will be divided by n minus 1. The deviation square will be divided by n minus 1. It is not on Nifty. It is not on mutual fund return. I can calculate standard deviation for this also. I can calculate standard deviation for this also. I am not calculating on that. I am calculating standard deviation on the difference between the two. On the difference between the two. Once you get the difference, once you get the difference, on the difference, take the average, get the deviation, do the deviation square and divide by n minus 1. Divide by n minus 1. With this, mutual fund over in 30 minutes. Mutual fund over. I have explained all the concepts which I want to explain. Earlier and all, I used to think whether you know this, you don't know this. Now, I kept explaining everything and the linkages were also discussed. Any doubts on this? Clear? Done? Okay, now we shift to Forex chapter. As we did in mutual fund, I'll keep focusing on the concept. The first concept is price currency and product currency. When I go to the market, they will say INR 80 per dollar. INR is called, keep participating, price currency. USD is called product currency. USD 0.01 per INR. USD is called price currency. INR is called product currency. Price currency is the first currency. Product currency is the second currency. Question says $1 equal to 80. No, I don't like this way. I will write again. This is what INR 80 per dollar. INR 80 per dollar. They say price of dollar in India is 80. Again, I don't like this. I will write this as INR 80 per dollar. 80 per dollar. They may write the way they want. I will write the quote only as first one currency, second the rate, third another currency. Third another currency. Question may say INR slash USD 90. I don't like this. I will write INR 90 per dollar. INR 90 per dollar. Okay. The second part is there is a direct quote. There is a indirect quote. Direct quote expresses home currency per unit of foreign currency. Home currency means Indian currency. Let us look at only from India point of view. So direct quote is INR 80 per USD. INR 80 per USD. Indirect quote is USD 1 by 80 per INR. Inverse 1 by 80 per INR. I don't want any numbers. Okay. 1 by 80 per INR. Direct quote is INR 2.5 per Nepalese currency. Per Nepalese currency. Nepalese currency 1 divided by 2.5 per INR. 2.5 per INR. INR 90 per GBP. This is GBP 1 by 90 per INR. This is direct and indirect. In the quotation, if I go to SBI, he will say the quote is INR 85.25 hyphen 86.75 per dollar. He will give the quote like this. This rate is called what? Bid rate. This is the rate at which bank buys the product currency. Bank buys the product currency. What is this rate? Ask rate. This is the rate at which bank sells the product currency. Average of this is called middle rate. Average of this is called middle rate, which is 86. I don't want the numbers. Okay, I'm just writing some random numbers. Could be right, could be wrong also. Average of the two. The gap between the two is called spread rate. The gap between the two is called spread, which is 86 minus 85.25, 1.5. You want percentage, you can divide by the bid rate or you can divide by the ask rate. ICI material talks about this, but technically I can do both. MCQ they ask, you divide by the bid rate. Clear? This is two-way quote. I went to the bank asking for the two-way quote. They said 85.25, 85.75, 85.25, 85.75. The number after the decimal is called pips. PIPS. If the number before the decimal is same, ICI says let us not repeat again for simple communication. Let's just write 75. Let us just write 75. 75 means the last two decimals of the code. 75 means the last two decimals of the code. So you have to interpret this as 85.25, 85.75, 85.25 and 85.75. ICICS, I will go a step ahead. This is 85.315. This is 85.375. 85 same, 3 also same, 3 also same. So when I'm giving the quote, I'll say 85.315 hyphen 75. 75 means the last two decimals of the quote. 75 means the last two decimals of the quote. They give 750. 750 means last three decimal of the quote. 750 means last three decimal of the quote. So it will become 85.750. I add a zero here. I add a zero here. Now this will mean 85.3150, 85.3750, 3750, 3750, 3150 and 3750. That is the pips interpretation part. Price currency, product currency done. Direct quote, indirect quote done. Two-way quotes is done. Pips interpretation is done. Now, I want to convert a direct into indirect, indirect into direct. If it's INR 80 per dollar, this is USD 1 by 80 per INR. But if there is a bid and ask rate, INR 80 hyphen 82, when you do the conversion, for bid rate you have to use what? Ask rate, and for ask rate you have to use the bid rate. For ask rate you have to use the bid rate for doing the conversion. 1 by 82, 1 by 80, 1 by 82 and 1 by 80. This will only ensure that when we are doing conversion, the bid rate is lower than the ask rate. Bid rate is lower than the ask rate. Interpretation of quotes in the practical world. If you go and ask the bank what is the INR USD rate, he will say USD slash INR 80. This does not mean USD per INR. This does not mean USD per INR. Practical world, this is how rates are given. You go to the bank and ask what is the INR USD rate. He'll say USD slash INR. In that, INR is the first currency. USD is the second currency. ICI sometimes uses the practical convention. Many a times does not use the practical convention. What we say is, if they say $1 equal to 80, this is 80 per dollar. If they say INR slash USD 80, INR 80 per dollar. If they say USD slash INR 80, again it is INR per USD. If they say USD quote in India, again it is INR per USD. If it's INR quote in USA, again it is INR per USD. Is it always INR first? No, it depends on the rate. Rate is what? 80. If the rate is 80, $1 can only be 80 rupees. You can't say 1 INR is equal to $80. So for interpretation, I look at the rate given in the question. If the rate is greater than 1, rate is less than 1. Greater than 1 means 80, less than 1 means 0.0125. If it is 80 given in the question, the interpretation is cheaper currency, which is INR, per costlier currency. Cheaper per costlier currency. And this is costlier, which is dollar, per cheaper currency. Costlier per cheaper. Now, which is cheaper, which is costlier? You can go through this. JPY is the cheapest. INR is the second cheapest, and thereafter certain trends are there. The most important part is this: USD, Euro, GBP, USD, Euro and GBP. When I am trying to interpret the quote, I will try to interpret only one quote. I will not try to interpret all the quotes in the question. One you have interpreted. For example, they give INR USD, Euro GBP, Euro Swiss franc. If this meaning is USD per INR, then this meaning is GBP per euro. This meaning is CHF per euro. I don't want to apply my brain again. I don't want to apply my brain again. If the first meaning is USD per INR, the second meaning is GBP per euro. The third meaning is CHF per euro. No extra application I want to do at this point of time. Clear? Understood till this? Okay. Cross rate. What is cross rates? Is I want INR per USD. If you want INR per USD, start with INR. In the question, INR per USD is not there, but with INR I have GBP. With INR I have GBP, but I don't need GBP. I don't need GBP, so cancel this by writing in the. But with the GBP I have Euro. With the GBP I have Euro. Cancel the Euro also, and with the Euro I have USD. GBP cancel, Euro cancel. GBP cancel, Euro cancel. You want bid rate? Multiply the three bid rates. You want ask rate? Multiply the three ask rate. I don't have INR per GBP. I have GBP per INR. Bid rate is equal to 1 by ask rate. Ask rate is equal to 1 by bid rate. Depending on what requirement you have, you take the rate and then keep proceeding forward. This is cross rate concept. Okay. The question says, I want likely rate of dollar against INR. Dollar against INR. Rate of dollar means dollar is the product currency. Rate of dollar means dollar is the product currency. You go to the supermarket and say, give me the rate of apple. You don't even say rate of apple against INR. You only say rate of apple, and he will say INR 25 per apple. He will say INR 25 per apple. So if you want rate of dollar, INR 90 per dollar. INR 90 per dollar. This is concept 9. If they ask likely rate of INR, if they want likely rate of INR, INR is the product currency. If they want likely rate of INR, INR is the product currency. If they want likely rate of Japanese yen, Japanese yen is the product currency. Then, in order to solve any question, I need one known component, I need one unknown component. I want to buy 10 lakh dollar. I want to buy 10 lakh dollar, which means I will be selling question mark INR. I'll be selling question mark INR. INR will come in the left hand side, equal to what? USD into INR by USD. We will say what is the denominator currency? Denominator currency is US dollar. What are we doing with the denominator currency? We are buying. What is the bank doing? Selling. Bank will sell at the ask rate. Bank will sell at the ask rate. Bank will sell at the ask rate. I don't have INR per USD. I have INR per GBP. Expand INR per GBP into GBP per Euro into Euro per Singapore dollar into Singapore dollar by USD till I get USD in the denominator. If you have the ask rate, if you have the ask rate directly, if you have the ask rate directly, use it. Else do 1 by bid. Else do 1 by bid. Else do 1 by bid. Any doubts on this? This is the steps to solve the basic problem. Steps to solve the basic problem. I think there can't be an important step than this. We would have used this extensively for problem solving, and most of you would be very clear with this. Can we proceed? Okay. Then exchange margin. Banker is saying, I asked the exchange rate. He said INR 85.86 per dollar. I said, banker, very happy. You are making 1 rupee profit. He says, no, not 1 rupee. I'll make more profit by adding something called as an exchange margin, which is added to the ask rate 86.86, subtracted from the bid rate 84.15, and now the profit is around 2 rupees. Now the profit is more than 2 rupees. Earlier the profit was 1 rupee. Increase the profit. Now how do I apply the exchange margin if it's a cross rate? Get final rate. Get final rate. What is final rate? A by B into B by C into C by D into D by E. and then apply the exchange margin on the final rate. Apply the exchange margin on the final rate. You follow only this approach. Apply the exchange margin on what? On the final rate. On the final. There's another approach where you apply once, but you apply on the final rate. You apply on the final rate. When I'm doing my calculation, the bid can sometimes become 1 by ask. The bid can sometimes become 1 by ask. You get this rate. You get this rate. If you get this rate, this is the bid rate. Subtract the exchange margin. Or you can also add the exchange margin in the denominator, because in the denominator you have the ask rate. Once it becomes the divided by, it becomes the bid rate. It becomes the bid rate. You can either get the rate, deduct the exchange margin from the bid rate, or in the denominator you can add the exchange margin. Both will give almost the same answer. Okay. Sometimes question will say exchange margin on buying rate and selling rate. Now, my buying rate is different. Banker's buying rate is different. For banker, the buying rate is bid. For me, the buying rate is ask. When I buy, I have to pay the ask rate to the banker. I have to pay the ask rate to the banker. So, if they say exchange margin on the buying rate and the selling rate, we had in one problem, we'll understand that to be banker's buying rate, banker's selling rate, banker's buying rate and banker's selling rate. Now, exchange margin, when you add, this rate is called interbank rate. This rate is called inter. This rate is called merchant rate. Merchant rate is applicable when a bank deals with a customer. But if a bank is dealing among themselves, no exchange margin. No exchange margin when a bank is dealing with another bank. When a bank is dealing with another bank, no concept of exchange margin. No concept of exchange margin. Clear? Cover rate. What is cover rate? It's banker does lot of buying and selling. He sold 10 lakh dollar today. He sold 10 lakh dollar today. Cover transaction, he has to buy 10 lakh dollar. Cover transaction, he has to buy 10 lakh dollar, or squaring up transaction, he has to buy 10 lakh dollar. When he is buying 10 lakh dollar, you will have other currency in the question and find out what is the buying rate. When a bank deals with a customer, we ask what is the denominator currency, what is the customer doing, what is the bank doing. But when one bank is dealing with another bank, both are banker. Both are banker. The initiating bank is like the customer, and the other bank is the real bank. The other bank is the real bank. This is to decide the bid and the ask rate. This is to decide the bid and the ask rate. I did the calculation, got some profit or loss. Profit or losses in INR currency, story over. If it is a non-INR currency, if there is a profit, happily sell that, convert to INR. Happily sell that and convert to INR. If there is a loss, buy that and replenish the loss. Buy that and replenish the loss. Buy that and replenish the loss. Return in foreign currency. What is return in foreign currencies? When I'm investing in any currency, if I'm investing in US dollar currency, USD return is equal to what I get back minus what I give divided by what I give into 12 by M into 100. In USD, the return is 10%. The INR return could be more than USD return because the US currency may appreciate. The US currency may appreciate. Where we learned 1 plus INR return is equal to what? 1 plus USD return into 1 plus appreciation of USD, or 1 minus depreciation of USD. I don't know the USD. I know the INR numbers. Take the USD this side, INR other side. Take the USD. So I can also say 1 plus USD return is equal to 1 plus INR return into 1 minus depreciation of INR. If there is a depreciation. If there is a depreciation, you can call what? 1 minus depreciation of INR. This formula I can use if there's a one-way quote in the question, and I can compute the appreciation depreciation percentage. How we compute, you already know. I'll be anyway discussing it as we proceed. If there is a two-way quote, ignore all this and go ahead and convert all cash flows into INR and use the formula what I get back minus what I give divided by what I give into 100, or convert everything into US dollar, what I get back in US dollar, what I give in US dollar, divide. For conversion, you may have to use the bid rate, you may have to use the ask rate depending on the data in the question. Clear? Understood? Okay. Then comes the swap points. The swap points is the difference between the spot rate and the forward rate. Difference between the spot rate and forward. Spot INR 85.25, 85.75 per dollar. Swap points 10, 15. Swap points is 10 and 15. The 10 would mean the last two decimal. 15 would also mean the last two decimal. What are the last two decimal? 0.10, 0.15. This is in ascending order, add it. This is in ascending order, add it. If it's 15, 10, the meaning is 0.15, 0.10, descending order, deducted. Descending order, deducted. If they say 85.2375, 85.4385, and they say 20, 30, 20 and 30, this means 0.0020, 0.0030. Ascending order, descending order, ascending order, add it. Ascending order, add it. If they say 238, 85.298, and they say 2, 3, only 2 and 3, this will mean 0.002003. Okay, they said 2 and 3, but they say 1 point equal to 1 paise. 1 point is equal to 1 paise. Then 2 will mean 2 paise, 3 will mean 3 paise. 2 will mean 2 paise, 3 will mean 3 paise. 3 will mean 3 paise. 2 will mean 2 paise, 3 will mean 3 paise. They gave the pointers 0.2, 0.3, 0.2 and 0.3. 1 point equal to 1 point equal to 1 paise. 1 point equal to 1 paise. So 0.2 divided by 100 is the number of rupees. 0.2, because 1 paise is 1 by 100th of the rupee. 1 by 100th of the rupee, and 0.3 by 100 will mean 0.002, 0.003, 002 and 003. 0.2, 0.3, 1 point equal to 1 paise. I have only 0.2 points. I have only 0.2 points. Or they may say 1 point equal to 1 cent. 1 point equal to 1 cent. 1 cent is 1 by 100th of the dollar. 1 by 100th of the dollar. 1 by 100th of the dollar. So if they say 2 cents, it is 0.02. If they say 20 cents, 0.20. And if they say 0.2 cents, 0.002. 0.002. Don't try interpretation and all. If they have told this is what 1 cent means, follow whatever the question says. Ascending, descending order logic continues even in this scenario. And if they use the word swap premium, if they use the word swap premium, whether it is descending order, ascending order, add it. If they use the word swap discount, ascending order, descending order, deducted. Ascending order, descending order, deducted. Okay, they are saying, can you calculate the percentage of appreciation or depreciation? I can do my calculation only for the product currency. Only for the product currency. What is the formula? NAV1, NAV0 divided by NAV0, 12 by M into 100. NAV1 means forward rate, NAV0 means spot rate. Forward rate minus spot rate by spot rate into 12 by M into 100. Which one do I do? Do one formula for bid rate, one formula for ask rate. Do one formula for bid rate, one formula for ask rate. They're saying do it for the price currency. Take extra effort, convert the direct into indirect, indirect into direct. Price currency will become product currency. Product currency will become price currency. If you want, if the question says INR 80 per dollar, this formula is for dollar. You want for INR, do USD 0.0125 per INR. Now you can do for INR. Now you can do it for INR. You will have one spot rate, also one forward rate. They say use average rate to compute. Average rate to compute means in the denominator take average of forward and spot. Take average of forward and spot in the denominator. In the denominator, product currency FR minus SR by SR into 12 by M into 100. Denominator will be average of FR and SR. Price currency convert. Computed percentage positive appreciating. Negative depreciating. Calculate one for bid rate, one for ask rate. Okay. They give the appreciation depreciation percentage in the question and they say rate is INR 80 per dollar. Dollar appreciates by 10%. If dollar appreciates by 10%, 80 plus 10% is the forward rate. 80 plus 10% is the forward rate. They say INR depreciates by 8%. INR is not the product currency. INR is not the product currency. Convert the quote. Convert the quote. What is the converted quote? USD 0.0125 per INR. And you can subtract 8% from this. You can subtract 8% from the second quote, or you can add 10% to the first quote depending on the data in the question. Depending on the data. They say this is 10% per annum and you want 6-month rate. Please do the proportionate 6-month. Do the proportionate 6-month is 5%. Proportionate 6-month is 5%. So add premium given for product, deduct discount given for price currency, convert the quote, price becomes product, product becomes price. They say 6-month premium 3%. Word per annum is not there. Word per annum is not there. 3% is directly for 6 months. If they use the word per annum, if they use the word per annum, make it 1.5%. Make it 1.5% for 6 months and then do the computation. Clear? Able to understand this? Okay. If they give swap points for 1 month and 3 months, use the interpolation logic. Use the interpolation logic and do 2 months, 2.5 months, 2.25 months, 1.5 months. Anything can be computed. Anything can be computed. Then we learned IRPT. IRPT basically said 1 plus price currency risk-free rate 1 plus product currency risk-free rate equal to F1 by E0 equal to F1 by E0. I am doing 3-month forward rate, take the 3-month interest rate. I'm doing 6-month forward rate, take the 6-month interest rate. I'm doing 2 years, do power 2 and call it as F2 by E0. Call it as F2 by E0. Or when we did international financial management, from E0 get F1, from F1 get F2, from F2 get F3, from F3 get F4, from F4 get F5. You can keep proceeding forward. You can keep proceeding forward. Whichever country has higher interest rate, value of that currency will depreciate. The value of the currency will depreciate. Higher interest rate will lead to depreciation of the currency of that country. If somebody says INR appreciated by 4% against US dollar, the meaning of this is India's interest rate is approximately 4% more than US interest rate. Approximately 4% more than the US interest rate. That is why our currency is depreciating. That is why implied difference in interest rate is 4%. Implied difference is 4%. Somebody says GBP appreciates by 8% against euro. This means GBP has 8% lower interest, 8% lower interest against euro. GBP has 8% lower interest against euro, Able to understand this? Whichever country is appreciating, they have what interest rate? Lower interest rate, and the other country has higher interest rate. Now, for expecting the exchange rate, I can either do IRPT or I can do PPT. PPT means purchasing power parity theory. IRPT uses interest rate, PPT uses inflation rate. Same proportionate logic and all will work. With this, the basics part is over. Then now comes the arbitrage part. We have three types of arbitrage: space, time, triangular. Space means buy at lowest rate, sell at highest rate. I can buy only at the ask rate, and I can sell at the bid rate. Buy at the lowest ask rate from ICICI, SBI, HDFC, HSBC. Lowest ask rate. Sell it at the highest bid rate and see if you can make money. Buy it at the lowest ask rate. Sell it at the highest bid rate. I am doing a problem where they give multiple banks, multiple rates, and I'm doing any other scenario. Wherever you do, if you are using the ask rate, take the lowest ask rate. Wherever you are using the bid rate, take the highest bid rate. Ask is becoming 1 by bid. Take the highest bid. Ask is becoming 1 by bid. Take the highest bid rate in the denominator. Take the highest bid rate in the denominator. Bid is becoming 1 by ask. Take the lowest ask rate in the denominator. Take the lowest ask rate. I will go through the lowest ask rate, highest bid rate, and make money. How can I make money? I went to the bank. One bank said 80, 85. Another bank said 90, 95. Very rare. Okay. I will buy at the 85, lowest ask rate, sell it at 90, highest bid rate. Buy it at 85, sell it at 90, make a profit of 5. Make a profit of 5. Question gave 80, 85, and the second quote they said USD 0.01, 0.012. Convert the rate, this rate also into INR per USD. Convert this rate also into INR per USD and then do lowest, then do the lowest ask rate, highest bid rate. This is on space arbitrage. Buy in one bank, sell in another bank. Buy in one bank and sell in another bank. The second part we learnt was time arbitrage. Buy in one time, sell in another time. What we do here is we follow IRPT and calculate fair forward rate. There is a actual forward rate. Fair forward rate is INR 85 per dollar. Actual forward rate is INR 87 per dollar. 87 per dollar. The actual is more than fair. The actual is more than fair. This means the dollar in reality is getting a very high valuation. Very high valuation on the last day. Very high valuation on the last day. Create an asset in dollar. Create an asset in dollar, liability in INR. Create an asset in dollar, liability in INR. Create an asset in dollar, liability in INR. So here, if the actual forward rate is greater, the other way around, actual forward rate is greater than fair forward rate. Actual forward rate is greater than fair forward rate. In this scenario, invest in the product currency, borrow in the price currency. What are arbitrage steps? Arbitrage steps is very simple. Prepare your balance sheet. Take a loan in one currency. Take a loan in one currency. Which currency? 8% USD loan. Convert this into INR. Convert this into INR. Here it is 12% INR deposit 20 lakh, loan taken 25,000, repay the loan, redeem the FD. This maturity is 21 lakh, this maturity is 27,000. You have to use this 21 lakh and pay the loan. You will be still left with some money. You will be still left with some money. That money is called arbitrage gain. That money is called arbitrage gain. You can calculate in dollars. You can also calculate in INR. Take one loan, create one deposit. Take one loan and create one deposit. Loan will also mature. Deposit will also mature. Deposit value will be more than the loan value when you are trying to repay the loan. When you are trying to repay the loan. This is possible if they give one-way rate. If they give a two-way rate, if they give a two-way rate in this scenario, don't try anything, trial and error method. Borrow in INR, invest in USD. Borrow in USD, invest in INR, prepare the balance sheet and see on the last day, are you still getting any extra amount? Are you still getting any extra amount on the last day? Able to understand the arbitrage part? Third arbitrage is triangular. Triangular means a three currency USD, INR, GBP. You will be starting with one currency. It can be any currency. If you're starting with USD, convert the USD to INR, convert the INR to GBP, convert the GBP back to USD. Start with 1 crore. You may end with more than 1 crore. Or do the other one. USD to GBP, GBP to INR, INR to USD. In this process, you may end with more than 1 crore. If you are ending with more than 1 crore, that option gives you arbitrage gain. That option gives you arbitrage gain. It can be a very plain problem without any bid and ask, or it can be with bid and ask. With bid and ask means both may give a loss also. With bid and ask means both may give a loss also. Both may give a loss. And if there is an exchange margin, every time you convert, consider the exchange margin. Every time you convert, consider the exchange margin. Triangular arbitrage. Let us assume we have three quotes. Starting is USD, USD to GBP to INR to USD, or USD to INR to GBP to USD. Draw a circle and go clockwise or go anti-clockwise. Go clockwise or go anti-clockwise and see which gives you money. With this, arbitrage is over. With this, the arbitrage part is over. The last part is hedging. In hedging, we have multiple techniques. I'll go one by one. First technique is currency invoicing. Currency invoicing said very simple. All my discussion is from India point of view. Import, do it in INR. Export, do it in INR. Billing in INR, accept billing in INR. Not able to do, then you have to think about other strategy. But if you can get the bill in INR for exports as well as import, I do not carry any forex risk. I do not carry any forex risk. Now question says the bill amount is USD 1 lakh. Convert this into INR. The bill amount you have to convert into INR. You can multiply with the bid rate. You can multiply with the ask rate. You can multiply with the average rate. You can multiply with any other rate. There is no consistency in the solution if you want to convert. Okay. Assuming I decided INR is not possible. Then he says three possibility. GBP, USD, Euro. Appreciates by 4%, appreciates by 6%, appreciates by 8%. If I am exporting, asset is created. If I am exporting, asset is created. Bill it in the maximum appreciating currency. Bill it in the maximum appreciating currency. If I am importing, liability is created. Bill it in the maximum depreciating, but none are depreciating. Maximum depreciating, but none are depreciating. If none are depreciating, least appreciating currency. Least appreciating currency. Asset maximum appreciating or least depreciating. Liability maximum depreciating or least appreciating. If you want to eliminate INR, eliminate INR, but if I insist, it can lead to loss of business. If you don't want to eliminate but want to still decide, if you want to decide, export billing will be in the appreciating or maximum appreciating or least depreciating. Import will be in depreciating or maximum depreciating or least appreciating. I want to convert. You can do using bid rate, you can do using ask rate, you can do using middle rate, you can use negotiation. Anything can be done between the two parties because bank is not coming into picture here. Okay, next technique is called lead and lag. Let us assume I have a payable. In a payable, lead means pay today. Lag means pay on day 90. Pay on day 90. Here, when you pay on day 90, you'll have $1 lakh into 92 forward rate, 92 lakh rupee. $1 lakh into 92. 92 is a forward rate they'll give in the question. If I pay today, I will ask him, will you give me some discount? He may give also. If I pay today, I may be paying 99,000 and today the rate is 90. Today the rate is 90. When I multiply this, let us assume this is 89 lakh. Don't worry about the exact numbers, okay? 89 lakh. This is day 0. This is month 3 or day 90. To take this to month 3, add interest. Add interest. Which interest? If you are having no money, borrowing interest rate. If you are having lot of money, investment interest rate. If you are having lot of money, take investment interest rate. I add 3-month interest rate, 2 lakh. 91 versus 92. 91 is better. 91 versus 92. 91 is better and go for lead the transaction. Okay, is it only day 0 versus day 90? No, it can be day 0 versus day 60 versus day 90 versus day 120 versus day 120. Pay day 0, add 4-month interest. Pay day 60, add 2-month interest. Pay day 90, add 1-month interest. Pay day 120, no adding interest. No adding interest. Sometimes today if you pay it is 1 lakh and if you pay day 90, supplier will say 1 lakh too. Supplier may charge interest also. Supplier may also charge interest. Consider that in the calculation. Apart from this, I have receivable. In receivable, lead is little difficult. Lead means collecting money immediately. For collecting money immediately, the other guy has to agree. Assuming he agrees and he gives you 98,000. He gives you 98,000, multiply with the spot or divide, whatever, multiplication, division and all we know. Other side it is 1 lakh into 91, again 91 lakh receipt. This side the receipt is 88 lakh, add interest to take it to the last day. This becomes 90, this becomes 91. Receipt, higher inflow is better. Receipt, higher inflow is better. Payment, lower outflow is better. Okay. When I'm doing a payment transaction, my supplier says, I can't give you credit. You give me a letter of credit. You give me a letter of credit. Then only I can trust you. Then only I can trust you. In this case, lead, pay today, add interest, get final amount, story over. Pay today, add interest, final amount. When you lag, you have to give a letter of credit. You have to give a letter of credit. For that, pay commission day 0. Take the commission to the last day by adding interest on LC commission. By adding interest on LC commission. And on the last day, pay your supplier. On the last day. So you have to pay commission, interest on LC commission and pay the supplier. If LC is not needed, only the payment to the supplier. Only the payment to the supplier. Lead versus lag is also over. Whatever I had to discuss, everything is discussed. Next part is netting. Netting basically means there are two types of netting. One is called bilateral, second is called multilateral. A has to pay B, B has to pay net of the amount. Net of the amount. A has to pay B, B has to pay C, C has to pay D, A directly pays D. A directly pays D, AB is cancelled with BC, BC is cancelled with CD and A directly pays D. That is called multilateral netting. What is the benefit of netting? My outflow in foreign currency, or the inflow in foreign currency comes down. Inflow in foreign currency comes down. When it comes down, I save the bid and ask spread. I save the bid and ask spread. Second part is there can be some transfer cost. Without netting, I have to do a transfer of 10 lakh. With netting, the transfer is only 1 lakh. Every time transfer is done, 1% is the expense banker takes away. This side 1%. Without netting, expense 10,000. With the netting, expense is only 1,000. I save 9,000 rupees or $9,000 because of the netting. I save 9,000 rupees or 9 without netting. So much transfer. With the netting, very insignificant transfer, and I save money. I save money. Other thing is, I can also use netting for cash management. What is cash management? Is there is an Indian entity, there's a US entity, there's a UK entity. Each of these guys can independently invest on their own, and after 1 year I convert all into Indian currency. After 1 year I convert all into Indian currency. That is called decentralized management. Or I tell everybody, let us do netting today. Let us do netting today, and I do one investment or one borrowing. That is called centralized cash management, and there can be a gap. Surplus is netted. Surplus is netted and do investment. Everybody does investment on their own. In the end, there can be a gap between the two, which can be a benefit ideally, but can be a disadvantage also sometimes. With this, netting is also over. Next part is forward contract. In forward contract, first thing is, do I enter into forward contract or not enter into forward contract? For this, my speculated outflow, forward contract outflow. If I take forward contract 90 lakh and I am speculating that if I don't take forward contract, I will pay 88 lakh. I'll pay 88 lakh. I will not take forward contract. This is outflow. I will not take forward contract if I speculate. What is my speculation? I assume 1 lakh into 88 I will pay. Reality is 1 lakh into 90 by the bank. I don't want to take the forward contract. If it's inflow, speculated inflow, forward contract inflow. Forward contract inflow is 90 lakh. My speculation is 89 lakh. If my speculation is lower, inflow is higher, inflow is better. So this number is take a forward contract. I will take a forward contract if it leads to higher inflow of INR, if it leads to higher inflow of INR or lower outflow of INR. In a forward contract, we have four numbers. First number is called build rate. Build rate is 90 lakh. I'm talking about a receivable, okay? Sales. The billing rate is 90 lakh. My speculation inflow. What is my speculation? Is I'm estimating. I am estimating I will get 88 lakh. I will get 88 lakh. Forward contract says you can get 89 lakh. Forward contract says you can get 89. Actual inflow without forward contract. Actual means last day. Last day is 88 lakh 25,000. 88 lakh 25,000. The gap between the build rate and your speculation. The gap between the build rate and your speculation is called expected gain or loss due to hedging. Without hedging. Expected gain or loss. Here 90 lakh is billed, 88 lakh is collected, 2 lakh loss I'm expecting. I'm expecting a 2 lakh. Forward contract says, don't worry, I will help you. With me, the loss is 1 lakh. With me, the loss is 1 lakh. That is called expected or actual loss with forward contract. And if you did not take the gap between 90 and 88.25 is called actual loss without hedging. Expected loss without hedging, actual loss without hedging, expected or actual loss with hedging, expected or actual loss with hedging. Compare the build rate with the speculated rate, Compare the build rate with the forward contract rate. Compare the build rate with the final actual rate. Sometimes they will not give all this, they just give these two. This is called post-mortem of the forward contract, and we are trying to compare, because of the forward contract, did I make money or did I lose money? Did I make money or did I lose money? That is called actual loss with forward contract, comparing with the what would have happened versus what has happened. What could have happened versus what has happened. Here, what could have happened versus what happened, don't look at the formula. Logic is very simple. If my inflow is better in forward contract versus a no forward contract, then I gained money. Inflow is lower, I lost money. Outflow is higher, I lost money. Outflow is lower, I gained money. For forward contract, I need a cover rate. What is the cover rate? Is IRPT rate. Cover rate is IRPT rate. They have given some cover rate in the question. Then take that rate. Very rarely you may pay premium, interest on premium. You may pay premium and interest on premium. Premium and interest on premium for a receivable. For a receivable, hedging rate minus the upfront premium minus the interest. Comparing notional with the forward. Notional means what could have happened on the last day versus what has happened. Another type of loss is this: hedging expected loss and loss expected loss with hedging, expected loss without hedging, with hedging and without hedging. Closure of a forward contract. I want to close the forward contract. For closing the forward contract, we'll have a format called what? Entry date. Participate. Entry date. Then what is that? Position, action, execution date, rate. Execution date and rate. Day 0, original position. I did buy, which is at the ask rate. This was for March 31. This was for March 31, and this rate was INR 90 per dollar, because you are buying in bracket. You may execute this contract on March 31. Everyone is happy. If you don't execute, you can cancel it at any time. You can cancel it at either before due date, on due date, after due date. You can extend before due date, on due date, after due date, or you can do something called as early honor, honor on due date, honor after due date. Other than honor on due date, everything will involve cancellation. So I came back on Feb 28. I came back on Feb 28. We write what here? Opposite. Opposite is what? Sell bid. I have to ensure it matches. On Feb 28, what is the March 31 bid rate? What is the March 31 bid rate? And this will give you cancellation gain or loss. After this, you want to enter into another contract, that is called new position. That is called new position. You don't want to enter, story over. So with this format takes care of cancellation before due date, cancellation on due date, extend before due date, extend on due date, extend before due date, extend on due date, and honor on due date is also covered because their cancellation is not needed. But if you are coming early honor, if you are coming early honor, ICI says day 0, we call what? Original position. Day 0, original position, sell bid, sell and bid, and this was for March 31, some rate 90. 90 is the rate. You come back on Feb 28 asking for early honor. You're coming for early honor, not cancellation. Cancellation means old calculation. Asking for what? Early honor. If you're asking for early honor, I have to write opposite. I have to write opposite, and opposite is buy in bracket, ask, cancel. Cancel the contract. For cancelling what? March 31 matches the March 31. On Feb 28, what is the ask rate? On Feb 28, what is the ask rate, cancelled at 91. Cancelled at 91. Then on Feb 28, new and sell bid, do a spot, do a spot honor, do a spot honor, do a spot honor. The spot honor is 89. The spot honor is 89. Now ICI says, assume you have executed it at 90 only. Assume you have executed it at what rate? 90. So I will get 90 into 1 lakh. I'll get 90 into 1 lakh. The gap between 2 and 3 is called swap loss. The 2 and 3 is called swap gain or swap loss, which I have to pay 91 and 89. I will have to pay minus 2 into 1 lakh. And ICI does one more thing called interest, which is not very logical. Row 3 rate minus row 1 rate. Row 3 rate minus row 1 rate. Row 3 rate is 89. 89. Row 1 rate is 90. If you are getting negative, you have to pay interest. If you are getting negative, you have to pay interest. Take care of the sign properly. Row 3 minus row 1, 80. This could be minus 89. This could be minus 90 also. Then minus 89 minus of minus 90. Minus 89 minus of minus 90. Multiply this with $1 lakh into number of days early by 365 into the rate of interest. If you are paying interest, pay at the higher rate. If bank is giving you interest, which happened in one question, they'll give it at the lower rate. They'll give it at the lower rate. This is called early honor. This is called early honor. In an early honor calculation, I'll repeat again. I will have to do 3 transactions, one original transaction, one opposite transaction, and in the end, one new transaction. Execution at the original rate, swap losses 2 plus 3, swap losses 2 plus 3, interest is row 3 minus row 1 into the number of dollars into the number of dollars into the rate of interest into number of days or months early by 365 or 12 by 365 or 12, and one flat cancellation charges may also come, which the customer has to pay the bank. This is early honor. Now I had a choice. I can do early honor on Feb 28 or I can do it on March 31. March 31 versus Feb 28 is called lead and lag with the early honor. Lead and lag with the early honor. If you do on March 31, wait and do 1 lakh into 90. Wait and do 1 lakh into 90. But when I wait, I got the money on Feb 28 itself. This 1 lakh, I will create a fixed deposit. This 1 lakh, I'll create a fixed deposit and earn $1 lakh into 4% into 1 by 12. And this will be converted at the actual rate on the last day. This will be converted at the actual rate on the last day. I got the money on Feb 28, but I'm not informing the banker. I wait till March 31. Use that 1 lakh at the original rate, balance at whatever rate is there on the last day. Or do all those 3 steps. That is, get the execution at the original rate, pay the swap loss, pay the swap loss, pay the interest on which day? On Feb 28, and this gives you 89 lakh. This gives you 89 lakh on which day? Feb 28. To take it to March 31, add the interest. To take it to March 31, add the interest. This is called lead and lag with the early honor. The last scenario is late. Late means first to do customer analysis. Customer, what will you do? Date, position, keep participating. Date, position, what? Action, execution, date, rate. Date, position, action, execution, date, and rate. One original, one opposite. This rate is called cancellation rate. This rate is called cancellation rate. And on this, the customer has to pay cancellation loss. Customer has to pay cancellation loss. Banker is saying, you are not giving me instruction. 3 days grace period you have. Whenever you are coming back, see, the original date will be June 10. Cancellation date will be June 13. It may not match here. It may not match here because you're coming back on which day? You are coming back on June 13, both may not match. Both may not match. Cancel the contract, collect the money from the customer. But before that, as per FEDI rule, banker, as per FEDI rule, banker has to do something. As per the FEDI rule, banker has to do something. Banker does one back-to-back contract. Banker does what? One back-to-back contract with the another bank. One back-to-back contract with the another bank. So for the banker, date, position, action, execution date and rate. He will have original, he will have opposite, and he will have new. 2 plus 3 is called swap loss. 2 plus 3 is called swap loss. Recover this money from the customer. 1 plus 2 is called cancellation loss on this just charge interest. On this just charge interest. In the end, I want the customer to pay banker swap loss, interest on cancellation loss of the banker, one flat cancellation charge, and cancellation loss of the customer. Cancellation loss of the customer, and the contract will get auto cancelled in 3 days. After you pay this, you say cancel, story over. You say honor it at the spot rate. Honor it at the spot rate. You are saying you want to extend, take a new contract on June 13 for whatever date you want. Take a new contract on June 13 for whatever date. I can honor on due date, before due date, after due date, cancel on due date, before due date, after due date, extend on due date, before due date, after due date. If I am doing cancel on due date, before due date, extend on due date, before due date, this is the format. Original, loss on cancellation, and you may enter a new contract if you want to extend. If you want to extend, you may enter a new contract. The second part is, if customer does not appear, banker has one contract with the customer for Jan 1 to March 31. He also has another contract with another banker for Jan 1 to March 31. You happily do not come on March 31, but I have to fulfill my commitment with the other bank. I have to fulfill my commitment with the other bank. So as per FEDI rule, on March 31, this contract is, bank with bank is cancelled. Bank with customer is still live. Bank with customer is still live. So as per the rules, I cancel the ICICI contract and take the next row contract. Take the next row contract. In this process, I am going to incur certain losses. One is the swap loss of the bank, interest on cancellation loss of the bank, and cancellation loss of the customer. Cancellation loss of the customer. All the three you have to pay. Then honor before due date. Honor before due date means cancel and do a spot honor. ICICI says no, it is not spot honor. Honor happened at the forward rate. Row 2 plus row 3 is called swap loss, and you have to pay interest. Interest, there is no logic. Don't go with any of this formula. Debatable item. I have told you to write in your book itself. Row 3 minus the row 1 into the number of dollar into the interest rate into number of months by 12 or number of days by 365. If you are paying interest, higher interest rate. If you are receiving interest, lower interest rate. We also learned there can be a lead and lag. There can be a lead and lag with what? Early honor. Lead and lag with early honor. If you are having an early honor it on that day, get the money and save INR interest. Save INR interest, or keep that money as it is. Invest in dollar, earn dollar interest. Earn INR interest or earn dollar interest, and see ultimately which amount is better. See ultimately which amount is better. Time value of money component, currency. Time value of money is, the question will say 2 by 10 net 30. 2 by 10 net 30 means you get a 2% discount if you pay within 10 days. Otherwise, make the payment in 30 days. Otherwise, make the payment in 30 days. So, if there is a discount, I am paying 98,000 vis-a-vis 1 lakh. The saving in $2,000 or extra payment of $2,000 is technically called time value of money component. This, if I pay today 55, if I pay later, it is 56. The gap between 55 and 56 is called currency fluctuation component. The gap between 55 and 56 is called currency fluctuation component. So whatever discount into the exchange rate on the last day also can be done. Today also can be done. ICI does the last day rate into 56, and 1 rupee saving, and 1 rupee saving or 1 rupee extra is called currency fluctuation component. Decision on hedging. When I am doing decision on hedging, either I will hedge all the currencies, or I will not hedge all the currencies, or I will not hedge. I will not be doing selective. I have three scenarios. Calculate their contribution in every currency, add the contribution, total contribution by total sales if hedging is done, total contribution by total sales if hedging is not done, if hedging is not done, and see which is better. See which is better. Money market hedge means open a balance sheet to have a debtor USD 8 lakh, take a loan USD 7 lakh 90, convert into INR FD 57 lakh. This and this will cancel on the last day and earn 57 plus interest. Earn 57 plus interest, but you will have to take care the amount calculation part. Or I have a creditor USD 8 lakh, create a FD USD 7 lakh 85, but FD can't be created immediately. To create the FD, take a loan 90 lakh and repay the loan along with interest. Repay the loan along with interest. Repay the loan along with interest. Transaction exposure means increase or decrease in profit due to change in exchange rate. Do one profit statement at the billed rate, another profit statement at the realized rate, the difference. Operating exposure means all changes other than the currency. What can be changed? Selling price can change, cost price can change, number of units can change. And there's a concept called price elasticity of demand, which basically says that if price increases by 1%, volume will decrease by 1 into the elasticity of demand. Volume will decrease, price will increase. Price will decrease, volume will increase. We have three types of bank accounts. Nostro account means our account with you. Vostro means your account with us. Loro is an interim account for transferring one bank to another bank and then goes to the third bank. Then goes to the third bank. There is a concept called exchange position and cash position. Exchange position will record all inflow and all purchase and sale of foreign currency, whether the money came in or did not come in, whether the currency came in or not. So we record purchase, sale, and purchase will lead to inflow, purchase will lead to inflow, sale will lead to outflow. Look at like a raw material, look at like a raw material. Purchase will lead to what? Inflow. Sale will lead to outflow, and record the transaction. What are the transaction? Forward purchase, record here, money does not come in. Spot purchase, record here, record here also. Spot purchase means money came in that time. Currency came in. Forward sale, record here, don't record in other words. Spot sale, recorded both the places. In the end, I want to do balancing. If when I do balancing, there is an exchange position which says overbought 20,000. Cash position, I have a balance of 30,000. First, I will balance the cash position. I want 40,000. I want 40,000. Add another 10,000. Add another 10,000. This became 40. And this is a purchase. Bought has now gone up to 30. From an overbought, next I will do the exchange position. I want a oversold 20,000. We are at overbought. If you want oversold, sell first 30 and then sell another 20. Sell another 20. So you will get into an oversold 50,000. How will you do oversold? Forward sale. Forward. If you do spot sale, this balance will go down. This balance will go down. First we have to balance. First we have to balance the cash position. Next we have to balance the exchange position. Next we have to balance the exchange position. Last part, currency futures. Very simple. First write the exposure amount. The exposure amount can be 10 lakh dollar. In bracket, write what you are doing. Write what you are doing. 10 lakh dollar I am buying. There will be a future rate which is USD 1.8 per GBP. Convert this 10 lakh at the rate of 1.8. Convert the 10 lakh at the rate of 1.8. Exposure amount, whatever amount, 5 lakh GBP sell. 5 lakh GBP sell. 5 lakh GBP sell. They will give you contract size which can be in dollars, which can be in GBP. Assuming it is in GBP, 50,000 GBP, 5 lakh divided by 50,000, 10 contract sell. 10 contract sell, because we are doing GBP. Sell means I'm pressing the sell button first, buy button later. On the sell, I may have to pay some margin money. If you pay margin money, you have to consider interest on margin money. You have to consider interest on margin money. On the last day, day 0, day 90, spot 1.7, 1.8. Spot is 1.7 and 1.8. This is, sorry, day 0, spot. And on the last day, both may match, may not match. On the last day, it is 1.85, 1.84. I press the sell button here. I press the buy button here. I press the sell button first, buy button later. There is a loss here. The loss here is USD 0.04 per GBP. Get the overall loss, and your realization or payment will happen at the actual spot rate. Realization or payment will happen at the actual spot rate. Realization or payment will happen at the actual spot rate. Along with that, there will be a futures profit or loss, and there will be interest on margin money. Interest on margin money. This is as far as futures is concerned. When it comes to option, same thing. First we write exposure amount, INR or USD 10 lakh by USD 10 lakh by exchange rate INR 90 per dollar. Strike rate, sorry. Strike rate is 90 per dollar. Exposure amount, let's take this as 1 lakh. INR exposure is INR 90 lakh. INR 90 lakh, and I am going to sell. Other one I'm going to buy. Other one I'm going to buy. The second one I'm going to sell. They'll give contract size which can be in INR, which can be in US dollar. It can be any currency. Can be any currency. If they give contract sizes dollar, divide 1 lakh by the contract size. If they give it in INR, divide by INR. Divide by INR or divide by dollar. If it is in dollar, 1 lakh by $10,000, and if it's an INR, 90 lakh divided by INR. If the contract is in dollar, the product currency will be dollar. If the contract is in INR, the product currency will be INR. See the product currency. If the product currency is dollar, we are buying dollar call option. We are buying dollar call option. If the product currency is INR, we are selling, we will take a put option. We will take a put option. We will take a call option or a put option depending on what is the product currency. What is the product currency? Pay premium, consider interest on premium, and on the last day, one inflow or outflow will be there. One inflow or outflow. And if the contract is in decimal, there will be one inflow at the hedged rate and a small amount at the unhedged rate. Small amount at the unhedged rate. So currency futures will have one payment at the spot rate, one net settlement will happen, and interest on margin money. What, how to decide? Don't look at import or export. Don't look at import or export. Just to see what is being done with the product currency. Just to see what is being done with the product currency. Just to see what is being done with the product currency. Clear? Similarly for here, don't look at export or import, just to see what is being done with the product currency. If you are buying the product currency, call option. If you are selling the product currency, put option. And your outflow will be premium, interest on premium, and there can be a hedged inflow, unhedged inflow, or hedged outflow, unhedged outflow. Outflow means all outflow add together. Inflow means in hedged inflow, unhedged inflow, and premium you have to subtract. Premium you have to subtract. And investment decision means, where do I invest my money? Where do I invest my money? I have INR, convert into GBP, invest in GBP, finally convert into INR. You have INR, convert to USD, invest in USD, finally convert back to INR. You have INR, convert to Euro, invest, finally convert. Wherever you get higher inflow of INR is the best place to invest. Two places giving same amount, indifferent from return point of view, go through the risk angle. Go through the risk angle. Like this, I want to do financing. I want to do financing. Look at the interest rate. If the interest rates are same, equal to risk free rate, anywhere you can borrow. If the interest rates are different from the risk free rate, and they have not given any rates and all in the question, amount and all, calculate the risk premium through the IFM formula. What is the risk premium? 1 plus risky rate is equal to 1 plus risk free rate into 1 plus risk premium. Whichever has the lowest risk premium, borrow. They have given forward rates, other things are given in the question. Take borrowing in one currency, convert, repay in, borrow in USD, repay in USD, convert to INR, see how much outflow. Or borrow in INR, pay interest in INR, repay in INR, which leads to lower outflow of INR. And if they ask indifferent borrowing rate, that is nothing but FRA, future value factor for 6 months, equal to future value factor for 6 months, which is, take the 1 plus 6 month rate, 1 plus 3 month rate, into 1 plus the rate from 4th month to the 6th month, rate from the 4th month to the 6th month. And in the end, this is the summary of the strategy. One question on forward contract payable receivable, one question on money market hedge payable receivable, one question on currency futures, where it matches, it does not match. Currency option, it matches, it does not match. Currency invoicing, no hedge. And if they give rate like this, if they give the rate like this, for the bid rate subtract this number, for the ask rate add. And what is exchange exposure risk? Is transaction exposure. Build rate compared with the realized rate, profit at build rate compared with the realized rate. With this, the forex part is over. Now whatever I have done may not give you full clarity, but whenever you are doing revision, see this once and then start doing question. Whichever area you are struggling, you will try to spend more time on that whenever you are doing your revision. Clear? Done. With this, forex is over. We move to the next chapter, which is on derivatives analysis and valuation. Derivatives is basically an instrument which derives value from some other instrument. So we have something called as a futures, options, forwards, and swaps. Forwards is something we learned extensively when we did the Forex part of it. Futures is very simple. There is a spot rate 24,000. I have to calculate a fair futures rate. This fair futures rate can be computed for different time period. The futures can have different time period. For example, today is Jan 1 and I want to do Jan 31. 1 month extra compounding has to be done. I want Feb 28. 2 month compounding is to be done. I want March 31. 3 month interest is to be added. I want April 30. 4 month interest is to be added. So we have two prices. One is called spot price. Second is called futures price. Spot price influences the futures price, and spot price is the price at which I do spot buying and spot selling. Futures price is the price at which I enter for a future buying and a future selling. The futures price can be of two types. One is called AFP, second is called FFP. AFP is the price actually in the market. FFP is the price which I compute. The AFP can be for different time period. FFP also can be for different time period. If you are trying to do hedging, speculation, arbitrage, anything can be done only with the actual futures price. Anything can be done only with the actual futures price. Now, how do I compute FFP? There are two formulae. One is called spot price into 1 plus R power N. This is your time value of money problem. Other side formula which we have is spot price into e power rt, or e power rt is called continuous compounding or daily compounding or ccrfi compounding. 1 plus spot price means the price of the share in the stock market. This price can be spot price minus pv of dividend. Subtract the dividend. When you subtract the dividend, you get the ex dividend price. You get the ex dividend price. Otherwise it is called a cum dividend price, or you can do spot price plus pv of storage cost. You can add the storage cost or subtract the dividend from the calculation. Similarly, R can be replaced as R minus Y or R plus S. Y is a continuous dividend yield. S is a continuous storage cost. If you are doing continuous compounding, for calculating the present value, you have to do continuous discounting. And if you are doing normal compounding, you have to do normal discounting to get to the present value. So I have a spot market, spot price, TCS spot price is there. Futures market, this gives me the futures price. Spot is 3786. Feb, March and April, you have the futures price. Two types of price are there: actual futures price, fair futures price. Actual futures price is the price at which it is dealing in the market. FFP is the price at which it should deal in the market. I can do normal compounding 1 plus R power N. I can do continuous compounding e power RT. If there is a dividend in rupees, subtract the present value of dividend. If there is a dividend in percentage, R is replaced with R minus Y. If there is a storage cost in rupees, add the present value of storage cost. And if it's in percentage, replace R with what? R plus S. Replace R with R plus S. To get the present value, divide by e power RT or divide by 1 plus R power T, or to get the present value of storage cost also divide by e power RT or 1 plus RT. How do I get e power 0.04? 1 plus 0.04 by 1 factorial, 04 square by 2 factorial, 04 cube by 3 factorial. This is to get the present values. Then these are the information I need to calculate the FFP. I need a spot price. I need for what time period are we calculating? What is the risk-free rate of interest? Dividend in rupees or in percentage. Storage cost in rupees or in percentage. And I need a compounding frequency. For compounding frequency, practical world we do CCRF. Question says daily, do e power. They use the word ccrfi, do e power. They give e power value in the question, do e power. If they give monthly, do monthly interest, monthly compounding. If they give quarterly, quarterly interest, quarterly compounding. If they give half yearly, half yearly interest, half yearly compounding. They have not given anything in the question. R is for the time period of the futures contract, power 1. R is for the time period of the futures contract and power 1 and power 1. Arbitrage gain calculation strategy. I compare the FFP and AFP. 1800, AFP 1900. Futures are over. Futures are overvalued. Actual is higher. Actual is higher. Sell future. Buy spot. To buy, take loan. To buy the take loan. Take loan. Arbitrage gain is equal to difference between higher number and the lower number. Higher number and the lower number. Otherwise, the other strategy is buy future, sell spot, create FD. This will come if futures are undervalued. If futures are undervalued, buy in the futures market, sell in the spot market. And we assume that there will be a physical delivery which will happen. If there's a net settlement, we have a format. As we proceed, you understand that. And we saw cost to carry. Cost to carry is the cost to carry the asset in the spot market. Cost to carry is equal to FP as per formula. FFP as per formula minus the spot price. This is called cost to carry. The dividend which I take the dividend yield. If it is the same dividend yield every time, take that number as it is. But if it's different for different months, take the average of the dividend yield of the time period. Time period means if you are in January and you are doing July calculation, January to July average dividend, January to July or February to July, depending on we are on Jan 31 or Jan 1. If we are in July 31, 3-month contract, August, September, October average. August, September and October average. Same yield, take the same yield, take the average of the yield. Convenience yield. Convenience yield, the future value as a present value. Convenience yield is the extra benefit for the spot price and disadvantage for the futures price. So I did the FFP as per formula minus the FFP as per question or the AFP as per the question. Ideally, the difference was called arbitrage gain, but here the difference is called convenience yield. The difference is called convenience yield, and you can discount this convenience yield to the present value. You can discount this convenience yield to the present value. You can discount this convenience yield to the present value by discounting it at the risk-free rate. Okay, I have a spot rate 20,000. I have an arbitrage gain 1,000. Arbitrage gain 1,000. A question may ask implied risk-free rate. Implied risk-free rate. Normal 20%. Normal risk-free rate is 20% plus arbitrage gain by spot price 12 by M into 100. This is the extra earning without risk. Extra earning without risk added to the risk-free rate. Added to the risk-free rate. Extra earning without the risk. Extra earning without the risk added to the 20% number. Added to the 20% number. Next, physical settlement and net settlement. Physical settlement, give money, take delivery. Give delivery, take money. Otherwise, we do a format. Particulars, what do we write? Spot futures will have a time period. March future. It could be March future. Jan 1, 10,000. Futures could be given in the question. Not given, you calculate FFP. You calculate FFP. After calculating, it is 11,000. I may press a sell button or a buy button. I may press a sell button or a buy button at 11,000. I come back on Feb 15, my wish. I can come back on any day. I come back on Feb 15. That time this has gone down to 9,000. Futures will also go down. How much? You have to do FFP calculation. What is FFP? Spot into 1.5 month compounding. Another 1.5 month compounding. Another 1.5 month compounding, which is 9,500, and you press a buy button, and this will lead to profit or loss. Multiply with the lot size, multiply with the number of contract. I may come back on March 31 itself. That day, this is 8,000. Nothing given, this will also be 8,000. Nothing given, this will also be 8,000, and there can be a difference also. If they give a different number, take the different number. Nothing given, copy the same 8,000. Copy the same 8,000. I entered on Jan 1, 10,000. This is 12,000. I press the buy button. I came back on January 2 itself. My wish. I came back on January 2 itself. That day, this is 8,000, and this could be 8,800. And I press a sell button. Whatever profit or loss happens, calculate that. That is called net settlement. That is called net. You can enter on any day. You can exit on any day. Enter can be a buy button. Exit can be a sell button. Enter can be a sell button. Exit can be a buy button. Clear? Next concept. There are two types of markets: contango market and backwardation market. Spot 8,000. Futures more than 8,000 is a normal market or a contango market. More than 8,000. Lesser than 8,000 is a backwardation market. To calculate this, we calculate basis, and basis formula is spot minus futures. Why not futures minus spot? No issue. That is how the formula is. And on the last day, if spot and futures do not match, we call that risk as basis risk. We call that risk as basis risk. Ideally, on the last day, basis should be zero. Basis should be zero. But if it does not match, we create a risk called basis risk. Then the next part is hedging. For hedging, I need an item called beta, otherwise called as hedge ratio. How you calculate beta? Standard deviation of security, standard deviation of market, correlation of security with market. Standard deviation of security may be called standard deviation of spot, and market may be called future, and the correlation could be given in the question. After the beta is calculated or given in the question, we put a format called security beta weight product. Security beta weight and product. I have 1, 2, 3, 1.5, 2.5, 1.8. Weight, I could be buying it, I could be selling it. If I am buying plus 10 lakh, if I am selling minus 10 lakh, if I'm buying plus 10 lakh, I'm just taking an easy number, 10 lakh. I multiply the two. Multiplication will give us what? 15 lakh minus 25 lakh, 18 lakh. And after this, they may ask overall beta. You can do the overall beta, sum of product by sum of weights, or they will say hedge. Hedge happens through Nifty or Sensex futures. Nifty or Sensex futures, and they have a beta of 1. The question may say, I want beta, 0 beta. I want perfect hedge, 0 beta. I want full hedge, 0 beta. I want overall hedge, 0 beta. Or they may say, I want 0.3 beta. I want 0.3, 0.4. First, if you want 0, the total here is 0. The total here is 0. And the balancing figure, if I put a total here, and the balancing figure will be negative 8 lakh and negative 8 lakh. Sell Nifty futures worth 8 lakh. Sell Nifty futures worth 8 lakh to do the hedging. Sell Nifty futures worth 8 lakh to do the hedge, and please write below the table you are selling. Or instead of doing 0 beta, I want the beta to become 0.9. In that case, I need the weight total. I need the weight total, and Nifty futures will not be part of the weight total. This weight total is 10 lakh. Outer column I want 9 lakh. Balancing figure will be 1 lakh. Here 1 lakh. Buy Nifty futures worth 1 lakh. Buy Nifty futures worth 1 lakh. Buy Nifty futures worth 1 lakh. Anything can be there. Or they'll say, I want 80% protection. Beta has to reduce by 80%. Beta has to reduce by 80%. So hedge 0 beta, full hedge 0 beta, target beta whatever beta they give. Hedging of specific percentage, take that percentage, old beta minus 100% means old beta minus 100% is 0. Old beta minus 100% is 0. Security, beta, weight, product, balancing figure, Nifty futures. Balancing figure is Nifty futures. In the weight column, Nifty futures will not come. In the weight column, Nifty futures will not come. Beta of Nifty or Sensex or index futures is 1 time. Purchase is positive in weights, sale is negative in weights, and I will always be calculating the contracts based on actual futures price. Based on actual futures price. FFP can be the proxy for AFP if no data. Spot became proxy for FFP in one question because of no information. Because of no information, spot can also become proxy. Then normal rate is generally given in the question. They'll say cost of capital 20%. I take 20% as R. But sometimes they will give LN 1.2. LN 1.2. 1.2 is 20%. 0.19. This may not be 0.9, just for discussion. 20% normal rate is 19% CCRFI. 20% normal rate is 19% CCRFI. Or E power 0.19 will be 1.2. E power 0.19 will be 1.2. So if they give you natural log value in the question, convert the normal rate into CCRFI and then do E power RT. Then do the E power RT. No data there. Don't try to break your head and convert it because you can't convert on your own. Or just to do normal compounding if those indications are not there. Indication is E power value or something there. Then you can't do it. You will have to go through the CCRFI route. You have to go through the CCRFI. Like I want to modify beta through Nifty, I may modify the beta through something called as Nifty futures. I may modify this like we do it through Nifty futures. I am going to now modify this through risk-free borrowing or risk-free investment. If it is risk-free, this is 0. If it is risk-free, this is 0. This will also be 0. The total will be 8 lakh. And the question may say, I want a beta of 2 times. I want a beta of 2 times. This is balancing figure. This is balancing figure. The balancing figure will be 4 lakh. And this is balancing figure which can be positive, which can be negative. Negative means you are borrowing the money. Positive means you are investing the money. Positive means you are investing. Negative means you are borrowing. Some question can say you are borrowing and doing extra investment. You are borrowing and doing extra investment, then these numbers will not work. So we write portfolio, risk free, and a total. Portfolio, risk free, and a total. We write the total and take portfolio as balancing figure. Sometimes you'll say you will borrow, but you will invest in risk free, but to invest, you will sell the share. You will do sell the share. If you are selling the share, also the 10 lakh number will not work. The 10 lakh number will not work. So we will write portfolio, risk free, and total. Portfolio. When I do risk free, in the total of weights, risk free will come. In the total of weights, risk free will, and it can lead to partial sale of shares or partial purchase of share. Purchase means you have borrowed money. Sale means you sold and invested in risk-free asset. Profit or loss calculation. I did the calculation here, assuming this is Nifty futures and this is minus 10 lakh, some number, okay. Price change plus 2%, minus 2%, minus 4%, plus 8%. Weight into this is my profit or loss. Weight into this is my plus into plus is profit. Plus 10 lakh into plus 2, 20,000 profit. Minus into minus is also again profit. Plus into minus is loss. Minus into plus is loss. Minus into plus is loss. Weight into the price change. Positive weight, positive change, enjoy profit. Negative weight, negative change, again profit. Negative weight, negative change, again profit. Other scenarios will be loss. In this table, they may give overall loss, tell you to find some balancing figure, tell you to find beta balancing figure, tell you to find weight balancing figure. Anything can be balancing figure. Anything can be balancing figure. Effective realization. After taking futures, I need not be happy that I will get that money. Futures work like this. Day 0, 80, 85, I press the sell button. If you press the sell button in the forward contract, 85 is guaranteed. In the forward contract, 85 is guaranteed. Here, day 90, this is 84 and this is 83. This is 83. I will buy. I make a profit of 2. Make a profit of 2 and sell it at the actual rate. Sell it at the actual rate. So you'll be earning 84 plus 2, 86. 84 plus 2, 86, provided you have hedged the full amount. Some contract issues there, then it can slightly vary because we calculate the profit only for the hedged component or the whatever is hedging has been done. The sale will happen only at the actual rate. Sale will happen only at the actual. This could be for 1 lakh and the hedging could have been only for 90,000. If the lot size was 30,000, I would have hedged only for 90. So I may not get 84 plus 2. 84 into 1 lakh plus 2 into 90,000. 84 plus 1 lakh and 2 into 90,000. This is for sale. It can also be for buying. For example, original 80, 83 buy. On the last day 95, 94, press the sell button. Press the sell button. This will give you a profit of 11 and buy it at 95. Buy it at 95. 95 minus 11 is 84. 95 is the buying price. 11 is the profit. 11 is the profit. 95 I buy. Originally I wanted to buy. In reality, I will buy it at the actual rate. In reality, I'll buy at the actual rate plus or minus futures profit. Plus or minus futures. If this is 94, that is it matches. It matches on the last day, I will get my 83. If it matches on the last day, I will get my 83. Does not match, I may not get it. I may not get it on the last day. Does not match, I may not get it on the last day. That is a kind of unfortunate scenario with your derivatives part or the futures part. Asset swap. Asset swap means I am exchanging 1% with Sensex return. 1% with Sensex. So Sensex is this side. First quarter Sensex is 4%. 1%. Sensex is minus 2%. 1%. Sensex is plus 1%. So this could be my payment. This could be my receipt. This could be my receipt. Receipt minus payment will come to me. What is receipt minus payment? 4 minus 1, 3. Minus 2 minus 1. Minus 2 minus 1 minus 3. Minus 2 minus 1. Receipt minus the payment. Receipt minus the payment. Sometimes, unfortunately, the receipt is a negative amount. The receipt is a negative amount. Asset swap means one asset return is exchanged with another asset return. Margin concept. Broker is saying, I do not believe that on the last day you will fulfill the commitment. When we did forward contract, On the last day, we were canceling the contract. I cancel the contract on the last day, but I'm not able to find the customer. I'm not able to find the customer itself. Cancel, done. He has to pay me 10 lakh rupees. Banker is not able to find the customer. That is called default risk. That risk is there in a forward contract. In a forward contract, on the last day, customer is not traceable, and he has wound up. He has no money itself. All those problems can happen in forward. Futures, all that headache is not there because there is a margin collected. There is a margin collected. In forward also, you collect the margin, no problem. On the last day, use the margin. So here what we do, we have an initial margin, we have a maintenance margin. Initial margin is equal to absolute change plus 3 times of standard deviation, or 10% of contract, 8% of contract, 6% of contract. Maintenance margin will be a specific percentage of initial margin or a specific percentage of the contract. Initial margin 2 lakh, maintenance 160. Every day I have to calculate profit or loss. It has to be closing price minus the opening price into the number of contract, which can be plus or minus. The number of contract can be plus or minus, and the lot size. Closing 100, opening 80, number of contract 2, lot size 50. Profit is this because you purchased 2 contract, price went up. You purchased 2 contract and price went up. 100 minus 80, number of contract is minus 2. Minus 2 means you have sold it. You have sold it. Sold it, price went up, loss. Sold it, price went up, loss. The margin value will keep changing on daily basis. When it falls below the maintenance margin, banker will tell you to replenish it back to the original margin. Banker will tell you to replenish it back to the original margin. If it falls below the maintenance margin, replenish. How do I do the calculation? Day, price, profit or loss. Profit or loss. What is profit or loss? Closing price minus the opening price into the number of contract, positive, negative, into the lot size. Opening margin, margin post profit or loss, and any margin call and closing margin. Any margin call or closing margin. If your margin post profit or loss goes below the maintenance margin, replenish it back to 2 lakh. If you are above 2 lakh, you are allowed to withdraw that money. You are allowed to withdraw. Ultimately, I want to know the profit or loss of doing so many transactions. Add the profit or loss of every day, final profit. Add the profit or loss of every day, final profit, or selling price minus the buying price into the lot size into the number of contract. Here don't do any negative and all. Lot size into number of contract. What is selling price? Could be day one price or the last day price, depending on what did you do. If you buy originally, selling price is the last day. If you sell originally, selling price is day zero price. Day zero price, and the opposite is the purchase price. Opposite is the purchase price. So initial margin deposited at the start, value of one contract, specific percentage into what? Number of contracts, or daily absolute change plus 3 times of standard deviation, specific percentage of the initial margin. If you have excess amount, happily withdraw. If you are in between, broker will not disturb you. You need not disturb the broker. And if you go below, you will have to replenish it back. You will have to replenish it back. This is as far as futures is concerned. Now comes the options part of it. Futures, mandatory to press the buy and sell button on the last day. Options, you get a right but not an obligation. You get a right but not a obligation. Call option gives you a right to buy, not an obligation to buy. Keep participating. Put option gives you a right to sell, not an obligation to sell. I can be a holder, I can be a writer. Holder is called buyer, writer is called seller. Holder gets the right to buy or right to sell. Writer gives you the right to buy or right to sell. Holder pays premium, writer receives the premium. Call holder gets the right to buy. Call writer gives the right to buy. Gives the right to buy. Put holder gets the right to sell. Put writer gives the right to sell. Who can exercise? Only the holder can exercise the option. I am the holder, I can exercise. I am the writer, still holder can only exercise. Still holder can only exercise. So if you are solving a problem as a writer, please evaluate only holder analysis. Holder, if he exercises, positive gross profit, negative premium. Positive gross profit, negative premium. For the writer, positive premium, negative gross payoff. Negative, what is gross payoff? Difference between the exercise price and the current market price whenever you can exercise. Okay, don't think about a situation where it can't be exercised, then you can't write. Only when it can be exercised, the difference. Only when it can be exercised, it is the difference. American option can be exercised at any point of time. European option can be exercised only on the last day. What is exercise price? The price at which you can buy or sell. Now, in order to decide buy or sell, for call option, our question is, do you want to buy at exercise price when the actual market price is so much? Do you want to buy at 80 when the actual price is 100? Do you want to buy at 80 when the actual price is 100? Answer is yes. Do you want to buy at 80 when the actual price is 100? For put option, our question is, do you want to sell at exercise price when the actual price is so much? Here we have three types of option: in the money option, at the money option, out of the money option. In the money option, when I ask you a question, you say yes. Do you want to buy? You say yes, it is in the money option. Do you want to sell? You say yes, it is in the money option. You say no, out of the money. At the money means both are equal, kind of indifferent. Kind of indifferent. What action do I take? If prices are going up, prices are going up, call options are good. Call options are, in a bull market, call option is good. In a bear market, put option is good. So if prices are going up, buy the call option, you will exercise and earn money, or sell the put option. Buy the call option, because put will become zero. Put will become zero. Buy the call option, or sell the put today for 20, and on the last day it will become 0. On the last day it will become 0. So buy the call option or sell the put option, and if prices are going down, buy the put option or sell the call option. Intrinsic value means real value, GPO of the option. Intrinsic value is the GPO of the option, which can be 0 also. Which can be 0 also. Time value is premium minus the intrinsic value. Premium minus the intrinsic value. The time value can be will be positive. Intrinsic value can be 0 or some value. 0 or some value. Call option is used to restrict my maximum purchase price. I want to buy a Maruti car. I am worried Maruti car prices may go up. I buy a call option on Maruti car, where I get the flexibility to buy the car for 20 lakh rupees, even if the price is 25 lakh. Even if the price is 25 lakh. Put option will give me minimum selling price. Put option will give me minimum selling price. Call option will give me maximum purchase price. Put option will give me minimum selling price. And if I am a holder, don't look at the formula. Positive GPO, negative premium. You are the writer. Solve as if you are the holder. Solve as if you are the holder. How do we solve the question? We write actual price, exercise price. First we write actual price 100, exercise price 80, then exercise yes or no. It's a call option. Do you want to buy at 80? Do you want to buy at 80 when the price in the market is 100? Yes. GPO is the difference. 20. I don't want any sign. Then I write premium 10. And now you have to tell me, are you a holder or a writer? If you are holder, plus minus. If you are writer, minus plus and then calculate the profit or loss. You can do it for call option. You can do call, one put. You can do two call, two put. If two call, multiply with two and ultimately multiply with the lot size. Ultimately multiply with the lot size. Break even price means no profit, no loss. Call option gets exercised when you are on the higher side. So break even price is equal to exercise price plus call premium. Exercise price plus call premium, and put is getting exercise when its price is on the lower side. That is called exercise price minus. In case they want to do together and ask for a break even price plus combined premium plus combined premium of call and put, and combined premium of for the other side, subtract the combined premium. For here, add the combined premium. Combined premium means call and put together. Call and put together. Method of option valuation: PCPT, risk neutral model, binomial model, which is in between called replication approach, and Black-Scholes model. PCPT says share plus put is equal to what? Call. This will match on the last day. On the last day, this will match. Today, this is called present value of exercise price. Today, it is called present value of exercise price. Share can be replaced as share price minus PV of dividend, or share price divided by E power YT. YT means dividend adjustment. E power YT, or multiply with E power minus YT. E power minus YT. This is on put call parity theory. Second came our this one, risk neutral model. Today price is 100. It can become 120. It can become 80. First, calculate fair futures price for whatever is this time period. Could be third month, could be sixth month, could be ninth month, could be 12th month also. So FFP is equal to spot price into E power RT, or 1 plus R power N. 1 plus R power N. I got 110. I got 110. 120 into P, 80 into 1 minus P is equal to 110. Is equal to 110. Get the upside and downside probability for the two prices. Only two prices. I can't have more than two prices. After this, look at the problem. Is it a call option, put option, strike price? Calculating probability has nothing to do with call or put. Nothing to do with call or put. After that, price, intrinsic value, probability, product. The two prices are 120, 80. Now I will check whether it is a call option or a put option. Assuming it is a put option, strike price is 140. Strike price is 140. Do you want to sell at 140 when the price in the market is 120? This is worth 20. Do you want to sell at 140 when the price in the market is 80? Participate, guys. Do you want to sell at 140? This is worth 60. This is worth 60. Probability is 0.8, 0.2, 0.8 and 0.2. Do you want to sell at 140? I said, do you want to sell at 140? I'm taking put option. Do you want to sell at 140 when the price in the market is 120? Happily, I'll sell at 140. I multiply this 16, 12. This is called future value of put. Discount and get to today's value. Discount and get it to today's value. That is called present value of put option. That is called present value of put option. So under risk neutral model, we will have two judgment prices. Compute future share price using which formula? FFP formula. Take P as upside probability, 1 minus P as downside probability, future value, discounted to today and get the present value. Discounted to today and get the present value. Binomial model is the same story. Start with 80, make it 88, make it 72. It may further become some number. may become some number. This could be day 0, this could be year 1, this could be year 2. You'll have to find when is the first period ending. Once you find the first period ending, just focus on this and get the probability. Get the probability just focusing on the first period. Use the same upside and downside probability, and in the reverse order do the valuation. In the reverse order do the valuation. What is reverse order? For 9 to 6, the intrinsic value is 16. For it is 0, 0 some number, and do a weighted average, get one value here, get one value here, and weighted average, get a value. Whenever you come back, please do discounting of the numbers. Discounting of the numbers as you keep coming back. As you keep coming back. If it's an American option, I need to compare two things. I need to compare two things. The two things is immediate or later. Later is weighted average. Immediate is value as it is. Immediate is value as it is. Immediate is value as it is. Clear? Understood this? So I will have to compare binomial model, T prices, 2 into 2 into 2, 8 can happen. Draw a decision tree, upside, downside for the first period. Value, draw like this, value in the reverse order. Value in the reverse order. If it's a American option, then value is higher of the two number. What are the two number? Immediate exercise or the weighted average, which is the later exercise. Discounting has to be done every time. Discounting has to be done every time. Black-Scholes model basically said all option value is equal to two parts to the valuation. One is the share price, second part is exercise price. Share price minus exercise price is the value of the call in all the question. The intrinsic value is share price minus the exercise price. This has to be multiplied with n of T1, and this needs to be multiplied with n of T2. But here you will have to take present value. Here you have to take present value. Present value means today's value. First we calculate D1. D1 means current gap. Current gap between stock price and exercise price. Between stock price and exercise price. Future gap, half of variance divided by standard deviation. The current gap is called natural log S naught by EP. Natural log S naught divided by, if S naught is more, you will get a positive gap. S naught is less, you will get a negative gap. You will get a negative gap. Future gap is called R into T. Half of variance is 0.5 sigma square T, and this is sigma root T. For D2, instead of adding the half of variance, deduct the half of variance. Deduct the half of variance, and the shortcut is numerator D1 is D2 is equal to D1 minus the denominator of D1. Denominator of D1. Once you get the n of D1 and n of D2, you will have to get the probability from the Z table, which either is given to you, or you have to follow probability, or you have to follow the interpolation analysis, or you have to follow the interpolation. One rule you'll have to remember: if it's a positive Z value, value of probability will be more than 50, negative less than 50. Either it is this side or it is this side. This side is more than 50, this side is less than 50. That rule alone you please remember it. Then, in case there is a dividend given in the question, if there is a dividend in rupees, replace the spot price with adjusted spot price. Dividend in percentage, again replace the spot price with the adjusted spot. But for D1 calculation, I give you two options. Either you do adjusted S naught by EP or normal S naught by EP. Adjusted S naught by EP or normal S naught by EP. Adjusted S naught by EP or normal S naught by EP. If you are doing adjusted, great. If you are doing normal, do RS R minus Y, and it all depends on what natural log value is given in the question. What natural log value is given in the question. If they give the natural log value the way I want, very happy, I will use S naught by EP. If they don't give that, I will do adjusted S naught by EP. And if there are limited life assets like patent and other things, dividend yield is equal to what? 1 divided by life of the asset. 1 divided by life of the asset. Then, if they say exercise price prevails on the maturity date, this means on the last day, exercise price is equal to current market price. Exercise price is equal to current market price, and it will have an at the money zero value. At the money zero value. Next comes delta hedging. Theta is used for futures. Delta is used for option. The delta formula is change in option value by change in share price. Share price 100, 60. When it is 100, what is the option premium? When it is 100, what is the premium? Let's take this is 20. And when it is 60, it is 40. Imaginary numbers, okay? Then it is 20 minus 40 divided by 100 minus 60. This will happen in a put option. This will happen in a put option. When prices go down, premiums will go up. Premiums will go up. If it's call, maybe this will be 40 minus 20. 40 minus 20. Get the delta. Get the delta. Price 100. For 100, what is the option premium? For 60, what is the option premium? Or you can do N of D1 of Black-Scholes model. N of D1 of Black-Scholes model is called call delta, and N of D2 is called basically the likelihood of option getting exercised on the last day. Likelihood of option getting exercised on the last day. After I got this, I will do security, delta, weight, product. I can have share, I can have call or put. It can be call, it can be put. Share will always have a delta of 1. Call will have positive delta. Put will have negative delta. Call will have positive. Put will have negative. We'll have to calculate the delta. It is called, the delta was 0.8. Now to create a riskless hedge portfolio, I can do one share or one call or minus one share or minus one call. Assuming I do minus 1 here. I do minus 1 here. 0.8 into minus 1 is what? Minus 0.8. I want the total to be 0. This is 0.8. This is also 0.8. Buy 0.8 share. Buy 0.8 share and sell one call option. Buy 0.8 share and sell one call option. This 0.8 share minus one call, they will give two prices. They'll give two prices in the question. For these two prices on the last day, 0.8 minus 1 call will match. 0.8 minus 1 call will match on the last day. It can be 0.8 minus 1 call, or I don't want to do this. I want to do plus 1 here. You can do plus 1 also. This will become minus 0.8. This will become minus 0.8. Or I don't want to do this. I want to do this as 1. I want to do this as 1. 1 into 1 is 1. Minus 1, this is minus 1.25. Minus 1.25, whatever you create, okay? This will match on the last day. This is 600. 600 today value is 570. 600 today value is 570. Today the share price is 600, or today the share price is 1000. Minus 1 call is today's call price. Minus 1 call is today's call price. This is replication model of valuation. This is replication model of valuation. On the last day, the implied riskless hedge portfolio will have 0.8 share minus 1 call. Write 0.8 into whatever two prices. whatever is the call premium on the last day. On the last day, call premium depends on the GPO, depends on the GPO. On the last day, 0.8 minus 1 call will match for the two prices, not for others, not for others. If it matches for the last day, bring it to today, bring it to today. How do you bring it to today? Discount, take today's share price, call premium, balancing figure. Call premium is balancing figure. This is called replication approach. Replication approach of valuation. When I would have done first time, some clarity would have come. You would have tried on your own. There are few things you have to do 3-4 times. Now you would appreciate it little better, but as you do more and more times, things will become clearer. This is replication approach. Next, credit default swap. When I invest in a bond instrument, there are multiple problems I have. I have interest rate risk. I have price risk. I have something called as reinvestment risk. I have other problems. One of the problem is default risk. Default risk means on the last day, this guy is defaulting on the commitment. This guy is defaulting on the commitment. If you want protection against this, you have a tool called credit default swap. If the company defaults, the insurance company will give you a compensation. Insurance, you can be a protection buyer, you can be a protection seller. Protection seller would be an insurance company or a big financial institution, and I am a protection buyer. I am a protection buyer. I will keep paying premium. If premium is notional amount into the CDS spread, protection buyer pays premium, protection seller receives the premium. No default happened. Your premium, forget it. Default happened. Two things can happen: physical settlement, net settlement. Physical settlement means give the defaulted bond and get the face value, get the face value. And cash settlement means settle the difference, settle the loss which has happened, settle the loss which has happened. I purchased and premiums have gone up. Premiums gone up means there is a deterioration in the credit quality. There is a deterioration in the credit quality. And if premiums are going up, I continue to pay a lower premium. It is like a profit for me. I pay 2, you are paying 5. Extra 3% I save. That is my profit. Profit is equal to 3% into the notional amount into the number of years. And if the premiums goes down, I'll be unhappy because I continue to pay 2% and premiums are lower in the market. CDS spread, that is how is premium calculated, is probability of the default into 1 minus the recovery rate. For example, SBI bond probability of default is 0.1%. 0.1% chance, the premium will be very low. The premium will be very low for a SBI FD. The premium will be very high for Reliance companies, Anil Ambani companies. There it will be on the higher side. Then option Greeks, there are 5 terms. Delta measures the change in option price to the change in share price. Call have positive delta. Positive means price goes up, premiums go up. Put have negative delta. Put have negative delta. What will happen to the negative delta is price go up, premiums will go down. Gamma means change in delta of the delta. Change in delta of the delta. Theta means T means time period. Change based on the time period. Rho means change based on the risk-free rate. Call will have positive rho. Put negative rho means interest rates go up, call premium go up. Interest rates go up, put premium go down. And Vega means volatility change. Volatility change. I am not discussing exotic option and the CDO part because I'm not sure how many of you have seen that video till now. So this two parts alone, you see the proper video itself, because rushing through here will not make any sense. Other parts we have done. With this, our futures, options and allied areas are completed. If there are any doubts, you can let me know. Clear? Done? Okay, we move to the next chapter, which is on interest rate risk management. Very limited concepts are there, so we'll quickly understand everything. First is interest rate risk. Interest rate risk means what? Variation in the cash flow due to changes in interest rate. When interest rate go up, borrower is worried. Borrower is worried. Interest rate go up. I have taken a housing loan. Interest rate went up. I am worried. When interest rate go down, investor is worried. So I need some protection. There are four protection measures. One is options, forwards, futures, swaps. Options, forwards, futures, and swaps. In option, I have cap option. Cap option restrict maximum interest outflow. Maximum interest outflow, it is exercised if the actual interest rate is higher than the strike rate. Actual interest rate is higher than the strike rate. Then I have floor. This gives minimum inflow. Minimum inflow. If the actual interest is lower than the strike rate, this is exercised. This is exercised. A cap option is used by a borrower to restrict his maximum outflow. A floor option is used by an investor to get a minimum interest income. Caller is buy cap, sell floor. Buy cap and sell floor, or sell cap, buy floor. Sell cap and buy floor. If I buy a cap, my maximum outflow is restricted. When I sell a floor, there's another guy. There's another guy who has bought a floor, and the buying floor guy will have minimum income. Minimum income for me, that is called minimum expense. For me, that is called minimum expense. For me, that is called minimum expense. So cap maximum 7%, minimum 4%. Maximum 7%, minimum 4%. Maximum 7%, minimum 4%. Caller is taken because I can reduce my premium expense. I can reduce my premium expense. You don't want to reduce the premium expense, go for a cap option or a floor option depending on your requirement. And the wording may also be interest rate guarantee. Interest rate guarantee basically means a cap option if you are a borrower, floor option if you are an investor. Okay. Normal options are on price of share, and these are on interest rates which are on a benchmark. Benchmark can be MIBOR, can be LIBOR, can be base rate, can be MCLR rate, can be repo rate, can be reverse repo rate. We calculated net settlement. Net settlement is equal to notional amount, whatever is the principal, into the strike rate minus the interest rate, or interest rate minus the strike rate, depending on whether it is a cap option or a floor option. Basically difference in interest rate, multiply with time period by 12. If it's a 3-month option, 3 by 12, 6-month option, 6 by 12, yearly option, year by year, year by year. If they say I'm taking a quarterly settlement, 3 by 12, half yearly settlement, 6 by 12, 9 monthly settlement, 9 by 12, yearly settlement, year by 12. Okay. I have taken a caller option. I've taken a caller option. The question will have something called as reset date. Reset date. Then there will be a LIBOR on that date. LIBOR on that date. Whatever reset date is there, I have to calculate number of days. The number of days can be reset date minus the previous reset date. Previous means from today last 6 months, or from today next 6 months. Next 6 months. Reset minus the previous reset, or the new reset minus the old reset. New reset minus the old reset. That is today reset date, take the next reset minus this. LIBOR, then we'll have our borrowing rate, and interest is equal to principal into our borrowing rate into 182, 83, 84, 85, whatever, divided by 365, or 366 if it's a leap year. Wherever you are taking that February month, either the next one or the previous one will have 366 denominator. Next one or previous. After I have paid my interest, I can have a cap receipt. The cap will be exercised if the LIBOR, not my borrowing rate, if the LIBOR is more than the strike rate. LIBOR is more than the strike rate. I may also have a floor payment. This is applicable if the LIBOR is lower than the strike rate. LIBOR is lower than the strike rate. I may also have a premium which we amortize, which I'll discuss in 2 minutes, how premium is amortized. And finally, I pay interest, I pay floor payment, I pay premium, and I receive a cap receipt. I receive a cap receipt. I do not know the date itself, then number of days is not needed. I can go ahead and do 6 by 12, 3 by 12, 9 by 12, all that I can do. Understood this? The only point is the reset date can be applicable for the next 6 months or applicable for the prior 6 months. Applicable for the prior 6 months or the next 6 months. I pay a premium. Premium is equal to notional amount into lump sum premium percentage. Some percentage will be there, pay the premium. This is one time premium. If this one time premium is 2 lakh, and if you have 8 reset period, amortize this to the 8 reset period, whether data is given for 8 or not given for 8. Not given or given, you amortize this for how many reset period? 8. How do you amortize? Present value, annuity factor, fixed rate per reset period, number of reset period. What is fixed rate per reset period? Quarterly means fixed rate per quarter, number of quarters. Fixed rate per half year, number of half year. Once you amortize this, you can add that premium in the expense in that above table, earlier table, or they just want profit or loss calculation. GPO, premium, NPO. GPO, premium, NPO. Holder, positive GPO, negative premium. Writer, negative GPO, positive premium. Only one time premium paid, no amortization data, premium is okay. If there is amortization data, amortize and get the amortized premium. Get the amortized premium. Able to understand this part? With this, our options discussion is over. Then comes the interest rate futures. Interest rate futures means I press a buy button and a sell button. I press a buy button and a sell button. What will happen is there will be a spot rate, there will be a futures rate. Day 0, day 90. Day 0 and day 90. Day 0 and day 90. The spot rate is 10%. Futures rate, they don't say 10% and all. They say futures rate is 91. This means the interest rate is 100 minus 91, 9%. 100 minus 91, 9%. On the last day, this is 15%. And here it is 100 minus 15. I'm assuming it is same 15. This number will be 85. This number will be 85. I want to borrow now. I want to borrow money now. Please borrow at 15%. Borrow at 15%. Then I was thinking, why did I take the contract? If I'm going to borrow only at 15%, there will be a net settlement. There will be a net settlement. What is the net settlement concept is? If you are borrowing, you will press the sell button. You will press the sell button. How to remember in FRA? In FRA, B equal to borrower. Buy equal to borrower in FRA. In FRA, buy equal to borrower. Here it is opposite. Here it is opposite because there is an inverse relationship between interest and price. There's an inverse relationship between interest. So sell at 91. Buy at what rate? Am I making a profit here? Participate. Am I making a profit? Profit is how much? 6. So notional amount into 91 minus 85 percentage. 91 minus 85 percentage into one settlement factor will be there. If I'm borrowing for 6 months, I need settlement factor 6 by 12. May happen, may not happen also. May happen, may not happen. If it doesn't happen, something else to be done. But the logic is very simple. Pay 15%, earn 6%. Net outflow is originally planned 9%. Originally planned 9%. Sell, buy. Sell and buy, or it can be buy and sell depending on whether we are investor or borrower. Here, I have to take contracts. How do I take contract? Is denominator is contract size. Action is sell if you are a borrower, buy if you are an investor, sell if you are a borrower. The contract size will depend on how much amount. Amount is notional amount into the loan duration by future settlement duration. Loan duration by future settlement duration. Ideally, if I want loan for 6 months, I need the futures to have a 6 by 12 multiplier. I may get 6 by 12, may not get 6 by 12. If I am not getting, I will change the amount itself. I will change the amount itself. I will change the amount itself. This is what IRF is all about. Used to fix future interest rate. However, final rate may vary. Why it will vary? Because on the last day, this is not matching basis risk. This is not matching basis risk. I could not hedge it fully. Contract size problem. Decimals were there. Decimals were there. Loan duration, future settlement. If there is a difference, don't worry. Do this and get it. So once this is done, you do the hedging. Your actual outflow will only be at the actual borrowing rate. Actual borrowing rate. In futures, I will buy or sell at the actual spot rate. I will buy or sell at the actual spot rate, and the settlement is the difference. If there is no basis risk, original planned number, final number will match. Will match. Here on the last day, spot interest plus or minus net settlement. Spot interest plus or minus net settlement. If you are a borrower in FRA, buy. FRA, buy. If you are a borrower in FRA, buy. Here it is sell. Here it is sell. FRA, B, borrower, buy. B, borrower and buy. Futures has an inverse relationship. In fact, I'm not doing anything in interest rates. I am doing something called as buying a bond and selling a bond. Buying a bond and selling a bond. I bought the bond at 91. I bought the bond at 91, interest rate 9%. Interest rate went up, bond price went down. Interest rate went up, bond price went down. Yield and price has inverse relationship. Yield and price has inverse relationship. That logic is what is fitting in here. Yield and price has inverse relationship. Has inverse relationship. Cheapest to deliver bond. I did IRF and I said I don't want any set. I don't want to do any delivery. Net settlement. Other guys adamant saying that you have to deliver the bond. You have to deliver the bond. If I have to deliver the bond, I will buy the bond from the market. My outflow is quoted price of the bond. Give it to you. When I give it to you, you have to pay me future settlement price multiplied with the conversion factor. Multiplied with the conversion factor. The bond where I make maximum profit is the cheapest to deliver bond. The bond where I make the maximum profit is the cheapest to deliver bond. Cheapest to deliver bond. FRA. FRA is like interest rate futures, but here original planned rate, final rate, no difference. It has to match only. It has to match. FRA is a forward contract, but with a net settlement again. With the net settlement. But the net settlement, no basis risk and all. No basis risk. Originally planned to borrow at 8%. Reality rate is 9%. Borrow at 9 and get an inflow of 1%. Get a inflow of 1%. Day 0, I enter. Day 180, loan is starting. day 270 interest is to be paid. Day 270 interest is to be paid. If I am borrowing on day 180 till day 270, I want to borrow after 6 months for 3 months. This is called 6 by 9 FRA. This is called 6 by 9 FRA. 6 by 9 FRA. I want to borrow after 3 months for 5 months. This is called 3 by 8 FRA. 3 by 8 FRA. The interest is paid in day 270. You are paying extra 1% here. Extra settlement will come to you for 1%, but the settlement happens on day 180 itself. So you have to discount the number at the actual interest rate. At the actual interest rate. And my final effective outflow spot interest plus or minus net settlement. You can add the discounted, you can add the undiscounted and get the amount. ICI does either of them. But if they ask what is the settlement amount, it is always the discounted amount. Always the discounted amount. Sometimes they may ask us to calculate FRA 3 by 6, which is nothing but future value factor for 6 month equal to future value factor for 6 month. This side 1 plus 6 month rate into 6 by 12. 1 plus 6 month rate into 6 by 12. This side 1 plus 3 month rate into 3 by 12 into 1 plus FRA rate another 3 by 12. 1 plus the FRA rate another 3 by 12. Another 3 by 12. I want to do FRA 1 by 3 year. FRA 1 by 3 year. 1 plus 3 year rate power 3. 1 plus 3 year rate power 3. 1 plus 1 year rate power 1 into 1 plus FRA rate power 2. FRA rate power 2. I want to do 5 to 9. I want to do 5 to 9 year. Okay. 1 plus 9 year rate power 9. 9 year rate power 9. 1 plus 5 year rate power 5. 1 plus FRA power 4. I want to do 5 to 9 months. I want to do 5 to 9 months. 1 plus 9 month rate 9 by 12. 9 month rate 9 by 12. 1 plus 5 month rate 5 by 12. 5 month rate 5 by 12 into 1 plus FRA 4 by 12. No power and all. 4 by 12. This is FRA calculation. I calculated the fair FRA 8%. They give one actual FRA. They say 7 to 9. If the fair is between this range, arbitrage is not possible. If the fair is outside the 7 to 9 range, arbitrage will be possible. Trial and error. Just do trial and error. Borrow for shorter period, invest for longer period. Borrow for longer period, invest for shorter period. Invest for shorter. If they give you two rates, the second time when you FRA is for a future time period. Second time if you are planning to borrow again, 9% is the interest rate. And if you are planning to invest after some time, 7% is the interest rate. 7% is the interest rate. Buying an FRA means borrowing. Selling an FRA means investment. Selling an FRA means investment. Clear? Understood the concept on FRA? This is FRA rate computation. Don't go with the formula. Go with the future value factor logic. FRA and arbitrage is discussed. Borrower and investor action. If I am an FRA, borrower equal to buy. If I am an FRA, borrower equal to buy, investor equal to sell, opposite for the IRF. And in IRS, buyer buys the LIBOR and pays the fixed rate. Buys the LIBOR and pays the fixed rate. Pays the fixed rate. Buyer pays the fixed rate. Seller receives the fixed rate. Seller receives the fixed rate. Buyer pays the fixed rate, seller receives. So in an IRS, if I'm paying the fixed rate, if interest rates go up, I am very happy because interest rates go up. I pay 8, receive 10. Pay 8 and receive 10. So in IRS, I will have a profit if interest rates go up if I'm a buyer. If I'm a buyer. In FRA, I will have a profit if I am a buyer and interest rates go up. Buyer and interest rates go up. Here alone it is opposite because inverse relation. It is a inverse relationship. Understood till this? Okay. Then comes IRS. IRS. In IRS, we have to understand there are two types of loan. What are the two types of loan? Fixed loan, floating loan. Somebody may want fixed loan, somebody may want floating. Both the party want fixed, IRS not possible. Both the party want floating, IRS not possible. One guy wants fixed, one guy wants floating, maybe IRS possible, maybe IRS possible. A person who believes interest rates will harden means interest rates will go up, want a fixed rate, want a fixed rate. A person who believes interest rates will soften means interest rates will go down, wants a floating rate. There's a company A, 8% LIBOR plus 2%. Company B, 10% LIBOR plus 3%. Add the two. 8 plus L plus 3% is L plus 11%. 8 plus L plus 3 is L plus 11%. 10 plus L plus 2 is L plus 12. L plus 11 is better. L plus 11 is better. But they want to borrow, unfortunately, they want to borrow in this combination. They want to borrow in this combination. But I told them 8 plus L plus 3 is better. They are saying, no, no, I won't listen to you. I won't listen to you. I want the other. IRS is possible. IRS is possible. The difference in the total interest between the two is the gain due to the IRS. The difference here is one is L plus 11, another is L plus 12. 1% is the gain. 1% is the gain. It can be shared between company A and B, or an intermediary may also come into scene. Let us assume both are sharing, only both are sharing 0.5, 0.5. Then finally, effective borrowing rate is equal to original means the shaded one, 10 minus 0.5, L plus 2 minus 0.5. L plus 2 minus the shaded one. What they wanted minus 0.5. What they wanted minus 0.5. How is IRS structured? Borrow as the other rate. What is other rate? 8 L plus 3. You start with any one company, other company's balancing figure. So I am starting with A. He will receive the 8 from the other. He will receive the 8 from the other and he will give his. His is what? L plus 1.5. 0.5 benefit was there. 0.5 benefit was there. 0.5 benefit was there. Effectively cost is how much? L plus, very happy. I am getting an effective cost of L plus 1.5. This guy says, or sorry, 8 right here. Negative 8 plus 8. And this is L plus 1.5. If I put a total, LL will be cancelled. In the end, this will be 9.5 and I wanted 10. I wanted 10 and I am getting 9.5. I am also happy. You are also happy. I am also happy. You can start with any one company. You can start with any one company, whichever you want to start. Another example, 8 L plus 4, 14 L plus 8. L plus 8. Okay. What is the total of this? 16. What is the total of this? 18. Best is which one? 16. But adamancy, these guys are saying, I want this. I want 14 and L plus 4. I want 14 and L plus 4. I said, no problem. You please borrow at 8 and L plus 8. You borrow at what rate? 8 and L plus 8. What is the difference in the total interest? 8 plus L plus 8 is what? L plus 16. L plus 18. 2% difference is there. This 2% difference, intermediary takes away 1%. Intermediary takes away 1% and balance is 0.5 for me, 0.5 for you. Whatever I paid, intermediary gives it. Whatever I paid, intermediary gives it. Whatever I paid, intermediary. And my effective rate will be whatever you see shaded here, no? Whatever you see shaded in that 0.5 lesser. In that 0.5 lesser. 0.5 lesser means L plus, and this side 13.5. 13.5. From an intermediary point of view, from an intermediary, this is expense, this is income for the intermediary. For the intermediary, expense and income, and if you put a total of this, intermediary will earn 1%. Intermediary will earn 1%. This is normal problem. If there is a forex in the question, if there is a forex in the question, do the same thing. Do same thing like I have done. Identify the gain, identify who is sharing it, all that you do. But somebody has to bear the risk. Somebody has to bear the risk. If intermediary is bearing the risk, same like this. Just that this will be called US dollar, this will be called US dollar, this will be called yen. This may be called yen, this may be called yen, this may be called US dollar. This may be called US dollar, and in the end, I get an yen, I get an US dollar. If intermediary is not taking the risk, then whoever is not taking the risk, complete it. Other guy take the balancing figure. Other guy take the balancing figure. No intermediary there. Two parties only there. See who is taking the risk. Don't do his calculation. Who is not taking the risk, do the computation. Who is not taking the risk, do the computation. This is your currency swaps part and interest rate swap part. Clear? Any doubts in this? Okay. After the structuring is done, I want to do settlement calculation. I want to do settlement calculation. For settlement, see whether you are a buyer or seller, or understand, are you paying the fixed rate or receiving the fixed rate? Buyer pays the fixed rate, receives the floating rate. Seller pays the other rate. Seller pays the other rate. Buyer is paying the fixed rate. Paying the fixed rate. Now, fixed amount is notional amount into the fixed rate into 6 by 12, 3 by 12, 9 by 12, 12 by 12. The floating amount is little tricky. Notional amount into the floating rate, whatever is the rate, whatever is rate, into 181 by 360, 365, 182, 180, 179. The fixed guy will always be this, and it will always be 8% or 7%, 6%. For the fixed guy, the amount is fixed. Whether it is 6, 7, 8, that's all. Floating guy, the interest will also change and the number of days will also change. Number of days will also change. Number of days will also change. And the denominator can be 360 or 365. The denominator can be 360 or 365. The denominator can be 360 or 365. Able to understand till this? Okay. Sometimes I give you the net settlement. You have to reverse work the interest and get the interest rate. In this, you are doing a daily swap. If you're doing a daily swap, the floating guy has one advantage. The advantage is day, interest, opening balance, interest, closing balance. First day calculate on 10 crore. Second day interest will be calculated on 10.1 crore. What is 10.1 is adding the extra interest. Third day interest will be calculated on 10.2, 10.3, 10.4, 10.5, 10.6. It can keep increasing. He will have the benefit of interest on interest. He'll have the benefit of interest on interest. Saturday, Sunday comes together. Interest is not changing. Directly 2 days interest. Directly 2 days interest. Fixed guy, notional amount into the fixed rate into 7 days, 10 days, 15 days, 20 days. No concept of interest on interest. No concept of interest on interest. This, my IRRM discussion is also over. Any doubts on IRRM? Any area? Any doubts? I have no idea at all. So your doubt is on the reset period assumption. Practical world, it will be future 6 months. ICI, I can't be very confident. Okay, clear? No, they are very rarely tested. Clear? Done. Expectation theory holds good basically means that concept 16, it just means only one thing. I have 10% for 1 year. I have 3 year 11%. Using this 10% and 11%, I will use the FRA formula and calculate the interest rate from 1 to 3. Interest rate from 1 to 3 using which formula? FRA formula. How is you do? Future value factor for 3 years is equal to future value factor for 1 year into 2 to 3 years. That calculation will work only if the expectation theory is holding good. If I expect 10 and 11 to be the future interest rate, I can apply that formula and calculate the rate. This has nothing to do with problem solving. I'm going to anyway remove the concept, but the logic is very simple. When you are using this formula, when you are using the formula to calculate the FRA rate, this FRA rate will work only if that theory is holding good. Only if the theory is holding good. Somebody says the rates given in the market are not proper, so theory is not holding good. That time this formula can't be used. That time this formula can't be used to calculate the rate. Clear? Done? With this, IRRM is over. Okay, we now start with portfolio management. Chapters predominantly formula driven and with 3 formats. There was a format one which started with to understand the chapter. The format one had what? Return, probability, product, deviation, and PD square. This was a format one which we started. There was a format two when we have two securities, our security and market. Here the outer column was called what? Probability, and for security A, return, product, deviation, PD square. This is for first security. Second security, return, product, deviation, PD square, and the outer column was called probability into deviation 1, deviation 2, or deviation security, deviation market. Then there was a format 3 which had a very limited use for beta computation, where we had what? Return of security, which is called X, return of market, which is called Y, X, Y square. This has very limited usage, only for specific purpose. First, we understood how return is calculated. If I have only 1 year data, return is very simple. Return is equal to what? P1 minus P0 plus D1 divided by P0. If you have only 1 year data, or it can also be P1 minus P0 divided by P0 plus Dy. This is if you have 1 year data, this is the return. I did this for 5 years. I did this for 5 years. Take a simple average of the 5 years, that is the final return. Take a simple average of the 5 years, and that is the final return of the security. Okay, instead of 5 years, I do 5 scenario. Scenario means there will be a probability on top of it. Do return, probability, product. Sum of the product is the weighted average return. Return, probability, and product, and sum of the product is called the weighted average return, or return of the security, or expected return of the security. Okay, when I am trying, I have P1 can be 250, 280, 300. P0 is today's price, 200, 200, 200, and there are dividends also given separately. This they give 3 probability, 0.5, 0.4, 0.1. Dividend on top of this can be 10 rupees, 20 rupees, 30 rupees, and this has 0.3, 0.4, 0.3. So when I am calculating my return, I use this formula, P1 minus P0 plus D1. P1 can be 250, D1 can be 10 rupees. P1 can be 250, D1 can be 20 rupees. P1 can be 250, D1 can be 30 rupees. P1 can be 280, D1 can be 10 rupees, 20 rupees, 30 rupees, and P1 can be 300, 10, 20, 30. 3 into 3, 9 situation. Probability I can't write this numbers as it is, because then it will give more than 1. So we do a joint probability. What is joint probabilities? 250 and the 10 scenarios, 0.5 into 0.3, 0.5 into 0.3. 250 and 20 scenarios, 0.5 into 0.4. 250 and 30 scenarios, 0.5 into 0.3. Once return is calculated, that's all. There is nothing there in the chapter. Nothing there in the chapter. We are just doing time waste after that. We just use the return number and keep doing lot of other calculation. Return P1 minus P0 divided by P0 plus D1 in the numerator, R plus dy, R plus dy. Once this is calculated, if you have multiple data points, simple average or weighted average. Weighted average if you have probability, simple average if you do not have probability, or assume equal probability, or assume equal probability. Okay, I ended up calculating the return. If return is calculated, return is 10, 20, 30. There's a probability given in the question, 0.3, 0.4, 0.3. I multiply the two and call it as product. Product is 3, 8, 9. Put together the number is 20. I get a deviation column. Deviation is return minus the sum of the product. Minus 10, 0 and 10. And then we do P into D into D. Probability into deviation into deviation. Minus 10 square into 0.3 is 30, 0, 30, 60. Take a square root of 60, that is standard deviation. Take a square root of 60, that is standard deviation. Probability not there. Ignore. Take a simple average here. Take a simple average here. Deviation is return minus the simple average. Return minus the simple average, and only deviation square. No probability. No probability. And divide the entire part by number of observation. Divide the entire part by number of observation. This is on standard deviation. This is on standard deviation. So we are done with format 1, format 1, format 3, format 1, format 2, format 3 is to calculate. Return is possibility of earning money. Risk is possibility of losing money. Return is P1 minus P0 plus D1 by P0. P1 minus P0 by P0 plus dy, and risk is square root of PD square. Square root of PD square. And if you give me different probability for dividend and capital gain, do a joint probability. Do a joint probability. For standard deviation, square root of PD square. Now I have two securities. In two securities, I write a probability column here, and then I write security A, return, product, deviation, PD square. Security B, we write what? Return, product, deviation, PD square, and multiply probability into deviation 1, deviation 2. When I do this multiplication, I may multiply two positive number, I may multiply two negative number, I may multiply one positive, one negative, anything can happen. The total of this is called covariance 1, 2. The total of this is called covariance 1 and 2. Covariance 1 and 2. From the covariance, we calculate correlation. For calculating correlation, take a standard deviation, take a this is variance. This is variance. Take a standard deviation of A, standard deviation of B, or standard deviation of 1 and 2. Correlation AB is equal to covariance AB divided by sigma 1, sigma 2. Sigma 1 and sigma 2. One time what I did is, I copied this again here. Same thing I copied. I copied the same number and called it as probability into deviation 1 into deviation 1. Deviation 1 into deviation 1. The total is called covariance between 1 and 1, which is nothing but variance. Covariance between 1 and 1 is nothing but variance. Covariance between 1 and 1 is nothing but variance. Covariance also has another formula, which is called beta of A into beta of B into variance of market. Beta of A into beta of B into variance of market. Where did this formula come? You already know what is beta. Beta has a formula called covariance AM. A with market divided by variance of market. Beta B is covariance PM variance of market multiplied with variance market is cancelled. Variance market is cancelled. M M M is basically the deviation M together is called variance. M is cancelled, variance is cancelled, left over covariance AB. Leftover is covariance AB. When I did originally, I could not explain that time. I said I'll explain later. Now, as we are doing the concept, we are going through everything. Covariance AB. This is on the covariance part. Covariance AB is equal to probability into deviation A into deviation B. Format 2 will help you. Format 2. Covariance of A and A is called variance. Covariance of A and B can also be called as beta of A, beta of B into variance of market. Correlation is calculated with covariance, and covariance, when it gives you correlation, has to be between -1 to +1. -1 to +1. We learn portfolio return. Portfolio return, you can do security, return, weight, product. Security, return, weight and product. A, B, 25%, 15%, 10 lakh, 20 lakh. I've invested 10 lakh and 20 lakh. 10 into 25%, 2.5, 20 into 15%, 3, together 5.5, total 30. Return is 18.33%. The return is 18.33%. Sum of product by sum of weights. You know the weights 0.5, do into 0.5 into 0.5 and put a total. This is called portfolio return. Portfolio return is weighted average of the individual return. Only one rule. The weight has to be what you invested. Weight has to be what you invested. If you are doing second year portfolio return, weight will be the closing first year value. Weight will be the closing first year value. If you are doing the third year return, weight will be the closing second year value. Closing second year value. Portfolio risk is equal to A square B square 2AB. A square B square 2AB. A plus B the whole square formula. A is called what? Sigma A WA square, sigma B WB square, 2 sigma A, participate, WA sigma B WB, correlation AB, or same story, sigma A WA square, sigma B WB square, 2 WA WB covariance AB. Covariance can replace the SDA, SDB, SDA, SDB and correlation AB. Which one do I follow? Whatever data is available. 3 security, A plus B plus C the whole square, A square plus B square plus C square plus 2AB plus 2BC plus 2AC. This is for portfolio variance. For portfolio variance, weighted average of the individual securities return. Portfolio risk is not weighted average. In portfolio risk also, one situation, if you have +1 correlation, you can directly do sigma A WA, sigma B WB, or do the lengthy formula, you'll get the same answer. And if you have -1, it mathematically be sigma A WA, sigma B WB, or you do the lengthy formula, +1 -1 has a shortcut, +1 and -1 has a shortcut, or you do the lengthy formula, you'll get the same answer. Sigma A WA, sigma B WB, adding the two, subtracting the notion of dominance. Notion of dominance means I have A return risk 10%, 15%, 11%, 14%. Which has higher return? Which has higher return? B. Which has lower risk? B. B is dominating A. B is dominating A. Return also better, risk also better. Okay. 11, 15. Which has higher return? B. Which has lower risk? Same. So risk is of no use. Risk is of no use. Again, B is dominating. Again, B is dominating. Higher return with lower risk. Higher return with same risk. R. 10, 14. Which has higher return? Same. Which has lower risk? B. B is again dominating. Higher return, same risk. Higher return, lower risk. Same return, lower risk. Same return and lower risk. This is called notion of dominance. You are dominating the other security. You are dominating the other security. All the inefficient securities will be thrown out. Only the efficient securities will form part of the portfolio. Will form part of the portfolio. Compensation for risk. I am taking risk. Risk is measured through standard deviation beta. Risk is measured through standard deviation and beta. Standard deviation is for undiversified. Beta is for, so compensation for risk is measured through Sharpe train or. Sharpe will measure actual return minus the risk-free return divided by standard deviation. Sharpe improving means by taking risk, I am benefiting. By taking risk, I am benefiting. Train or improving means by taking risk, I am benefiting. I am benefiting. Train or means actual return minus the risk-free return divided by beta. Divided by beta. And here it is divided by a naught divided by beta, and here it is divided by standard deviation. Risk, as I said, can be measured in two ways. One is system risk. System risk means India as a whole, certain risks are there which nobody can do anything. System risk is called systematic risk or non-diversifiable. Non-diversifiable means by diversification you cannot eliminate it. By diversification you cannot eliminate it. Beta is a measure of systematic risk. Standard deviation says India has so many problems and my company has extra problems. All problems put together is standard deviation. All problems put together is the standard system problem as well as the non-system problem, as well as the non-system problem. Consider both. Consider both. How do I calculate beta? With probability, without probability. The questions can be of two types. Without probability, there is a very short approach. Format 3. Format 3 is return of security, return of market, xy, y square. The formula is sigma xy n x bar y bar sigma yy n y bar y bar n y bar y bar. This is technically called as your regression equation. With this I can kind of do the solving part if without probability, and only beta is asked, nothing else. No standard deviation, nothing else, only beta. Use this. With beta they want systematic risk, unsystematic risk, something else. Ignore this formula. Ignore this formula. Then you have two other formula. One is correlation or covariance. One is correlation or covariance. Correlation is what? Sigma S, sigma M, correlation SM. Correlation SM. The correlation is calculated as covariance divided by sigma S, sigma M. Sigma S is cancelled. Covariance by variance. Covariance divided by variance. Covariance divided by variance. And there is one more thing, shortcut formula, which basically beta 1 market 10% change. Market is 10% change. This is the rarest formula. Last option. Security 20% change means beta is 2 times. Security 20% change means beta is 2 times. This is what we used in derivatives for finding out the price change. For finding the price change. So beta probability information not given, format 3. Given, format 2. Crude formula, percentage change in security by percentage change in market. I computed the beta. I want to give observation. Two types of observation ICI gives. One, calculate CAPM return of every year, calculate actual return of every year, and do the comparison of buy and sell. Do the comparison of buy and sell by comparing what? CAPM return every year, actual return every year. The other option ICI does is, if beta is 1.8, I'll say the security carries more risk than the market. Security carries more risk than the market. Beta is 0.7. Security carries low risk than the market. Beta is 0.1. Security is almost risk free. Almost risk free. This is another kind of observation which institute gives. Risk free rate. Risk free rate is basically the return for which security? Government of India bonds. Now question gives you two risk-free returns. Two risk-free return, aggressive approach, highest risk-free return is the final risk-free return. Conservative approach, lowest risk-free return is the final. Moderate, take a average. Return, they have not given the return, use the formula current yield. Current yield is interest divided by current market price, and interest is face value into interest rate. Face value into interest rate. This also not there. One security with zero beta is sitting somewhere in the question. One security with zero beta is sitting, or 0.01 beta. That is the RF. That is the RF, hidden RF. If any security has a zero beta, if any security has a zero beta. Risk premium of the market is the difference between RM and RF. Ideally should be positive. Unfortunately negative. Go ahead with whatever number you have. When will it be negative? If the risk free rate is more than the market rate. If the risk free rate is more than the market rate. Portfolio beta. Portfolio beta is weighted average. Security beta weight product. The preference for weights is market price weights. Market price weights is the first preference. Book value weights is the second preference. For calculating return, cost is the first preference. For calculating return, cost is the first preference. For calculating portfolio beta, market value or the MPS is the first preference. This can change if you add a security, remove a security. How will you calculate? Sum of product by sum of weights. You can also alter this by bringing in risk-free asset or taking out risk-free asset. You can also alter this by adding Nifty futures, removing Nifty futures, which is what we were doing in that other chapter, adding Nifty futures and removing Nifty. I want to replace a security which has a beta of 1 time. You can replace that with Nifty. You can replace that with Nifty. Question gives you a target beta. Weights can be balancing figure. For example, security 1, 2 overall 1.5, 2.5. I want 2. This is X, 1 minus X put together 1, 1.5X, 2.5 into 1 minus X. Total is equal to 2 into 1 total, and solve the weights. Solve the weights using the weighted average format. 2 securities there, balancing figure will come. 3 securities there, then they'll give data for 1, other 2 will be balancing figure. Clear? Able to understand this? Okay. Concept of fair return and fair beta. In order to buy or sell a security, I have 3 comparison. One is actual price greater than fair price, overvalued, sell it. Actual price is greater than fair price, overvalued, sell it. Actual return lower than fair return. Actual return lower than fair return, bad company, sell it. Bad company, sell it. Or actual beta greater than fair beta. Actual beta greater than fair beta, again a bad company. Higher beta, bad. Higher price, bad. Lower return, bad. All actual with fair. Other way around, it is good, buy. If you are selling, it is called overvalued, and if you are buying, it is called undervalued. Now, in this part, I have a formula called CAPM return is equal to RF plus beta into RM minus RF. For one security, RF is 8. Beta I calculated using formula 1, formula 2 or formula 3. Correlation, covariance or regression, I calculated the beta. Used the beta as 1.5 and did 12 minus 8. Did 12 minus 8 and got a number as 14. This is called fair return, required return, equilibrium return. Fair return, required return, equilibrium return. Which beta I have used here? Actual beta. Where did I get the actual beta? Through the format 2 or format 3, formula 1, formula 2 or formula 3. The same formula told me the actual return is 25. The actual return is 25. 25 is equal to 8 plus question mark into 12 minus 8. This question mark is called fair beta. This question mark is called fair beta. This question mark is called fair beta. Here I think the fair beta will turn out to be 4.25. This, if you are generating 25% return, you deserve to have a beta of 4.25. You deserve to have a beta of 4.25. I have a beta of only 1.5. Very good company. I can afford to have a beta of 4.25, but the actual beta is very less. Good company, buy it. Actual return is very high. Good company, buy it. Actual return is on the higher side and risk is on the lower side. We calculate the fair return with actual beta. We calculate the fair return with actual beta, and we calculate the fair beta with actual return. Fair beta with actual return. Actual return, where will it be there? Actual return will be there either in your format 1 or format 2, return probability product. How did that return calculated? P1 minus P0 plus D1 by P0. If the return is 25, beta can be 4 times. If the beta is 1.5, return should be only 15% or 14%. If you are generating more returns or carrying lower risk, you are an excellent company. You are an excellent company if you are carrying lower risk than what is needed or generating a higher return than what is needed. This fair beta concept I can apply for a portfolio also. I can apply for a portfolio. With the actual portfolio return, calculate the fair beta. With the actual portfolio return, calculate the fair beta. How will you get fair beta? Actual return is equal to RF plus fair beta into RM minus RF. Compare the fair beta with actual beta. You could be carrying optimum. Optimum risk means perfect. High risk means unnecessarily I'm carrying more beta than what is needed. Either, see, if somebody tells me invest in stock market and earn only 5%, why will I invest? Taking risk, return is also not coming. So if the actual beta is higher than fair beta, it is a high risk situation. Other one is a low risk situation. And this leads us to this situation. I purchase if the actual return is higher, actual beta is lower, actual price is lower. Actual price is lower. Price comparison is done in security valuation topic. Return and beta comparison is done in this chapter. Clear? Understood till this? Any doubts here? Beta, there are two types of markets. One is called bull market. Second is called bear market. In a bull market, returns will go up. In a bear market, returns will go down. When returns are going up or when you're generating positive return, higher beta, higher risk, higher positive return. Higher beta, higher risk, higher positive return. When bear market is there, lower beta, lower risk, lower negative return. Lower return is negative only. Lower negative, higher positive. Higher positive. Systematic risk and unsystematic risk. Now, the risk which we measure, let's call it as variance. This is 100. This will be broken down into two parts. Systematic risk, unsystematic risk, otherwise called as specific standard deviation, otherwise called as random error, otherwise called as residual risk. There are multiple names. This is balancing figure. Systematic risk, your formula for beta calculation, we had a correlation based formula. What is the formula? Beta is equal to what? Sigma S by sigma M into correlation SM. This square, or you take this side, sigma M into beta square. Sigma M into beta square or sigma S into correlation of security with market square. Correlation of security with market square. Sometimes this correlation of security with market institute uses a term called coefficient of determination. Coefficient of determination. And if they don't mention anything, Coefficient of determination is correlation square. Correlation square, R square. If they use the word R, it means correlation. If they use the word R square, R square. So I can say sigma S into sigma S into CD. Sigma S into sigma S into CD. CD I need not square because CD is already squared. CD is already squared. If CD is not squared, then they'll use that word R. If it is squared, they will use the word R square. Silent, it is R square. Silent, it is R square. I did this, I got 80. Balancing figure is unsystematic risk. Balancing figure is unsystematic risk. Balancing figure is unsystematic risk. Okay, I had three securities: A, B, C portfolio. 100, 200, 300. Total risk. Systematic risk is 80, 160, 240. Some random numbers, okay? Unsystematic is balancing figure. Balancing figure is what? 20, 40, 60. Now I want to calculate portfolio risk. I want to calculate portfolio risk. Portfolio risk is equal to systematic risk of portfolio plus unsystematic risk of portfolio. Systematic risk of portfolio plus unsystematic risk of portfolio. Systematic risk has one formula: sigma m into beta square, sigma s into correlation sm square, sigma s into sigma s into CD. The word S will become P. P means portfolio. P means portfolio. Sigma portfolio, I don't know the sigma portfolio. That only I am calculating. I don't know the sigma portfolio. Sigma means standard deviation of the portfolio. So generally for portfolio systematic risk, we use this formula. Sigma M into beta of portfolio. Sigma M into beta of portfolio and square it. Random number. This is 200. Sigma m into what? Beta of portfolio square. Sigma m into beta of portfolio square. Unsystematic risk is weighted average. What is weighted average? Is 20 into the weight square. Weight square. Why square for the weight? Because 20 is already squared. Because variance approach. 20 is already squared. 40 into 0.3 square. 60 into 0.5 square, you get this number 100, random number, and put together 300 is the portfolio standard variance. Portfolio variance, standard deviation you can get later. This approach, or you do Markowitz. What is Markowitz? Is A plus B plus C the whole square. Both should ideally give same answer if ICI drafts the question properly. Both will give same answer if the drafting is taken care. Drafting is wrong, it can give different answer. For systematic risk related to the market, unsystematic risk, other names are there. Yeah, unsystematic risk, other name: specific standard deviation, residual risk, random error. Ignore the SD approach. Ignore the SD approach. Variance of security, beta of security into SD of market square, SD of security into correlation SM square, or SD of security into SD of security into coefficient of determination. Into coefficient of determination. Balancing figure, unsystematic risk. Once I do this, Markowitz approach. 10 securities are there. Markowitz can't be done. 10 securities, I can't do Markowitz because A plus B plus C plus D plus E. How will I do so many covariances correlation? So if you have more than 3 security, Markowitz is impossible in exam. So what do I do then? Then the formula is systematic risk of the portfolio plus unsystematic risk of the portfolio. What is systematic risk of the portfolio? Beta of the portfolio into sigma m whole square. Beta of the portfolio into sigma m whole square. And unsystematic risk is weighted average of the individual unsystematic risk with the W square being the assigned weight. With the W square being the assigned weight. Again, ignore the SD approach. R square. R square is the variance approach. Clear? Okay. Sometimes what I will do is, I have 100 rupee, but I want to invest with margin of 80%. Margin of 80% means borrow another 80. 100 your money, borrow 80 from the market. 100 your money and borrow how much? 80 from the market. Return is equal to portfolio return into 1.8 times. I will earn 1.8 times return. With 100 rupee, I'm investing how much? 180. But I have to pay interest on the 80%. Interest on the 80%. Return is what? 1.8 times of the normal return. 1.8 times of the normal return, but pay interest as zero point 0.8 into interest. 0.8 into the interest rate. Risk is portfolio risk into 1.8, no reduction. Because when I borrow money, if the company does not do well, I only have to suffer. I can't be taking any benefit. The other guy who borrowed money, who lent money, does not take any risk. He does not take any risk. I only have to take the risk. I only have to take the risk. So return is equal to normal return into 1.8, 1.6, 1.4 minus the interest rate into balance 0.4, 0.6, 0.8. Risk is directly 1.8 times or 1.6 times or 1.4 times. Okay. A question says security does not carry unsystematic risk. Our security is fully diversified. Portfolio is fully diversified. In this situation, systematic risk is equal to standard deviation. Systematic risk is equal to standard deviation, or systematic risk is equal to variance. No unsystematic risk. No unsystematic risk. Where does this help? Systematic risk has a formula called sigma m into beta of the security. Standard deviation is sigma of the security. Standard deviation is sigma of the security. This sometimes will help me. I will have this. Beta will become balancing. Beta will become balancing figure. Beta will become balancing. Does not carry unsystematic risk. Our portfolio is fully diversified. Portfolio is fully diversified means there is no unsystematic risk. There is no unsystematic risk. Okay. This leads us to, I have a security, risk free 8, RM 12. The gap between the two is called risk premium of market. The gap between the two is called risk premium of market. I have a beta of 1.5. I have a beta of 1.5. CAPM is 14. CAPM will be 14. The gap between these two is extra return due to extra risk. Extra return due to extra. I can earn 8. By taking normal stock market risk, I can go to 12. By taking more risk, I can go to 14. My manager gave 20. Balance 6 is called sheer skill of the portfolio manager. Sheer skill of the portfolio manager. That is his talent. He gave extra 6. He gave extra 6. That is called sheer skill of the portfolio manager. Investment with margin. Investment is equal to 160%. Borrowing is equal to 60%. I told you to correct here. Return is 160%. Interest is 60%. And risk will become 160%. Fully diversified portfolio, no unsystematic risk. No unsystematic risk. Components, market risk component, extra risk component, sheer skill of the portfolio manager component. Sheer skill of the portfolio manager component. Then there are 3 ways of putting a price equation: CML, SML, characteristic line. Characteristic line says alpha plus beta into RM. Alpha plus beta into RM. Characteristic line is only for one company. For example, TCS characteristic line is 6 plus 1.2 into RM. 6 is its alpha, 1.2 is the beta. 6 is the alpha, 1.2 is the beta. RM can keep changing. RM can keep changing, and accordingly you calculate the return. Accordingly you calculate the return. How alpha is calculated in some time as we proceed. Okay, 6 plus 1.2 into RM. When you do SML, which is our normal approach, RF plus beta into RM minus RF. This is common for everyone. 4 plus 10 minus 4. You can keep changing the beta. TCS, Infosys, any company you can do. CML says RF plus what? It focuses on standard deviation of security by standard deviation of market into RM minus RF. If you are using standard deviation, undiversified companies, and if you are using beta, diversified companies. Beta is for diversified and standard deviation is for undiversified portfolio or company. Characteristic line stock specific alpha plus beta into RM. CAPM, CAPM basically is RF plus beta into RM minus RF, and this is RF plus SD of security by SD of market into RM minus RF into RM minus RF. Coming to the alpha part is the extra return which is being generated. Extra return which is being generated. For calculating alpha, we compare actual return with the required return. Actual return, whatever any formula gives. Required return, three ways are there. One is characteristic line based, which is just beta into RM. Just beta into RM, the difference is alpha. Just beta into RM. For example, have a security beta 2, RM 8, actual return 18. Required return is equal to 2 into 8, 16. 18 minus 16 is alpha. 18 minus 16 is alpha. Another way of doing required return is RF plus beta into RM minus RF. RF plus beta into RM minus RF. This is 12. 18 minus 12 is the alpha. 18 minus 12 is the alpha. One is just beta into RM. Second is RF plus beta into RM minus RF. And the third way is RF standard deviation of security, standard deviation of market into RM minus RF. This can be a different number. This can be a different number. Generally, required return is calculated for alpha in this chapter as beta into RM. Beta into RM. And many places when risk-free rate is not there, don't have information, required return is just what? Beta into RM. Just beta into RM. No need to do RF plus beta into RM minus RF. If you have return for two securities, you can form two SML equation. What is two SML equation? Is security 1 equal to 18, 6 plus 2 into RP. RP is RM minus RF. 6 plus 2 into RP. Second security 24 is equal to 6 plus 3 into RP. 3 into RP. If you solve, you will get the RP. Sorry, not 6 also. RF. Sorry, this is RF. RF plus 2 into RP, RF plus 3 into RP, RF plus 2 into RP, RF plus 3 into RP. This will give you RP, then you will get RF, then you will ultimately get RM. Then you will ultimately get RM if you have data for 2. If you have data for 2 securities, you can form 2 CAPM equation. You can form 2 CAPM equation. What is CAPM equation? 18 is equal to RF plus 2 into RP. 24 is equal to RF plus 3 into RP. RP or you can call RM minus RF also. RM minus RF solving will take more time. Okay. Next, APT approach. APT basically said that CAPM is very simple. It just uses beta. He says, no, we will do RF plus beta 1 into RP1. RP1 is risk premium of factor 1. Beta 2 into RP2. Beta 3 into RP3 or RF plus surprise element of factor 1 into RP1. Surprise element of factor 2 into RP2. The surprise element is little tricky. Look at the data. If actuals are more than expected majority, do actual minus expected or do expected minus actual. ICI hasn't done consistently this properly. Okay. Actual minus expected or expected minus actual if there is a surprise element. Here, a question may also ask you security weight, factor 1 beta, product, factor 2 beta, product. Sum of product by sum of weight is the overall factor 1 beta. Sum of product by sum of weight is the overall factor 2 beta. You can do beta computation. Beta means sensitivity. Beta basically means sensitivity. It is not the meaning of the beta which we generally see. The factor 1 can be beta. Sensitivity of beta is beta of beta. It's technically like that. Factor 1 beta and factor 2 beta. RF plus factor 1 into risk premium, into risk premium, or expected minus actual, or actual minus expected. There is no major consistency there. Okay. Beta and leverages. This we have used it in portfolio, but majority used it at other places. To calculate the beta, there are two types of beta. One is called asset beta. Second is called equity beta. Asset beta is asset beta weight product. Business 1, business 2, overall. Business 1, business 2 and overall. This is called my asset beta equal to my proxy company's asset beta equal to my proxy company's liability beta. Asset beta or liability beta meaning is same. Asset beta or liability beta, the meaning is same. My asset beta, my proxy company's asset beta, or my liability beta, or my liability beta. Clear? With this, I will then say liability beta weight product. In the liability, we'll have debt, equity. Debt beta will be generally 0. Weight will be debt into 1 minus tax rate. Debt into 1 minus tax rate. Copy the same beta here and get equity beta balancing figure. Equity beta will give you cost of equity. Equity beta will give you cost of equity. Separately do cost of debt and do WACC. Do WACC. Asset beta is called unlevered beta. Equity beta is called levered beta, stock beta, plain beta. Plain beta means without any word. Plain beta. Equity beta, this I told you to delete again. Equity beta will give you the cost of equity. With the equity beta, get KE, separately get KD, and then do WACC. Then do WACC. Portfolio strategies, there are three strategies I can follow. First, buy and forget. Buy and forget, nothing to be done here. Buy once and sell it in the end. Second part is I have day 0. I have debt, equity overall. Debt is 80, equity is 120, 200. Month 1, every month I will do rebalancing. In month 1, equity may touch 130. Debt may remain 80. Total is 210. Total is 210. Split this total as 46. Split the total as 40, 60. In this question, 40, 60. So this will become 84. This will become 126, 210. Next time, 84 continues 84. This becomes 226. This becomes 226. Total is 300. Make it again in the same, sorry, 310. 310, make it in the same proportion. 40, 60. Make it in the same proportion. 40, 60. That is called constant mix. The mix will be given in the question. 40, 60, 50, 50, 60, 40, 30, 70. Debt value will remain as it is. Equity value will keep changing as Nifty goes up or Nifty goes down. Another approach is called CPPI. Constant proportion portfolio insurance policy. CPPI, constant proportion portfolio insurance policy. Here we calculate floor value. The floor value is either given in the question or investment minus the maximum loss in Nifty. Maximum loss in Nifty or stock market. Maximum loss in Nifty or stock market. I am going to invest 5 lakh. Maximum is 20%. Floor value is 4 lakh. Now the approach says debt is balancing figure. Equity is equal to multiplier. Equity is equal to multiplier into portfolio value minus the floor value. Portfolio value minus the floor value. Multiplier could be 2, 3, 4. Portfolio value is 5. Floor value is 4. 2 lakh will be invested in stock market. 2 lakh will be invested in stock market. 3 lakh will go to bond. After 1 month, the debt and equity put together is 5.5. Put together is 5.5. Same 5.5 minus 4 into 2. How is this 5.5? Originally it was 2 plus 3. Now it is 2.5 plus 3. Now it is 2.5 plus 3. But now equity can be 3. Equity can now be 3. Multiplier into 5.5 minus 4. So instead of doing this, I'll change it as 3 plus 2.5. I'll make equity as 3, bond as 2.5. Next time it became 2 into 4.7 minus 4. 4.7 minus 4. How did it touch 4.7? This 2.5 remains as it is, and this is 2.2. This is 2.2. This is 2.2. 2.2 and 2.5. It touched down. Whatever is the investment in equity balancing figure, take it. Investment in equity is always a balancing. Okay. Last main part, which is very frequently tested, minimum risk portfolio. 3 situations are there. 2 securities, 3 securities, more than 3 security. 2 securities, weight of first security, weight of second security. First security weight is dependent on the variance of the second security. Variance of the second. So variance of B, variance of A, subtract the covariance, and add the numerator together. Add the numerator together. What is numerator together? Variance A plus variance B, 2 covariance AB. Somebody says, sir, I will not write in the denominator. Then just get the value. This is 20. This is 30. Weights is in the proportion of 20, 30. What will be denominator? 20 plus 30, 50. Denominator will be 20 plus 30, 50. The denominator technically is going to be 20 plus 30, 50. So I don't know the denominator. No problem. Weight is in the proportion of 20, 30, 0.4, 0.6. 0.4 and 0.6. Second is 3 security. For 3 security, they'll give weight of A, weight of B, weight of C. 0.4, 0.3, 0.3, 0.5, 0.4, 0.1. Something like this is given in the question. I need to create a third portfolio. In the third portfolio, the weight is going to be 0.6. I don't know this. I don't know this. Here we form a equation. We form a equation between the weights. We form a equation between the weights. Weight of first security. Let me call the first security is equal to A plus B into weight of second. That word is used as A plus B. So I want to change the names. Okay. A plus B into weight of second security. That is first security is 0.4. A plus B into 0.3. When it is 0.4, this is 0.3. When it is 0.4, this is 0.3. When it is 0.5, this is 0.2. Ultimately, you'll get some number to A and B. I am not solving it, but let us assume you get it as weight of 1 is equal to -2 plus 1 into weight of 2. Just random number, okay? You solved and you got -2 and 1. You got -2 and 1. Substitute 0.6, W2 will be balancing figure. Substitute 0.6, W2 will be balancing figure. W2 will be balancing figure. Again, I'm repeating here. I've not done the solving part. I've just, because I don't want to waste time on solving the equation. Form the equation, get A and B. Get A and B. Third equation, you know, weight of first security, weight of second balancing figure. Third obviously becomes the balancing. More than 2 securities. Calculate Traynor ratio. Calculate Traynor ratio and arrange the securities in the order of Traynor ratio. After you arrange it, you will have security Traynor ratio. Security Traynor ratio. This will be the order of the Traynor ratio. This will be in the order of the Traynor ratio. Security Traynor ratio. Security Traynor ratio. Traynor ratio considers only the beta part. Only the beta part. But some securities may have high unsystematic risk. So bring in unsystematic risk. Bring in systematic risk. What is the formula for systematic risk? Beta into SD of market square. Beta into SD of market square. Do SR by USR, multiply the trainor with this and divide by the same thing. Multiply also same thing, divide also same thing. Multiply with what? Trainor ratio into SR by USR, get cumulative value. Then denominator is SR by USR, get the cumulative value, but just add 1 in the denominator once. Add 1 in the denominator once. If we don't add 1, the highest trainor will become the cutoff point. The highest trainor will become the cutoff point. Other securities will not form part of portfolio. So for that purpose, we have to do the adjustment of adding 1 in the denominator. Whichever security has a trainor greater than the cutoff point are welcome to the final portfolio. Others are rejected. We compute Z value. Z value is equal to excess cutoff. Excess cutoff means trainor minus the cutoff. Trainor minus the cutoff. Beta by USR. This I don't have full logic and all. Beta by USR. Get the Z value, and in the order of Z value, the final weights are decided. In the order of Z value, the final weights are decided. Final weights are decided. Clear? Please do see this day before exam, otherwise you'll forget the steps. Last part, real estate valuation. Value based on the debit side, which is cost part of it. Credit side based on the sale value. Debit minus credit, PAT into P multiple, are based on cash flow. Cash flow means year cash flow, PVF and DCF. Year cash flow, PVF and DCF. With this, our portfolio discussion is over. Predominantly formula driven chapter, but lot of things are interlinked here. Any doubts on this? Clear? Okay, we'll quickly close three chapters first, which are very small. One is risk management, and the second part is your security analysis part and the IFM part. These three, let us quickly close it first. Coming to risk management focuses on only one thing: computation of value at risk. Value at risk means how much loss can I suffer if the worst happens. If the worst happens. Now listen, VAR is a time-based statistic. Time-based means, do you want the maximum loss for 10 days, 15 days, 5 days, 20 days? I want VAR 20. I want to calculate the loss for 20 days. This is equal to amount invested into daily standard deviation. Daily standard deviation is the daily possible loss. Multiply this always with square root of number of days. Multiply with square root of number of days, and there will be a multiple. The multiple depends on how much confidence I want. I may want a 95% confidence, you have a multiple. 99% confidence, you have a multiple. When we were trying to do initial margin, we had 3 times of standard deviation. 3 times means 99.99% confidence, 99.99 something like that. So here amount will be, let's assume 10 lakh, daily SD 2%, square root of 20, and the multiple will either be given in the question, or if it's 99, 2.33, and 95 is 1.65. This is if they give daily data. Instead of giving daily data, they give 200 days SD. They have given 200 days SD. From 200, if you want to come to 20, divide by square root of 10. Divide by square root of 10, not divide by 10. Not from 200 to 20 is divided by 10, but it is square root of 10. It is square root of 10. I have annual SD 25%. I want monthly 25 divided by square root of 12. 25 divided by square root of 12. I have monthly 2. Annual is 2 into square root of 12. 2 into square root of 12. Okay. Some exam question. I give you the value at risk. I tell you the standard deviation. I give you the number of days. I give you the multiple. Amount can be balancing. Amount can be balancing figure. No, I want to go a step ahead. I give you this. I give you this. I give you this, but I don't give you daily ST. I tell you, you do return, probability, product, deviation, PD square, and calculate the standard deviation. Calculate the standard deviation. If daily returns are used, daily standard deviation. Weekly returns are used, weekly standard deviation. Monthly returns are used, monthly standard deviation. I want to go a step ahead and tell you there is a security 1, security 2. This is 2%. This is 2%, and I give you a correlation, and you have to calculate portfolio value at risk. Portfolio value at risk. For portfolio value at risk, I have to do sigma A WA square, sigma B WB square, 2 sigma A WA, sigma B WB, correlation AB. Portfolio is 1.5%. Portfolio is 1.5%. Here, 200 lakh, 2%, only one day calculation into 2.33 is the loss. Security is separately 200 into 2% into 2.33. This number will be, I think, 9.32. Similarly, 200 into 2% into 2.33, 9.32. But when I club it together, it is 400. It is 400. But the risk is how much? 1.5% into 2.33 into 2.33. This number should be 16.98. Maybe some differences can be there. The difference in this is the diversification benefit. When you independently do 9.32 plus 9.32 is 18 lakh loss. But when you diversify together, your loss is only 16.98. It will not be 16, and some other number, but don't worry about the numbers part of it. Okay, don't worry about the numbers part of it. I think I have not done the proper calculation, but the concept is very simple. When you club it together, this is 20, this is 20, but together is 25. Together is 25. The gap is called diversification benefit. The gap is called diversification benefit. Only thing you need to be sure here is you need to use properly is square root of 20. Doing square root of 20 and not into 20. Not into 20. And maybe diversification benefit, which is already tested. I don't think they're testing again, but diversification benefit could be asked in the question. With this chapter is over. There isn't anything in this chapter. Second part is security analysis. In security analysis, technically have three approaches. One is called fundamental analysis. Second is called technical analysis. These are the two parts of selecting a stock. And the other thing is to check whether the market is a good market or a bad market, technically called efficient market hypothesis. Fundamental analysis, you don't do any practical problem, but the entire AFM is only fundamental analysis. You are basically trying to find whether the company is undervalued or overvalued. That is called fundamental analysis. Technical analysis is studying charts, studying patterns, and based on the patterns deciding whether to buy a security or sell a security. In that technical analysis, first is simple moving average. What is simple moving averages? You want 3-day moving average, last 3-day prices. Last 3-day prices 10, 15, 18, average of 10, 15 and 18, which could be 14 point something. Next day 14, average of these three. Average of these three. Next day 15, average of these three. Average of these three. This is called moving average. Simple moving average. Simple moving average. Then comes an exponential moving average, where they say you can't be doing simple average. You can't be doing simple average. So what we do in exponential moving average is 20,000. Next day is 20,100. Next day is 20,100. They will give one EMA data for the last data. EMA data will be given saying that what is the starting EMA. So starting EMA is 19,000. Starting EMA is 19,000. One number will be given and one exponent needs to be given. One exponent needs to be given. Earlier we do simple average. Here we are going to do weighted average. Exponent could be given in the problem, or the exponent is equal to 2 by n plus 1. N is not the number of observation. N is basically how many day EMA you are trying to do. How many day EMA? It may be a 15-day EMA or a 30-day EMA. N is the number of days of EMA. N is the number of days of EMA. Once you get the exponent, you have one choice. Take the previous value, multiply with 1 minus the exponent and the new value into the exponent. New value into the exponent, and this is the new EMA. This is the last EMA into 1 minus exponent, new day value into the exponent. Let us assume this is 19,250. I apply this formula, 19,000 into 0.8 plus 2,100 into 0.2, 2,100 into 0.2, last day value into 1 minus exponent, current day value into the exponent. Then it becomes 2,400. Last day value into 0.8, current day value into 0.2. Last day value into 0.8, current day value into 0.2. This is one way which is easy to understand. Previous day EMA into 1 minus exponent, current day EMA into the exponent. Or you can do an EMA adjustment route. Both will give same answer. Only EMA adjustment is basically today value minus what was there on the last day, multiply with the exponent. It can be a positive number or a negative number, and you have to add this or subtract. If the EMA is continuously going up, it is a bull market. EMA is going down, it is a bear market. SMA is continuously going up, it is a bull market. SMA coming down is a bear market. Third thing, index, this measures number of advances by number of declines. Number of advances minus number of declines divided by the total securities traded. Breadth is positive, Nifty is positive, technical strength. Breadth is positive, Nifty only 50 companies, and this ratio measures 5,000 companies. So breadth positive, Nifty positive, market will continue to go up. Breadth negative, Nifty negative, market will continue to go down. Contradicts, market will reverse. Reverse means if it was going up, it will go down. If it is going down, it will go up. Going up is going, if Nifty is going up and there is a reversal, there is a wrong sign. What is wrong sign is Nifty up, breadth negative. Next day, high probability Nifty will go down. Next day, high probability Nifty will go down. The good performance of Nifty is not supported by all the companies in the market. All the companies in the market are not supporting the good performance of Nifty. Good performance of Nifty. Confidence index is yield of high grade bond. High grade means credit rating bond. Yield of low credit rating bond. If the confidence index is moving up, people are ready to take more risk. It is a sign of a bull market. Sign of a bull market, and opposite is a sign of a bear market. Opposite is a sign of bear market. RSI index means relative strength analysis. Relative strength analysis. For RSI index, I'll have to calculate the average gain of the last few days, average loss of the last few days. Gain is 10, loss is 4, RS is 2.5. This is little cautionary situation, because if more gains are there, less losses are there, we are getting into a very high price kind of a situation. If it's 2.5, you'll apply here 100 minus 100 divided by 1 plus 2.5, you will get a number closer to 70, 80 and all here. If there is a high up, if exactly both are same, 4 by 4, then RS is 1. When RS is 1, RSI will be exactly 50. RSI will be exactly 50. When RS is more than 1, RSI will be more than 50. RSI will be more than 50. Mathematically, that is what will happen. Okay, that RS is converted into an index. RS 1, RSI 50. RS more than 1. More than 1 means more gain, less loss. More gain and less loss. If RSI touches 70, be cautious. Silver would have touched an RSI of 70, 80 and then it started crashing down. It started crashing down. And if the RSI is less than 30 or closer to 30, buy it a lot. Buy it a lot. When will RSI be 30? If the gain is 4 and loss is 10. gain is 4 and loss is 10, the RSI may turn less than 30 or closer to 30. 30 and 70 are the two signal points here. Types of market. Efficient market means I throw a dice. I cannot tell what number will come. That is a perfect dice or a perfect market. Perfect dice or a perfect market. Inefficient market means I throw a dice. When I throw, I know number 2 will only come. I somehow manage it. Number 4 will come. Number 6 will come. I do it that way. That is a compromised dice or a compromised stock market. Compromised dice or a compromised stock market. There are three tests: run test, serial correlation test, and filter rules test. Run test basically says have data 100, 120, 140, 80, 90. Put plus sign, minus sign. Plus if price has gone up, minus if price has gone down. Plus, minus, plus, minus, plus, minus, you keep putting. You should not have very high number of runs or very low number of runs. High number of runs means what is one run is started with plus, became minus. Whenever the sign has changed, another run is created. Another run is created. Again plus, again minus, again plus, again minus. This is 6 runs. If in 7 days 6 runs happen, then I know the trend: plus, minus, plus, minus, plus, minus, plus, minus, or plus, 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 and minus. Very few runs. Very few run means it continued as plus for a very long period and then became minus. Only 2 runs are there. So general expectation is that whenever you do this analysis, the plus or minus sign. Plus sign is called N1, minus sign is called N2, and R is called number of runs. In this, we do a mean number. You may have to remember the formula: N1, N2 divided by N1 plus N2 plus 1. If N1 is 8, N2 is 10, the formula will say 2 into 8, 10 divided by 8 plus 10 plus 1. Some number will come. Let's assume that number is 9. Just random number, okay? Basically, I expect the number of runs to be exactly 9. But exactly 9 not possible. So they say we allow a standard deviation. So a standard deviation. Standard deviation is mean minus 1, mean minus 2 divided by n minus 1. This is one area. Please remember the formula and go. Mean minus 1, mean minus 2, and n minus 1. And the number of runs can either be between upper limit and the lower limit. Between the upper limit and the lower limit. What is upper limit? Daily absolute change plus 3 times of standard deviation we used to do. Similarly, daily absolute change, daily average change is called mean. 3 times of standard deviation is called t value into standard deviation. T value will be given in the question. T value will be given in the question. This is the cushion available. This is the cushion available, and t value has to be taken for n minus 1. N minus 1 degrees of freedom. If the number of runs falls within the limit, it is a non-compromised or a good market. Non-compromised or a good market. And if it doesn't fall within the limit, it is a bad stock market. It is a bad stock market. Somebody is trying to influence the market. Some big guy is influencing the market. Second option is to do correlation test. What is correlation? January 2026, January 2025, find the price change and find the correlation of the price change. Correlation of the price change. If the correlation is closer to plus 1 or closer to minus 1. Closer to plus 1 means Jan 25 is repeated in Jan 26, will repeat in Jan 27. Will repeat in Jan 27. If it's closer to minus 1, Jan 25 opposite happened in 26. Opposite of 26 will happen in 27. Opposite of 26 will happen in 27. Or January 1 to 10 compared with January 11 to 20. January 11 to 20 compared with January 21 to 30. Are there any trends? If at all some trend gets found, your trend will repeat and you earn money out of it. You earn money out of it. If somebody is able to exploit this, I have a problem. Somebody is able to exploit this, it is an inefficient market. Exploit this, it is a inefficient market. Either through correlation, there is a auto correlation test, The serial auto correlation will take absolute change. Serial correlation will take the percentage change. It is on the change data. Like tracking error is on the differential return. This is on the change. Change means two observations have to be there, and calculate correlation in the normal way. Correlation and covariance in the normal manner. Any doubts in this? Able to understand this? Clear? Okay. And the third part which I want to quickly discuss is your international financial management. Now, in IFM, we learned, listen, IFM, what we learned is there are two things which you need to be aware in international financial management. Whenever I'm doing a capital budgeting problem, generally when I do normal capital budgeting problem, all cash flows are in Indian currency. Here, some could be in Indian currency, some could be in non-Indian currency. Indian NPV, Indian currency, Indian cash flow, India discount rate, India discount rate, USD NPV, USD cash flow, USD discount rate, USD discount rate. First thing, how do I convert the cash flow? To convert the cash flow, we use IRPT or PPT and forecast the exchange rate. IRPT or PPT and forecast the exchange rate. I have done the forecasting. Then here INR cash flow, exchange rate, convert to US dollar, some other US dollar is also there, total USD, discounted USD rate, discounted USD rate. I can take the number as it is, or some question that will have a real cash flow and nominal cash flow, convert the real to nominal, nominal to real depending on the question's requirement. But we will use the help of IRPT or PPT. Second thing, in India, interest rate is 8% risk free. Risky rate is 12%. We calculate something called as risk premium. How do we calculate? 1 plus 12% is equal to 1 plus 8% into 1 plus RP. 1 plus RP. RP number, let's assume, is 3.7%. Some random number. Okay. RP number is 3.7. Then USA 3%. Same 3.7. This is balancing figure. This is balancing. How will you do? 1 plus risky rate of US, 1 plus risk-free rate of US, 1 plus risk premium is same. Risk premium is same and get the answer. Risk premium is same, and once you get the discount rate, USD cash flow, USD discount rate, INR cash flow, INR discount rate. There are two approaches. One is called home currency. Second is called foreign currency. Home currency does not mean Indian currency. Home currency means who is investing. Who is investing? Foreign currency means where is the investment? Where is the investment? Indian company invest in US. Indian currency is home currency. US currency is foreign currency. US company is investing in India. US is home currency. India is foreign currency. India is foreign currency. Problem silent, we will do home currency approach. Problem silent, will do home currency approach. So first issue is cash flows are not in Indian currency. No problem. Use IRPT or PPT and do the conversion. IRPT or PPT and do the conversion. Second issue, altering the discount rate. Third issue, withholding tax. If there is a withholding tax by the government, the withholding tax will reduce my cash flow and reduce my CFAT. Reduce my cash flow and reduce my CFAT. If cash flows are directly given, just reduce from the cash flow. If they ask us to prepare a P&L statement, in that ICI will say withholding tax eligible for tax credit, not eligible for tax credit, not eligible revenue less expenses, PBT less corporate tax, PAT, deduct the withholding tax and money can be repatriated. Money can be repatriated. Withholding tax is an expense. Withholding tax is a expense if it is not eligible for tax credit. Not eligible for tax credit, withholding tax is a expense. If you are eligible for tax credit, they say you calculate PBT 200, on PBT charge withholding tax 10%. Corporate tax charge 30% on this, but subtract the 20. Subtract the 20. Charge 30% on PBT. Withholding tax also on PBT. Corporate tax also on PBT. But corporate tax charge and subtract. Charge and subtract. Charge and subtract. So once you subtract this, in the end, you are not even paying the withholding tax. You are not even paying the withholding tax, and money can be repatriated back. In case they give a DTA provision also, the withholding tax rate will be lower of normal income tax rate and DTA rate. DTA rate. I want to calculate one NPV to another NPV. NPV in INR is equal to NPV in US dollar into spot INR per USD. Spot INR per USD. Spot INR per USD. The next part is, are there any exchange restriction? Exchange restriction means I'm not able to transfer the money. If you are not able to transfer the money, till you transfer, it is not an inflow of the project. Till you transfer, it is not a inflow of the project. It is not an inflow of the project. Your USD NPV could be very high. INR NPV can be negative also if you are not able to transfer the money back to India. So when you transfer the money back to India, that time consider it as inflow. That time consider it as inflow. When the money is transferred back to India, when the money is transferred back to India, it is an inflow in the Indian country. It is a inflow in the Indian country when what? When the money is transferred back to India. When the money is transferred back to India. If the money is not transferred, till that it is not a inflow of the project. And when I do my asset beta and equity beta, I use weight of debt as debt into 1 minus tax rate. If there are two countries, India and US, if you borrow from US, weight of debt is equal to debt into 1 minus US tax rate. And if you borrow from India, weight of debt is equal to debt into 1 minus Indian tax rate. 1 minus Indian tax rate. This is a very simple concept, but a lot of solving is needed. IFM, the questions are more comprehensive. Concept wise, it is very simple. So we have done one value at risk discussion. I've done the security analysis discussion also, and I'm now completed the international financial management discussion. Any doubts on any of this? Clear? Done? Okay. Let's now move to security valuation, a chapter which has multiple concepts. Ideally, it is not one chapter, it is a combination of multiple chapters. We'll quickly go through all the concepts. Concept 1, we are not discussing, that's self-explanatory, time value of money. Concept 2 onwards comes the various things. First is Walter's model. This is one of the model for price calculation, where price is equal to, what is the formula? Keep participating. Price is equal to, just give me a minute. Price is equal to D by KE plus R by KE into E minus D divided by KE. This part is called dividend paid. The other part is called retained earnings, which has a multiplier called R by KE and again divided by KE. The first part is called paid money. The second part is called the future profits or future dividends of the company out of the earnings and due to retained earnings. In this, D represents dividend per share, which is total dividend by number of shares, or EPS into payout ratio, face value into dividend rate, or market price into dividend yield. Market price into dividend yield. R is equal to return on equity. There are other names called IRR, return on investment, rate of return on retained earnings, and ROE formula is EAES divided by amount of equity. This divided by number of equity shares is called EPS, and this divided by number of equity shares is called PVPS. EPS by PVPS. E represents EPS. EPS can either be calculated as total earnings minus the preference dividend divided by number of equity share, or you can do PVPS into ROE. PVPS into ROE will give you the earnings per share. K represents cost of equity, multiple other names called investor required return, opportunity cost of capital, rate of capitalization, cost of capital, equity capitalization rate. Second concept is what is the appropriate dividend payout ratio? That depends on R and KE. R is what company is earning. If company earns more, keep full money with the company. Keep full money with the company, no dividend. If they are equal, indifferent, and if company cannot earn, pay the entire money to the shareholder. Pay the entire money to the shareholder. Pay a 100% dividend. Okay. Then there's a concept called limiting value. Limiting value is calculated by following a payout ratio, which is opposite of the optimum payout ratio. Example, R is greater than K is equation. Calculate the price with a 100% payout. Calculate the price with a 100% payout. And R is less than KE. Calculate the price with a 0% payout. With a 0% payout. Opposite of the optimum payout ratio. Next came the Gordon's model, which is what we predominantly use to multiple places, where P naught is equal to what? D1 by KE minus G or D0 into 1 plus G, keep participating, divided by KE minus G or E1 into payout ratio by KE minus G or E0 into 1 plus G into payout ratio divided by KE minus G. Now the dividend number given in the question, clarity will not be there. If they say it is paid earlier, paid out, paid now, all those are D0. Will pay next year, pay end of current year, D1. Clarity not there, give two answers. One assuming D0, one assuming D1. One assuming D0 and one assuming D1. How is growth calculated? Growth is calculated, one formula is ROE into retention ratio. This is called based on earning ability of the company. Based on earning ability of the company, calculate ROE into retention ratio. There's another way to calculate the growth where I have 1996 dividend, 2020 dividend, any two data, or let's take 2010, 2020, this is 20, this is 40. 2010 dividend is called present value. This is called future value. Future value is equal to present value into future value factor R comma N. You will get the future value factor. Look at the tables and see what R correspond to. If they give you present value, then present value is equal to future value into present value factor R comma N. Present value factor R comma N. When we are doing this calculation, the earlier dividend is called present value. The later dividend is called future value. For example, I have 2020 and 2030. 2020 is present value. 2030 is future value. I have 30 and 40. 30 is present value. 40 is future value. So growth is computed, ROE into retention ratio are based on the past dividend history. If I'm taking past data, first preference is to calculate based on earnings and not based on dividend, because dividend can be manipulated by the company. Go with past EPS data, not available, past DPS data, ROE formula is EAES by amount of equity. EAES divided by number of shares is called EPS. Amount of equity by number of shares is called book value per share, where we use this formula. Share capital plus reserves minus fictitious asset by number of share are total assets minus current liability minus other liability divided by number of share, and this will give me the book value per share. Next, cost of equity. If you are paying dividends, K is equal to CI inter D1 by P naught plus growth rate. This can have P naught minus F. If you are not paying dividend, RF plus equity beta. Till now just beta we were saying, but now it is called equity beta, and generally beta means equity beta. Generally beta means equity beta. None, these two are not happening. I tried, not happening. Rare scenario, 1 by PE multiple. 1 by PE multiple. Rare scenario, not mandatory, but rare scenario, 1 by PE multiple. So if you are paying dividend, D1 by P naught minus F plus growth rate, not paying RF plus beta into RM minus RF, or you can do 1 divided by price earning multiple. 1 divided by price earning multiple. If I am doing any new project, I will have to calculate the NPV of that project. If you have a positive NPV, share price will go up by the amount of NPV divided by number of share, and share price will go down by the amount of NPV divided by number of share. I acquire one company. Acquisition is positive NPV, share price will go up that day. Acquisition is negative NPV, share price will go down. Whenever an acquisition is done in M&A chapter, if it is a positive synergy gain acquisition, share price will go up. Negative synergy gain acquisition, share price will go down. Undervalued or overvalued security, we discussed in portfolio some time back that undervalued or overvalued can be on the basis of return, can be on the basis of beta. Now here on the basis of only price. Actual price higher, overvalued, sell it. Actual price lower, undervalued, buy it. Undervalued, buy it. Now I know the price. You want to know the first year price for some reason. Modigliani Miller, P naught into 1 plus KE minus dividend of year 1, minus dividend of year. You want to do bond valuation minus interest of year 1, minus interest of year 1. I want price 2. Price 2 is equal to P1 into 1 plus KE minus D2. Why do I need prices for multiple year? There was one problem where we did something called as dividend investing. Dividend investing means I am investing an objective of regular dividend income, getting regular dividend income. Company pays dividend, very happy, I am getting my money. I am getting my money. Company does not pay dividend. We will do partial sale of shares till the company starts paying dividend again. For doing partial sale of share, I need the share price every year. So with the share price every year, I will tell how many shares are to be sold every year. How many shares are to be sold every year. Holding period return, we are aware what I get back minus what I give divided by what I give into 100. P1 minus P naught plus D1 divided by P naught into 100. Ex dividend price and cum dividend price. Whenever we buy a share, it could be only the share purchase, or it could be the share purchase inclusive of some dividend income. Inclusive of some dividend income. If the share price is quoted cum dividend, remove the dividend from it and make it ex dividend. Make it ex dividend. Only the ex dividend price can be used in any formula or even for comparison. What is comparison? Fair ex dividend price calculated by me compared with actual ex dividend price to decide undervalued or overvalued. To decide undervalued or overvalued, fair ex dividend price, actual ex dividend price. Our formula can only give fair price for ex dividend price. Our formula can only give ex dividend. You are trying to do KE calculation. Please use the ex dividend rate. Please use the ex dividend rate. So wherever you are using, use the ex dividend. In rights issue, we do a formula called existing shares into existing price. That existing price has to be ex dividend price. The existing price has to be the ex dividend price. Inflation premium. Anybody who says the required return, he has two things. One is risk-free rate. Along with the risk-free rate, he adds a risk premium. He adds a risk premium. Along with the risk-free rate, you're adding a risk premium. Risk-free rate has two parts. One is called inflation plus the real return. Inflation plus the real return. So if inflation is going up, risk-free rate may go up, market rate may or may not go up depending on the question. We did one problem where market rate was remaining same, our market rate may also end up going, but inflation premium is a part of risk-free, a part of risk-free rate. step up growth model. Step up growth model says that whenever I am calculating Gordon's formula, Gordon says P naught equal to D1 by Ke minus G. But the G, there are 10 numbers. For the growth rate, I'm saying today 10, then 9, then 8, then 7, then 6, then 5, then 4, then 3, then 2. Ultimately, it will become 1% and stabilize. When I ask you this number, you are saying multiple numbers. So Gordon says, please come to the year when we start having only one growth rate. When we start having only one growth rate. After eighth year, it is consistently 1%. After eighth year, it is consistently 1%. Then he says P8 equal to D9 by KE minus 1%. After eighth year, you are saying dividends will not, growth will not change. Till growth does not change, I cannot use the formula. Once you use this, very simple. Year, cash flow, PVF, TCF, year 1, first year dividend, year 2, second year dividend, year 3, third, fourth, fifth, sixth, seventh, eighth. P8, if you are writing, write till 8 dividends. P8 is 9 to infinity. P8 is 9 to infinity. If you are calculating P6, calculate sixth year dividend, write the sixth year dividend. P6 is equal to D7 by KE minus G. So I have to write cash flow first, second, third, fourth, fifth. 6 to infinity is P5. 6 to infinity is P5. In the calculation, I may give you the price, tell you to calculate the day zero dividend, tell you to calculate the growth rate, tell you to calculate the price. Anything can become a balancing figure. But you cannot use this formula till the growth stabilizes, and always keep in mind we are writing from year 1 till infinity. So 1 2 3 4 5 to infinity, 1 2 3 4 5 to infinity, 5 to infinity is called P4, 5 to infinity is called P4, 1 2 3 4 5 6 7 8, 9 to infinity is called P8, 9 to infinity is called P8. When we are doing step up growth model, there is a possibility that a payout ratio change may happen. A payout ratio change may happen. Payout ratio influences the dividend, and if payout ratio is not changing, earnings growth equal to dividend growth. Earnings growth is equal to dividend growth. But if payout ratio is changing, then my dividend can significantly go up or significantly go down also. If there is a change in payout ratio, determine EPS till the year of stability, and EPS into payout ratio is dividend, and write the dividend in year cash flow. Write the dividend in year and cash flow. Write 7-year dividend, P7 equal to D8 divided by KE minus G. D8 divided by KE minus G. In this also, there could be a linear fall in growth rate. Linear fall or linear rise. It can be a fall or rise. If they say first to 4 years 10%, thereafter it will fall, stabilize at 8%. So first to 4 years 10%, fall and stabilize at, let's assume, 4%. Stabilize at 4%. This is for 4 years, and this will happen for when they have not mentioned. If they don't mention, for first to 4 years 10%, fifth year 9%, sixth year 8%, 7, 6, 5, 4, and 4 stability will come in the 10th year. 4 stability will come in the 10th year. 10 will become 9, 9 will become 8, 8 will become 7, 7 will become 6, 6 will become 5, 5 will become 4. If they say this will happen in the 7th year, 6% fall in 3 years, 6% fall in 3 years, 2% fall every year. 2% fall every year. So 10 will become 8, 8 will become 6, 6 will become 4. 10 will become 8, 8 will become 6, 6 will become 4. Like there is a fall in growth rate, there can be an increase in payout ratio. There can be a increase in payout ratio. Linear increase can happen, whatever the question gives. If they give the number of years, higher rate minus lower rate divided by number of years of fall. Number of years of fall. A variant of this is the H model. The variant of this is H model. H model said assume the stability happened today itself. They say D0 into 1 plus long term growth rate divided by KE minus long term growth rate. Stability happened today itself. Stability happened today. Denominator again KE minus long term growth rate, but I'm growing at a higher rate, so I want to give some benefit. I'm also growing at a higher rate. So for that D0, for that D0, for that D0 into higher number minus the lower number, higher growth rate minus the lower growth rate into half of stabilization phase, half of stabilization phase. This is extra benefit given on the valuation. The same thing I can do a step up growth model, will not give same answer, but may give a closer answer, may give a closer answer. H model works little differently. Multiple approach, EPS into P multiple. If P multiple is given, great. Not given, P multiple can be 1 by KE if it's 100% payout, or 1 by ROE, 1 by ROE in case EPS is sorry, in case market price is equal to book value per share. Market price is equal to book value per share. Earnings growth model technically not needed, but specifically asks then dividend growth model is D1 by KE minus G. This is E1 divided by KE minus G. E1 divided by KE minus G. Impact of bonus. I purchased one share, year 0, 300 rupees. First year I got dividend. Second year I got dividend. Third year some bonus happened. Third year some bonus happened. Whenever bonus happens, my number of shares will increase. My number of shares will increase. So my one share may become 1.2 or 1.4 or 1.5. So when number of shares increase from year 3, I may get 36. 30 into 1.2, 30 into 1.2. And when I sell the share, I'm not selling one share. I am selling 1.2 share. I am selling 1.2 share. So keep in mind, in case there is any bonus element, if you are doing the P7 as D8 by KE minus G, P7 as D8 by KE minus G, that value into 1.2, that value into 1.2, that value into 1.2, because bonus will increase your number of share. Bonus will increase your number of share. Generally, what we calculate here is called fair value or maximum purchase price. Fair value or maximum purchase price. But if there are any transaction cost, then purchase price plus 2% of purchase price is equal to fair value. If there are any transaction cost, if there are any transaction cost, purchase price plus what? 2%, 5%, whatever number, and reverse work the purchase price. Reverse work the purchase price. Purchase price plus what? 2% of purchase price. No transaction cost. Maximum purchase price is equal to fair value. And if there are transaction costs, fair value divided by 1 plus transaction cost percentage. But rather than remembering the formula, I've explained you in the logical way. How to compute cost of GDR? GDR is basically equity share. It is basically equity share. Instead of issuing it in India, I issue it in US market to the US investor, denominated in US currency. Denominated in US currency. What will happen is one share equal to, sorry, one GDR equal to 5 shares. Each share is worth 200, which means one GDR is worth 1000 rupees. One GDR is worth 1000 rupees. But when I'm issuing, I may issue it at some discount. I want to give discount of 20%. So the issue price of GDR is 800. This 800 is also of no use. This is INR. Exchange rate is 80. So I am going to issue it at US dollar 10. I am going to issue this at US dollar 10. The question will say amount to be raised. Some expenses can be there. Get the gross amount. Divide by USD 10. Divide by USD 10 is the number of GDR. Divided by USD 10 is the number of GDR. Number of GDR. and cost of GDR is equal to D1 P naught minus F plus growth rate. D1 by P naught minus F plus growth rate. D1 will not be for 1 shares, it will be for 5, 6 shares. It will be for 5, 6 shares. P naught for 5 shares, flotation cost, and add the growth rate. Add the growth rate. This is called cost of GDR. This is called cost of GDR. When we did step up growth model, I explained that growth can be a balancing figure, price can be a balancing figure, dividend can be a balancing figure, sometimes KE can be balancing. For KE, what we do is year, cash flow, PVF, DCF. I will know the cash flows. I will assume some rate and put the total and see whether I'm getting a positive NPV or a negative NPV. Repeat at another rate. When you repeat at another rate, you can't write the same cash flow because dividends will remain same. But P5 will be D6 by new KE minus G. D6 divided by new discount rate minus the growth rate. New discount rate minus the growth rate. As you change the growth rate, P5, as you change the discount rate, P5 will undergo a change. As you change the discount rate, price will undergo a change. So here, cost of equity with multiple growth rate, direct formula can't be applied. So I will have to get one positive NPV, one negative NPV, and IRR of the investor is technically cost of equity as per an approach called realized yield approach, which you would have seen in CA Inter. As per realized yield approach, that is called cost of equity. Okay. Another approach of valuation is FCFE. FCFE we discussed extensively when we did our business valuation part. FCFE 1 divided by KE minus G. What is FCFE 1 is PAT minus the equity needed for net capex and working capital. Equity needed for net capex and working capital. We are not discussing much on what is net capex and all. Anyway, in business valuation, we'll see net capex and working capital. Once you get the FCFE number, you can divide by KE minus G. You can divide by, and the FCFE number can be taken as FCFE 0 or FCFE 1 depending on your assumption. If you take 0, add 1 plus G into 1 plus G and divide by KE minus G. Divide by KE minus G. With this, then there's an income statement format. In the income statement, we start with sales, deduct cost of goods sold, gross profit, less operating expenses, EBIT, interest, EBT, less tax, EAT, less preference dividend, EAS. Interest generally, loan into the rate of interest, another loan into rate of interest, another loan. But if they give a effective interest rate, add up the entire loan and multiply, add up the entire loan and multiply with one interest rate, multiply with one interest rate. Ratios concept we are not discussing. Okay, fixed interest and dividend coverage ratio, it's there in one of the question in our material. Fixed interest and dividend coverage ratio is equal to PAT plus interest divided by interest plus preference dividend. PAT plus interest divided by interest plus preference dividend. Technically not a very logical formula. Why are we calculating ratio? What we will do in ratio is, let's take interest coverage ratio, our industry. Ours is 4 times, industry is 3 times. We are better than the industry. Our KE should go down. We are better than the industry. Our KE should go down. ROE, ROE 25, industry 30. We are weaker than the industry. We are weaker than the industry. We are weaker than the industry. KE should go up or the P multiple should go down. KE should go up or the P multiple should go down. So find out what are the relevant ratio. See, are you better or weaker, and get your return on, get your cost of equity, and then do valuation using Walter Gordon or a customized method. Walter Gordon or a customized method. Here, this is the concept. We are better required return will go down or KE will go down. And if we are weaker, KE will go up. If we are weaker, KE will go up. Stock lending is basically a scheme where I am lending my share to another person. I am lending my share to another person. As a lender, I will get certain income. My income is very simple. My income is lending fees. I'll be charging one lending fees to the other party, whomever I'm lending the share. Why is he borrowing? In 2 minutes, we'll discuss. I will charge one lending fees and I may get some dividend income because I am the owner of the share. I am the owner of the share. Another party who borrowed the share, he did a short sell. He did something called as a short sell. What a short sell is? Selling the share without even having the share. Selling the share without even having the share. He sold the share. He sold the share, not able to make delivery. So borrowed and gave it to other person. Borrowed and gave it to. For him, this is an expense. For doing this lending or borrowing, I may have to give one bank guarantee. I may have to give one bank guarantee. That is another expense. And third can be profit or loss. What is profit or loss? Is number of shares. I did short sell. No, selling prices day one, purchase prices last day. Selling price minus the, I press the sell button first, buy button later. I press the sell button first and buy button later. In this process, there can be some profit or loss. There can be some profit or loss. These two are expenses. These two are expenses. So I earn lending fees, I earn dividend income. Other guy has a guarantee expense, has a lending fees, and there can be a profit or loss on short sell. Profit or loss on short sell. The next point we learned is rights issue. This is an issue given to my existing shareholders at a price lower than the current market price. Price lower than the current market price. This is to encourage them to subscribe. We calculate X rights price. We calculate a X rights price. What is the formula for X rights price? Existing, keep participating. Existing shares into existing price, new shares into new price, whole divided by existing shares plus new shares. This is 25. This is 35. This is 20. The 20 is the rights issue price and post rights is 25. Value of a right is equal to X rights price minus the rights issue price. Value of a right is equal to X rights price minus the rights issue price, and this right I can sell it to someone. I can sell it to someone. This number 25 minus 20 is called the value of a right at a per share level. If you divide by the rights ratio at a per existing share level, and you can sell it to anyone, you can sell it to. If you subscribe to the rights issue, no impact on wealth. If you sell your right entitlement, no impact on wealth. If you ignore, wealth will go down. If you ignore the rights issue, wealth will go down. Next part is buyback of share. Buyback is an exercise where the company is returning some of the reserves to the shareholder. Whenever buyback is done, three, four things will get impacted. PAT may remain same or go down. PAT may remain same or go down. Why will it go down? If I do a buyback by borrowing money, interest payment, PAT is down. Or by breaking a fixed deposit, no more interest income, PAT is down. No more interest income. Number of shares 100% will go down and net worth will go down. Net worth is earlier share capital plus reserves was more. Now share capital will also be down. Reserves will also be down and this will go down. In a buyback, if PAT goes down, number of shares go down. How much they go down? PAT is down by 20%. Number of shares is down by 30%. EPS will improve. If the denominator falls more, EPS will technically go up, or EPS may remain same or may go down. If EPS improves, it is a benefit for all the existing shareholder because PAT, EPS into P multiple will be the price. EPS into P multiple will be the price. A question may ask you to compute the interest cost balancing figure also. They will say, I want this price. What should be the interest cost? Similarly, as I said, there will be an impact on net worth. There will be an impact on number of share. Net worth by number of shares is book value per share, which may go up, which may go down, or may remain same, This is on the allied areas of buyback as well as rights issue. Coming to bond valuation, very simple. Here we are valuing the bond as present value of future cash flow discounted at investors required rate of return. Only one model of valuation. Year cash flow, PVF, DCF. Half yearly bond, half year cash flow, PVF, DCF. Quarterly cash flow, quarter cash flow, PVF, DCF. Annual bond, annual interest, annual YTM. Half yearly bond, half yearly interest, half yearly YTM. Quarterly bond, quarterly cash flow, quarterly YTM. You keep doing the calculation, keep getting the numbers, keep doing the calculation, keep getting. The discount rate has multiple names: cost of debt, discount rate, required return of investor, expected return, opportunity cost, market rate of interest, prevailing rate of interest, interest rate of similar bond, going rate of interest. Now I did the valuation, I got P naught. I want P1, the Modigliani Miller. P naught into 1 plus the discount rate minus the interest of year 1, minus the interest of year 1. And annual bond, annual cash flow, annual YTM, half yearly bond, half yearly cash flow, half yearly YTM. Whatever I am earning may go down if there is a transaction cost. If there is a transaction cost, my yield will go down as normal yield into 1 minus the transaction cost percentage. And number of times taken to recover the transaction cost, 2% is the transaction cost. I earn 8% in 360 days. I earn 8% in 360 days. 2% will be recovered in how many days? 2% will be recovered in how many days? That's called number of days to recover the transaction cost. Next point is, there is a relationship between the coupon rate and the YTM. If the bond is redeeming at par, and if the bond interest is equal to the YTM means investor expectation, bond will quote at par. Any bond quotes at par, YTM will be equal to coupon rate, provided redemption is at par. Why YTM? I want shortcut because calculating YTM is time consuming exercise. But if it's quoting at par, directly take the par value. If coupon is more, paying more, bond will be at premium. Coupon is lower, bond will trade at discount. And there is an inverse relationship between yield and price. There's an inverse relationship between yield and price. Yield increases, price decreases. Yield increases, price decreases, and vice versa. YTM basically means IRR of the investor. For calculating IRR, you will have to write with year 0. You have to write with year 0, 1, 2, 3, 4, 5, and you calculate the IRR. Whatever IRR you calculate is called as the YTM of the investor. There's a shortcut, but focus on the longer calculation. YTM is more relevant for a redeemable bond. If it is irredeemable bond, we just do current yield is equal to interest by current market price. This is useful for an irredeemable bond. In the YTM also, there are multiple types of YTM. You can use pre-tax cash flow, pre-tax YTM. You can use post-tax cash flow, post-tax YTM. You can use company cash flow, pre-tax cost of debt. Company post-tax cash flow, post-tax cost of debt. Pre-tax cost of debt and post-tax cost of debt. Pre-tax cost of debt and post-tax cost of debt. And current yield is more relevant for an irredeemable bond. Next, If question says there is an increase in interest rate, it means discount rate is changing. It means discount rate is changing because coupon can't change. Because coupon can't change unless it is a variable bond. Unless it is a variable bond, because for a variable bond, both the coupon and the YTM will change. Both the variable bond means it's a floating bond. Floating bond means as benchmark changes, interest rate also changes. As benchmark changes, interest rate also changes. Step up or step down discount rate. Step up or step down means there are changes in the discount rate. Now, whenever discount rate change, it can be of two types: forward change, spot change. Forward change and spot change. Here 10%, 11, 10, 11. If it is 10 and 11, first year is 1 divided by 1.1, 0.909. This side also 0.909. Year 2, 909 divided by the new discount rate. Divided by the new discount rate. Divided by the new discount rate. And this side 1 divided by 1.11 square. 1 divided by 1.11 square. 1 divided by 1.11 square. If it's a spot yield change, 1 divided, the PVF of year 2. PVF of year 2 is what? 1 divided by 1.11 square. This side, PVF of year 1 divided by 1 plus the new discount rate. 1 plus the new discount rate. And when you do the step up or step down, ICI asks something called as expected price, which is not very logical. Expected price is equal to what you calculate, intrinsic value multiplied with beta. Intrinsic value multiplied with beta. Then what should I use as discount rate to do a bond valuation? Different names, which we saw in that concept 37 when I started. I gave multiple names. But sometimes company will say, I want to give more returns. If you want to give more returns, you can have higher coupon. But they're saying, no, coupon don't change, but issue it at a higher discount. Issue it at a higher discount. So if they want to give a higher return or a lower return, change the discount rate. Change the discount rate for doing the valuation. Intrinsic value will always be calculated at the YTM. Issue price can be more than the YTM rate or less than the YTM rate. Broken period bond valuation. Broken period means one bond is paying interest on March 31, September 30. If I am doing my discounting technique, I can value the bond only on March 31 or on September 30 because I want the number of periods to be a whole number. If I ask in how many half years will pay interest, you have to tell me 1 half year. You can't be saying in another 0.5 half year will pay the interest. That 0.5 our notebook can't handle, because if I am on April 1, in another 1 half year interest will come. Second half year again interest will come. Third half year interest will. But if I am in the month of August, in 1 by 6, in 1 by 6 of the half year interest will come. 1 by 6 of the half year interest will come, which our formula can't handle. So it says if it's broken period, you want June 30. Before June 30 is March 31. Do the valuation on March 31 and add the amount of accrued interest. Add the amount of accrued interest. Add the amount of accrued interest to which number? March 31 number. March 31 number, add the amount of accrued interest and get June 30. Accrued interest 3 months. July 31 you want 4-month accrued interest. August 31 you want 5-month accrued. September 30 no accrued. September 30 do valuation normally. Do valuation normally, because on the interest paying date you can do normal valuation. Non-interest paying date you will have to add the amount of accrued interest. Realized yield. Generally we do YTM using the cash flow of the bond. Realized yield says use the cash flow of the investor. What is the difference? The difference is bond is paying us. We are not using it. We are reinvesting it. We are reinvesting it. So bond pays minus 100, 10, 10, 120. This is called YTM if you use this. what I do is this 10 is 0 for me because I did not take the money. I did not take the money. This 10 is also 0. This 10 is also 0. All this I reinvested and I got 170. I got 170. At what rate I reinvest? At the cost of capital, something they'll give a reinvestment rate. If you calculate IRR for this, it is called realized YTM. And if you calculate IRR for this, it is called normal YTM. This is called normal IRR. In IFM question, this is called modified IRR. This is called modified IRR. We had one question where I did not explain. This is called modified IRR. Now, my normal YTM 10%. If you reinvested more than 10%, your realized YTM will be 11, 12, 13, 14. If you can reinvest it at a higher rate, realized YTM will go up. If you reinvest it at a lower rate, realized YTM will go down. Realized YTM will go down. Realized YTM will go down. If you reinvest it at what rate? At the lower rate. At the lower rate, realized YTM will go down. Exact same rate, same realized YTM. Exact same rate, same realized YTM. So here I do my reinvestment. Reinvestment rate equal to normal IRR. Equal means both are same. Higher reinvestment rate, higher earning. Lower reinvestment rate, lower earning. Lower reinvestment rate, lower earning. Higher reinvestment rate, higher earning. Lower reinvestment rate, lower realized YTM. Duration. Duration basically is a measure of bond risk. It is a measure of bond risk. What you do? Year cash flow. Just give me a minute. Live online guys have some issue. Okay. For duration, we write year cash flow, EVF, DCF, and do year into DCF. Year into DCF. Total 5,000. Total 1,000. 5,000 by 1,000 is called duration. 5,000 by 1,000 is called duration. Or it is half year. Then 5,000 by 1,000, 5 half years is the answer. 5 half years is the. If it's quarters, put the total of the last column, total of DCF. Total of the last column and total of DCF. Year into DCF divided by total of the price. If it's a half yearly bond, half yearly calculation, quarterly bond, quarterly calculation. And if it's an irredeemable bond, it is called 1 plus YTM by YTM, because I can't be writing this. Irredeemable has no end. Irredeemable has no end. So I need a shortcut. The shortcut is 1 plus YTM divided by YTM. Purpose of doing duration is to calculate volatility. Duration divided by 1 plus YTM is called volatility. Duration divided by 1 plus YTM. Let us first assume it's an annual bond. 7% or 7, just call it a 7. If interest rate go up by 1%, price will go down by 7%. Price will go down by 7%. And if interest rate go down by 1%, price will go up by 7%. This is if it's an annual bond. It's a annual bond. If it's a half yearly bond, volatility is equal to duration in years. Duration in years divided by 1 plus half yearly YTM. The denominator will be half yearly YTM and multiply this with change in annual yield. Multiply this with change in annual yield. That is what is the annual interest change. Or you can do everything half year. Duration in half year divided by 1 plus half yearly YTM into the change in half yearly yield. Into the change in half yearly yield. And bond price and yield has inverse relation. Bond price and yield has inverse relationship. So with the duration, we do volatility. Volatility is equal to what? Duration divided by 1 plus YTM. Percentage change is equal to volatility into change in yield. Yield increases, price will fall. Yield decreases, price will increase. Yield decreases, price will increase. For a half yearly bond, duration in year, divide by 1 plus half yearly YTM into annual YTM change. Duration in half year, 1 plus half yearly YTM into the half yearly change in yield, both will give same answer for the final percentage change. Final, but denominator is 1 plus half yearly YTM. Denominator is 1 plus half yearly YTM. Okay, I have a duration calculated. High duration, high volatility, higher risk. High duration, high volatility, higher risk. If interest rates are going down, price will go up. If interest rates are going down, price will go up. Interest rates are going down, price will go up. Interest rate likely to go down, higher price, higher volatility, higher duration, higher profit. When interest rates are going down, invest in high duration bonds, invest in high and earn higher positive return. When interest rates are going up, price will go down. When interest rates are going up, price will go down. Lower duration, lower volatility, lower loss. Lower duration, lower volatility and lower loss. So if yield is going up, reduce the long duration bonds with the shorter, because I want to reduce the duration. When yield is going down, I want to increase the duration. I want to increase the duration. I don't want this duration headache itself. Then go through immunization. Go through immunization where duration of the portfolio is equal to investment horizon, is equal to investment horizon. You need money after 6 years, find a bond with a 6-year duration. Find a bond with a 6-year duration. Not able to find, take one 5-year, take one 8-year and do a weighted average. Take one 5-year and 8-year and do a weighted average. This is called immunization of the portfolio. Bond refunding. Bond refunding is basically a process of doing replacement decision. When I do replacement decision, there is a initial outflow, there is a in-between flow, and there's a terminal flow. Initial outflow will write capital expenditure, working capital, net salvage value of old machine. Similarly, old bond, I'll be paying lot of things. New bond, I will be receiving lot of things. So old bond, what you paid is outflow. If you have paid any call premium, that is also outflow. But everything related to old bond, write it off to P&L and get tax benefit. Write it off to P&L and get tax benefit. What will I write off? If any discount was there on issue of old bond, not yet written off. Any flotation cost, not yet written off. Any call premium which is paid. Any overlapping interest which you pay. Any overlapping interest you pay, all write it off to P&L and get tax benefit. When it comes to new bond, you will issue, some inflow will come, some flotation cost will be there, and there will be a net outflow. There will be a net outflow. There will be a net outflow. In between flow is equal to after tax cost of new bond, after tax cost of old bond of the last year. Old bond, go to last year and do the calculation. What is last year? Interest paid, tax saving on interest, tax benefit on amortization of flotation cost, tax benefit on amortization of discount. New bond, do the same calculation, find the difference. Find the difference. That is the saving every year. That is the saving every year. Step 3, compare the redemption value, mostly no change, and consolidate and calculate NPV. Positive NPV, go ahead with bond refunding. Negative NPV, reject the bond refunding. Negative NPV, reject the bond refunding. Positive NPV, go ahead with the bond refunding, and negative, reject the bond refunding. The discount rate will be given in the question, that is called after tax cost of debt, not given after tax cost of new debt. After tax cost of new debt. Outflow, these are the payments I'll be doing. Payment to bondholder, call premium, write off, overlapping interest, tax benefit. Inflow, flotation cost. Find out the net difference. Interim saving, compute cash flow of new bond and cash flow of the old bond for the last year. For the last year, find the difference. Any difference in terminal flow. Discount rate given after tax cost of debt, not given after tax cost of new debt. After tax cost of new debt. Then forward rates computation, I'm not discussing it because we did in FRA. In FRA, use the future value factor. But if cash flows are given in the question, PVF will be balancing figure. PVF will be balancing. PVF of year 1 is equal to 1 divided by 1 plus the first year rate. PVF of year 2 is equal to PVF of year 1 divided by 1 plus discount rate of second year. Discount rate of second year. Nature of yield curve. The yield curve can be of three types. Interest rates going up with the time. This is called normal yield curve. Interest rate going up with the time. First year, 1 year, lower interest, 2 year more, 3 year more, 4 year more. Interest rate going down with the time. Going down with the time is called inverted yield curve. Short term more, long term less. An indication of an upcoming recession. An indication of a upcoming recession. All are equal, flat yield curve. All are equal is called flat yield curve. Bond convexity. Bond convexity comes into picture because when I do duration calculation, generally the bond price as you change the discount rate, the bond price goes down like this. The bond price goes down. But what volatility says is bond price will go down like a straight line. Will go down like a straight line. Whereas in reality, it goes down like a curved shape. There is this gap. This gap is the problem in the estimation. This gap is the problem in the estimation. If you try any discount rate and put a graph, the graph will look like this. But convex or volatility says no, it will be a uniform fall. It will be a this gap will be bridged through a concept called convexity adjustment. Will be bridged through a concept called convexity adjustment. Will be bridged through a concept called convexity adjustment. Will be bridged through a concept called convexity adjustment. To calculate convexity adjustment, institute says calculate one higher discount rate price, one lower discount rate price, V plus V minus 2 today price divided by 2. Divided by 2 is the convexity adjustment. Divided by 2 is the convexity. What is volatility adjustment? Is volatility into the change in yield. Volatility into the change in yield. Convexity adjustment is just divided by 2. If you divide by V0 also, if you divide by V0 also, it's called convexity adjustment percentage. And if you divide by delta y 2 times, delta y means change in yield 2 times, that is called convexity. That is called convexity. Generally, I will calculate convexity and multiply with this denominator to get the convexity adjustment, ignoring the 2. Ignoring the 2. Just divided by 2 is called convexity adjustment. But generally, you calculate convexity and multiply with delta y, multiply with delta y, multiply with the price and get the convexity adjustment. We are saying no, let us divide by 2, get the adjustment, divide by price, get the adjustment percentage, and divide by delta y into delta y. Divide by delta y into delta y. This is called convexity. Almost done. Valuation of preference share, very simple. When you are valuing the preference share, if it is redeemable, year cash flow PVF DCF, irredeemable, interest by current market price logic, current yield equal to preference dividend by current market price. Preference dividend by market price goes to the other side and the formula comes. We also saw warrant. Warrant is nothing but a call or a put option. Now I can discuss here call or a put option. Warrant gives me the flexibility to buy the share. Gives me the flexibility to buy the share. Nobody can force me. Nobody can force me to buy the share. So warrant is equal to current market price. Do you want to buy at 50 when the price in the market is 80? You will say yes. 80 minus 50 is the value of the warrant. 80 minus 50 is the value of the warrant, but one warrant can give you 20 shares also. So multiply with the lot size. Multiply with the lot size. Multiply with the lot size. Convertible instruments, there is a term called conversion value, stock value. Conversion value means if I convert the shares today, what value do I get? If I convert the shares today, what value do I get value of the bond if the conversion is done today, current market price of the share into the conversion ratio. The conversion value is 100, but I'm paying 125. The difference is called conversion premium, which can be per bond. If you divide by the number of shares per share, divide by 100 or 125 percentage. Divide by 100 or 125. ICA generally divides by the conversion value. Divides by the conversion value. Current market price minus conversion value. Divide by ratio. Divide by CP by CV into 100. Then straight value or intrinsic value or floor value or minimum price, present value of future cash flow without the conversion option. Without the conversion option, do the calculation. Without the conversion option, do the computation. Downside risk means how much can the share fall, from how much the bond can fall from the current market price. It can fall down to the straight value. It can fall down to the straight value. This is called premium over straight value or percentage of downside risk. Percentage of downside. CMP of bond minus the straight value can be divided by CMP, can be divided by straight value to get the percentages. Conversion parity price means if I do conversion today, the current market price of the bond and the conversion value should match. Current market price of the bond and conversion value should match. It will match if the conversion value is equal to current market price, and conversion value has a formula called current market price of equity share into number of share. That price is called conversion parity price. The price at which I suffer no gain, no loss on conversion. I suffer no gain or no loss. This is also called minimum price or break even price. Minimum price or break even price. When I invest in a bond, I get interest income, which can be higher, than the dividend income, which can be higher than the dividend income. Interest income minus the dividend income of 10-15 shares is the favorable income differential per bond. Divide by the conversion ratio, favorable income differential per share. And with this favorable income differential, we'll calculate the premium payback period. We'll calculate the premium payback period. Premium payback period means conversion premium divided by favorable income differential. Conversion premium divided by favorable income differential. Favorable income differential. Then for doing convertible bond valuation, generally bond valuation is year, cash flow, PVF, DCF, write the interest. But last year value, higher of the two numbers. Higher of the two number. The first number is the redemption value as it is. The second number is you convert into equity. Convert into equity. For that you need the last day price. For that you need the last day price. How you calculate last day price? Some information has to be there. Some information has to be there to calculate the last price and take the higher. If you don't take the higher of the two and just take the redemption value, that is technically called straight value calculation. That is basically the straight value. Straight value means without conversion. Straight value means without. But if you take the higher of the two, that is normal convertible bond valuation. Normal convertible bond valuation. Once the valuation is done, I can also calculate the conversion parity price again. And if my current market price is greater than conversion parity price, I told you to change here. We will opt for conversion. We will opt for conversion. Otherwise, we will not opt for conversion. Otherwise, we are not going to opt for conversion. With this, my convertible instrument discussion is over. Another few points. Enterprise value. We had three types of enterprise value. One is called total enterprise value. Second is called your operating enterprise value. Third is called core enterprise. Enterprise value is equal to debt plus equity plus preference plus minority interest minus the cash and cash equivalent. From this, if you subtract non-operating, what is non-operating is not related to operations of the company, you will get the operating enterprise value. From there, if you subtract the non-core asset, you will get the core enterprise value. Institute talks about three, but generally one only we calculate. With the enterprise value, we can also do valuation using two approaches: EV to EBITDA multiple or EV to sales multiple. In business valuation, we have used so many multiples. We did PAT multiple, we did your book MB to BB multiple. Like that, here you have EV to EBITDA multiple and EV to sales multiple. Calculate for other companies and use that multiple for our company. Use that multiple for our company. Calculate for proxy company and use it for our company. And the inverse of EV to EBITDA, the inverse of EV to EBITDA is EBITDA by EV. EBITDA is technically called cash return. EBITDA is technically called cash because EBITDA depreciation is not subtracted. And EV is the overall investment. So inverse of EV to EBITDA is called cash return on total investment. Cash return on total investment. Inverse of EV to EBITDA is called what? Cash return on total investment, because EBITDA is the numerator, EV is the denominator. EBITDA is the numerator, what I get back by what I give. What I get back by what I give. Last part, money market instrument. First, they will ask you to calculate yield. Yield calculation is very simple. What I get back minus what I give divided by what I give, maturity value minus the investment value divided by investment value into 365 generally by number of days. In this, issue price can also become balancing figure, or this can also become balancing figure. I calculated the yield. Yield is 8%, but this is compounded quarterly. This is compounded quarterly. My effective income can be more. What is effective income? Is 1 plus 8% divided by 4 times compounding power 4. 4 times compounding power 4. Half yearly divided by 2 power 2. Divided by 2 power 2. Annual compounding, nothing to be done. Divided by 1 power 1. So if the frequency is higher, for example, it's monthly compounding, divide by 12 power 12 and earn more. Divide by 12 and power 12. Divide by 12 and power 12. That is called rate of interest. 1 plus R by N power N. R by N power N. When I invest in one of the instrument called commercial paper, there are certain other expenses incurred. Like there can be a stamp duty, there can be a rating charges. So here what institute says is add up all the expenses you add together, divided by the money raised on day 0. Divided by the money raised on day 0 into 12 by M into 100. In the money raised on day 0, I can have something called as compensating balance. What is compensating balance? Is I raised 20 lakh, but not able to use 3 lakh in that. Not able to use 3 lakh because bank is saying keep it in the bank. Keep it in the bank. You can't withdraw that. You can't withdraw. So I'll be paying interest on 20 lakh, but my denominator is only 17 lakh. My denominator is only 17 lakh. This is one way of increasing the income of the bank. Increasing the income of the bank. And the last part we learned is clean price and dirty price. This is very important, has been tested multiple times. Repo transaction. What is repo transaction? Is either a bank borrows from RBI or RBI borrows from bank. Repo rate is the rate at which bank RBI gives the money, and reverse repo is the rate at which the RBI takes the money. So I have invested in 12% Government of India bonds. I am in sudden need of money. I go to bank B. Technically, in the practical, you will have to go to RBI. You will have to go to RBI, and to the RBI, you give this bond as a financial security, and RBI gives you a loan at 5%. RBI gives the loan at 5%. Repay the loan along with interest. Repay the loan along with interest. In the context of this, there are 2-3 terms we need to know. One is called clean price. Clean price means price without accrued interest, which is 95. Accrued interest will be considered at 12% on GOI bonds. 12% on GOI bonds. 12% on GOI bonds. So including accrued interest, it is 105. I am giving 1 lakh bond. So other party has to pay me 105 into 1 lakh. He may subtract 2-3% as margin. Margin means he doesn't want to give me full amount. 105 into 1 lakh into 1 minus the initial margin. Let us assume he gave a loan of 1.02 crore. You have to repay 1.02 plus 5% interest. Plus 5% interest. Clean price value without accrued interest. Dirty price add the accrued interest at 12%. At 12%. Start proceeds number of security into the dirty price into 1 minus initial margin, and end proceeds at start proceeds plus the interest at the repo rate. Interest at the repo rate. Clear? Any doubts in this? A very big chapter. We have completed it. Now I've reached a stage where I think my throat will not support. So I'm ending at this stage. Other chapters, I have a old recording. That is the old videos are there. So you see that, but almost completed. I'm not able to speak now. So we will just end with this. Almost done. Good number of chapters. Keep preparing. Keep revising. That is the only thing I told yesterday. Keep doing it. I'm ending with this now. Thank you, friends. Okay, now we proceed to chapter 3, which is on advanced capital budgeting. Let's quickly cover the concepts of the capital budgeting chapter. Now, there are 6 techniques of capital budgeting. The first technique is payback. In payback, we do year, cash flow, cumulative cash flow. We capture the information like this, and the payback is computed as base year plus the unrecovered cash flow of base year divided by cash flow of next year. So at home also keep telling with me, keep participating. Base year plus the unrecovered cash flow of base year divided by cash flow of next year. The second technique we had was discounted payback. Under discounted payback, we also need to consider time value of money into the analysis. And for doing this, we write year, cash flow, PVF, DCF, and CDCF. You will have to discount and write the cumulative value of the discounted cash flow. Formula remains same. Discounted payback is equal to base year plus unrecovered discounted cash flow of base year divided by discounted cash flow of next year. And the meaning of the base year is the last year in which the cumulative cash flow is negative. NPV, I think most of us are aware of this, which is nothing but PV of inflow minus the PV of outflow. You just need to subtract. PI, otherwise called as benefit cost ratio, PV of inflow divided by PV of outflow. Inflow divided by outflow. And one technique which is on profits, which is called ARR technique, which is average profit from the cash flow. I will subtract depreciation, get the profit figure. Subtract depreciation and get the profit figure. Average PAT divide by average investment or initial investment. You can keep going through the concept book. I'll show it in the concept book in some time, where average investment is equal to opening plus closing investment by 2. Opening investment is what you pay on day 0. Closing is equal to salvage value or scrap value. Salvage value or scrap value. So these are the techniques we have: payback, discounted payback, NPV, PI, ARR, and IRR technique. Payback, time taken to recover the initial investment, ignoring the time value of money. Base year plus unrecovered cash flow of base year divided by cash flow of next year. We just need these 3: year, cash flow, cumulative cash flow. Discounted payback, considering the time value of money. Unrecovered DCF divided by DCF of next year. Both the techniques, lower the better. NPV, inflow minus outflow. Higher positive NPV is better. PI, inflow divided by outflow. PI has different names: profitability index, benefit cost ratio, present value index method, or the desirability factor method. Multiple names are there as far as the technique is concerned. Then accounting rate of return, PAT divided by average investment, or PAT divided by initial investment. Initial is what you invest on day 0. Average is opening plus closing by 2, and closing is equal to salvage value. Then we saw IRR technique, which is the 5th technique. For IRR technique, I need to find out at what discount rate are we going to get 0 NPV. To do this, we write year,
cash flow, PVF at some rate, DCF, again PVF at some rate, and DCF, year cash flow, PVF at some rate, discounted cash flow, PVF at another rate, discounted cash flow, get one positive NPV and one negative NPV, and the formula is your interpolation. L1 means lower discount rate, NPV at lower discount rate divided by NPV at lower minus NPV at higher into the difference in rate. NPV at lower discount rate divided by difference in NPV into the difference in rate. This is how interpolation work. What rate do I start for discounting? Generally, below the question, they will give you a table which will have the discount rates. In case they don't give any table, which is rare, but if it is not there, we take 2 by 3. 2 by 3 of ARR on average investment. 2 by 3 of ARR on average investment could be my initial guess rate to compute the NPV. The starting rate would be 2 by 3 of ARR on average investment. Also, if there is only one outflow and one inflow, then you can use this formula. Future value is equal to present value into 1 plus R power n. And if it's a perpetuity, you can use the perpetuity formula, which is your Gordon's formula. P naught equal to CF1 by KO minus G, KE minus G. That KO or K is technically like the IRR. What discount rate do I use for the project? The discount rate we generally use in CA Inter is cost of capital. Here at final, let us understand that there can be a COC for the project, and that is computed based on asset beta of the project. If the project has a specific discount rate, cost of capital specific to the project and not to the company, and the cost of capital can increase or decrease, like we have step up or step down discount rate when we did bond valuation. Similarly, here the discount rate can change, and if there is a change in discount rate, PVF of year 2 is equal to PVF of year 1 divided by 1 plus the new discount rate. Keep participating with me. Then rules for computation of cash flow, certain rules. Depreciation, non-cash item, will not impact cash flow, but if there are taxes, there will be tax benefit. So relevant because of the tax benefit, and irrelevant if taxes are not there or taxes are exempt. Opportunity cost of benefit foregone. I am taking this batch of classes. Because I take this batch of classes, I lose the opportunity of doing my office work and I lose some income. That is called opportunity cost. If the opportunity cost is given before tax, consider it in PBT calculation. If it is given after tax, or if it says opportunity cost post tax, consider it post the PAT. Sunk cost or historical cost are those costs which have already been incurred, whether paid or not, ignored in the cash flow analysis. Examples are market survey expense, R&D expense, which are already incurred, ignored in the analysis. Overhead cost, allocated, apportioned, general, corporate, all these overheads are irrelevant. Anything specific or incremental for the project, consider it in the analysis. Working capital is the money blocked for day-to-day operations of the company. Initial working capital, initial outflow. Increase in working capital, in between outflow. Decrease in working capital, in between inflow, and the entire amount comes back in the last year as recapture of working capital. Outflow in year 0, outflow in between years, inflow and inflow in the last year. Reward exclusion principle basically says, for doing our NPV calculation, we use cost of capital as the discount rate. Cost of capital is computed using cost of debt, cost of equity, and cost of preference. So whatever interest you pay, whatever equity dividend you pay, whatever preference dividend you pay, whatever cash flow you give to the providers of money, whatever cash flow you give to the providers of money, ignore the same in the analysis. Ignore interest, preference dividend, and equity dividend in the analysis. Incremental principle basically says that when I am doing a project, see what is the cash flow with the project, what is the cash flow without the project, with the project, without the project, and find the difference. That difference is called incremental outflow or incremental inflow. Incremental outflow or incremental inflow. We did use this in bond refunding, old machine cash flow, new machine cash flow, and the difference was considered. Next, these are the steps we follow. First, there is an initial outflow. That is the outflow at the start of the project. Generally, two items: capital expenditure, working capital. But sometimes we may pay extra item like some compensation is given, or some advertising expenses are incurred, or some extra expenses are incurred, which are paid on day zero. Paid on day zero. So some extra items can come like installation charges, compensation. Also, if you are buying the machinery and not making full payment, if you have not made full payment, only the amount which is paid will be part of initial outflow. The unpaid part will go to step 2. Step 2 is in between flow, where I consider extra revenue, extra revenue, then we consider cost saving, then we subtract cost additional incurred less depreciation, extra revenue, cost saving, extra cost, depreciation. You will get PBT, deduct tax, PAT. After the PAT is done, add back depreciation. After depreciation is done, I can have increase in working capital is an outflow, decrease in working capital is a inflow. If you purchase additional machine, purchase additional machine, and if some payment was pending for original machine, payment was pending for original machine, consider all of this and you will get the CFAT number, cash flow after tax. You will get the CFAT number: incremental revenue, cost saving, all cost other than depreciation, PBDT, depreciation, PBT, tax, PAT, increase or decrease in working capital, purchase and payment. Step 3 is our terminal flow. We have two items. One is NSV, second is recapture of working capital. NSV is comparing the sale value. So we have sale value 10 lakh, book value 8 lakh. The difference is capital gain, in this case 2. Pay tax on this 40%, 0.8. And NSV is sale value plus or minus tax. Sale value, if you pay tax, subtract it, and if you save tax, add it. 10 minus 0.8, 9.2. Recapture of working capital, whatever money was blocked will come back, and we consolidate all of this together and put it in step 4, year cash flow. Let's assume it's a 5-year project. Year 0 is step 1 figure, year 1, 2, 3, 4 is step 2, and last year is step 2 plus step 3. After this, you want payback, add CCF column. You want discounted payback, year cash flow, PVF, DCF, CDCF. Depending on what is needed, we generally compute only NPV, year cash flow, PVF and DCF. Then asset purchase at beginning of the year. Capital budgeting generally assumes that any purchase will only happen at the end of the year, or any cash flow will only happen at the end of the year. But if some question says that I buy an additional machinery at beginning of year 5, we consider that as end of year 4. End of year 4. Impact of losses. If you are making losses, three things can happen. Profit making company. If I am a profit making company, loss will give me tax saving. Tax saving in year of loss. If I am a profit making company, I will have a tax saving in the year of loss and add that in the tax saving number. Add the same in the tax saving number if you are a profit making company. If you are loss making or there are no details on profit, two things can happen. One is no carry forward, no tax benefit. If you do not have carry forward option, you will not get any tax benefit. Second option, you can carry forward and reduce future tax payment. Reduce the future tax payment. What you pay in the future years. For example, I made a loss of 20,000 in year 1, no payment, no saving. Year 2, I made a profit of 40,000. Profit will be 40, but tax will be paid only on 20,000. Tax will be paid only on 20,000. And if there is a tax exemption for some specific percentage, then what you can do is calculate something called as effective tax rate, where normal tax rate multiplied with 1 minus the exemption percentage. 1 minus the exemption percentage. This will give us the effective tax rate, and consider that effective tax rate in the analysis. And if you have not paid any expenses in the year of incurrence, if at all you have not paid any expenses in the year of incurrence, then very simple. What you have to follow is accrual concept till PBT. Accrual concept till profit before tax, pay tax, and then after PAT, add back item which was not paid and deduct item which has really been paid. Add back amount which was not to be deducted. Not to be deducted means you did not pay it, and deduct amount which has been paid in that specific year. Subsidy, if I'm getting any government grant, the grant is of two types. There is a capital and there is a revenue. Revenue can be of two types: taxable, exempt. Exempt means before PBT in the step 2, and this is after PAT. Taxable means after PAT, exempt is before PBT. Capital part, adjust, not adjust. What is adjust and not adjust is whether you can adjust it with the cost of the asset, not to adjust with the cost of the asset. If you are not adjusting, then you can claim higher depreciation. The capital subsidy will be a year 0 inflow, but you may adjust it with the cost of the asset. You may not also adjust. If you are not adjusting, higher depreciation, and if you are adjusting, it will lead to lower depreciation. Till this was CA inter part. Utility value, this is not a very logical item. What ICA says is cash flow 10, 20, 30. This is utility value minus 10, 25, 45. Some logic of giving utility value. Probability will be there for this. Do a weighted average utility value. Do a weighted average utility value and select the project which has higher weighted average utility value. Higher weighted average utility value. Abandonment decision means, should I sell my existing machine? Two option: sell today, earn NSV today, NSV of 2 lakh. You have to do sale value less book value, capital gain, capital loss, tax paid, tax saved, NSV. Or use and sell after 3, 4, 5 years. If you use, you will be getting every year inflow. At the end of the life, some terminal inflow will happen, and the total of this, the present value is 2.5 lakh, which means continuation is better. Continuation is better. Abandonment means we are thinking whether to sell the machine today. If you are selling, compute the cash flow today. If you are using, compute PV of all the cash flow by using the machine and then selling it. Using the machine and then selling it. If continuation gives more inflow, that is better. Sale gives more inflow, that is better, and abandon the mission. Abandon the mission. Next comes replacement decision. First, there's a type 1 problem. In replacement, type 1 means I am deciding whether a replacement is needed or not. Step 1, initial outflow. Here you will have capital expenditure, working capital, NSV of old machine. You will sell the old machine. Step 2 will be in between flow. In between flow, you will do new machine separately, old machine separately, and find the difference. That difference is the in between flow. It will be new minus old. Step 3, terminal flow. In terminal flow, again you will do new, old, news NSV, old's NSV, news working capital, old working capital, and find the difference. Find the difference. Always new minus old. Once you find the difference, so step 1, initial outflow, sale of old machine, new minus old, and consolidate and calculate NPV. NPV positive, go ahead with replacement. NPV negative, reject the replacement decision. There are other two types. One is deciding whether to replace. We have analyzed it. Deciding on optimum life. What is optimum life is type 2. I have a car. This is regular use for me. Regular use. So here car has a life of 3 years. Buy and use for 1 year. Buy and use for 2 year, buy and use for 3 year, and then sell it. Buy, use, and then sell it. Write the cash flow, get EAB, EAC, get EAB or EAC. By every machine will have a year 0 outflow. It will have a year 0 outflow. You will have to buy. You will have to buy. Even if it's available in the company, then also we are buying a new car using for 1 year, new car using for 2 year, new car using for 3 year. Whichever has better EAB or EAC is a better machine. Type 3, I already have a car. It is irregular use. When should I replace? If I replace today, you will have sell, buy, and then use. Sell the old car, buy the new car, and then use whatever life it is. Then replace year 1. Say use for 1 year. The old car has to be used for 1 year. Then sell, buy, and then use new car. Similarly, replace year 2. Use old car for 2 years. Sell, buy, use the new car. The life will be different. We may use a EAB, EAC concept to make them comparable. Type 2 problem. An asset has a life of 3 years. Compute cash flow NPV if machine is purchased and sold in 1 year, 2 year, 3 year. EAB, EAC. Type 3 problem. An existing asset has a balanced life. So you will have to calculate cash flow. In a type 3 problem, we already have the asset. So sometimes we may not have year 0 outflow. If I am buying a new car on day 0 and selling the old car, I will have an outflow. But if I'm replacing year 1 or year 2, year 0, no outflow in type 3 problem, but there will be outflow in type 2 problem. Okay, then EAB, EAC concept. EAB, EAC is done to compare projects with different life. EAB is equal to very simple, NPV divided by present value annuity factor, R comma life. R is the cost of capital, and here it is PV of outflow, because majorly outflow are there. PVAF, R comma life, higher EAB or lower EAC. Then we had an approach called FCFF and FCFE approach. More about FCFF and FCFE we discuss in business valuation. Concept is very simple. If you are using FCFF cash flow or FCFE cash flow, FCFF cash flow gives project NPV gives project IRR discounted at KO. This gives equity shareholders NPV, equity shareholders IRR, and discounted at KE. FCFF, FCFE discussion is in the business valuation. Project NPV, project IRR, equity NPV, equity IRR, KO discounting, KE discounting. Then adjusted present value approach, we generally do not club two decisions together. What are the two decisions? Investment decision, financing decision. Investment means deciding whether to invest money or not. Financing means where the money is going to come from. Whatever problems we have done, we never thought where the money is coming from. APV approach says no, think where the money is coming. APV says first calculate base case NPV. Base case NPV means NPV with KE. NPV with KE, and assuming it is fully equity funded. Assuming it is fully equity funded. Then consider debt saving. Because of the debt, there are two savings. What are the two savings? Tax saving on interest and the interest saving itself. In case you get a lower interest, there's an interest saving. These two are discounted at pre-tax cost of debt. Discounted at pre-tax cost of debt. And the third part is issue cost or flotation cost. So base case plus this minus this. Any issue cost you incur, reduce it from the NPV. PV of debt financing benefit, lower interest, tax saving, pre-tax cost of debt, final NPV, base NPV plus the debt financing benefit minus issue cost. Most of the time base NPV could be negative. Base NPV could be negative. Debt financing benefit will make it positive. Inflation in capital budgeting. Inflation basically says there are two types of cash flow: nominal cash flow, real cash flow, and the link between them is nominal cash flow is equal to real cash flow into 1 plus inflation rate power n. 1 plus inflation rate power n. Nominal cash flow should be discounted at nominal discount rate. Real cash flow should be discounted at real discount rate. Keep participating so that you get more comfort. Nominal discount rate, real discount rate. Nominal cash flow, nominal discount rate, real cash flow, real discount rate. Use the real discount rate, use the nominal discount rate. Also, we had a discount rate understanding. 1 plus nominal discount rate or money discount rate is equal to 1 plus real discount rate into 1 plus inflation rate. 1 plus inflation rate. And one more point we need to be aware: the depreciation is always a nominal value. What is nominal value? Is one which is recorded in the books of accounts. So nominal cash flow, if you're following a real discounting, depreciation has to be discounted to the real value. We did see in one of the question. Okay, expected value standard deviation. Expected value can be for anything. Expected cash flow, weighted average of the cash flow with the probability being the product. You can do it for NPV, NPV, probability, product. So expected value can be for anything. After the expected is calculated, you do deviation PD square, that is standard deviation. That is the standard deviation what we saw in portfolio chapter. And there's a coefficient of variation. If the standard deviation is calculated for cash flow, numerator is expected cash flow. Coefficient of variation is risk per unit of return. Standard deviation numerator, standard deviation of cash flow, expected cash flow. Standard deviation of NPV, expected NPV, risk per unit of return, risk per unit of return. And for doing expected NPV, we have two approach. One approach is weighted average of various NPV. Various NPV means you have to calculate multiple NPV and then do a weighted average. The other option for expected NPV is get one expected expected cash flow every year by doing weighted average. Get one expected cash flow every year. Get one expected cash flow every year and get one expected cash flow every year and do one NPV. This approach is followed if they ask for base case, best case, worst NPV, multiple NPV. If you want, you follow weighted average. You follow weighted average. Compute different NPV and take weighted average, or compute expected cash flow and compute one NPV. This approach is followed if I want two standard deviation. What are that? Let us understand. If the question asks standard deviation, one approach of doing standard deviation is this: NPV, probability, product deviation, PD square. But this will give you only one standard deviation. In the practical world, there are two types of cash flow. One is called dependent, second is called independent. Dependent means when I write my CA exam, performance in second exam is dependent on what happens in the first exam. Performance in third exam depends on what happens in the second exam, which is not logical, because I may do well in one paper, I may not do well in the other paper. So they are independent scenario. That is technically an independent scenario. What is independent scenarios? Performance in second exam not dependent on what happens. But if somebody says it is dependent because I'm not able to concentrate because of some exam, my first exam did not go well. If it is dependent scenario, then second exam performance is dependent on first. So dependent cash flow means what happens in first year will influence second year, and independent means what happens in second year is not influenced by first year. Here we have to calculate every year standard deviation. Every year standard deviation. How will we calculate every year standard deviation? Cash flow, probability, product deviation, PD square. Then do PVF, then do discounted standard deviation and square this number. The total of this, let's assume this is 2 years only, 16, and this is square 64, 64, 128, and square root of this could be around 11 something. This is standard deviation if cash flows are dependent, and this is lower standard deviation if cash flows are independent. Independent is little less risky. Compute SD of every year, sum of discounted SD, SD of every year, discount them, take a square and take a square root. Take a square and take a square root. If they are asking for probability, dependent cash flow probabilities, what happens? What is the probability of the first year? Independent first year power the number of years. Independent means it may not continue in the same manner. So first year probability power the number of years is the independent cash flow NPV. Then RADR basically says use different discount rate for different project. The discount rate can be risk-free rate plus risk premium, or the discount rate can be based on standard deviation, based on coefficient of variation. That mapping can be there, or you can use our formula RF plus beta into RM minus RF. Beta is called risk index, RM is called normal discount rate, and RF. CEF approach says, there's another approach called CEF approach where year uncertain cash flow, CEF certain cash flow. What is uncertain is what we generally write. If generally I'm writing minus 10, 2 lakh, 8 lakh, there will be the first year 0, there is no certainty equivalent factor directly. There will be a factor saying that 0.8, 0.6. I'm only 80% confident on this number. So multiply the 2 and write the cash flows only 1.6. Multiply the 2 and write the cash flow only as 1.6. The number will go down. You convert your uncertain cash flow into the certain cash flow. Certain cash flow is equal to uncertain into certainty equivalent factor. And we discount this at risk-free rate. We discount this at risk-free rate and get the NPV. If I want to link both the technique RADR and CEF, if I want to follow an RADR for a CEF question, add the CEF. Whichever has lower CEF, has lower confidence, more risk, more RADR. More risk and more RADR. Sensitivity analysis means changing one parameter at a time and finding out the impact on NPV. So what we measure here is sensitivity percentage is equal to new NPV minus the old NPV divided by the old NPV. How much is the percentage fall which we are having? If selling price fall by 10%, cost price increase by 10%, sales volume decrease by 10%, some uniform percentage and impact on the NPV. One with the maximum fall, is the most sensitive parameter. Second approach is safety margin concept. Safety margin means where do we have maximum cushion? Where do we have maximum cushion? Here we find at what, let us take selling price, NPV will become 0. NPV will become 0. And the percentage again here is new selling price, old selling price divided by old selling price. How much safety cushion is available? The lowest cushion is the most sensitive parameter. The lowest cushion is the most sensitive parameter. Scenario analysis means making more than one changes at a time. Impact on NPV due to changes in multiple factors. Next part, decision tree. Decision tree is putting a situation in a diagrammatic form where we start with a rectangle which can go as yes, no. After yes, it could be a circle. Circle will have probabilities coming from it. Wherever it is a circle, probabilities will come. Circle is called as a chance node. This is called a decision node. Draw like this, value in the reverse order. Value in the reverse order. Wherever it is a circle, weighted average of the value. Wherever it is a rectangle, highest of the value, highest of the branch starts with the decision, highest, circle, weighted average, drawn from left to right and valued from right to left. And if there are probabilities there, use the joint probability. What is joint probability? Is probability of event 1 into the probability of event 2. Draw like this, value in the reverse order. And the last part is simulation, which is useful for a complex project where there are a lot of uncertainty. Run the experiment million times to find out what will be the expected performance. Here two things you have to identify. One is parameter. Parameter means one which can't change. For example, outflow of the project, life of the project, tax rate. I feel these three can't change. Then variable. Variables are those which can change, like selling price, cost price, variable cost, fixed cost. We do a random number 2-digit table. Random number 2-digit table. You'll have to fix a random number table, find out a rate from the random number table, get that variable, calculate NPV once, twice, thrice, 4, 5, and a simple average of the final experiments is the final NPV. Ideally, you will have to use the risk-free rate. Ideally, we'll have to use the risk-free rate because risk is measured separately and the return part is measured separately. Here, the focus of the second segment of the chapter was fully on the risk, and many places we use risk-free rate for the purpose of discounting. Risk-free rate for the purpose of discounting. With this, the simulation part is over. If there are any doubts on this, you can send me a message on the same. Thank you. Okay, we now move to business valuation chapter. Here we focus on valuation of a normal company, a distressed company, startup, and one special area called economic value added. Let's quickly discuss. EVA is basically the excess value generated by the company on a yearly basis. The computation is NOPAT or EBIT into 1 minus tax rate and subtract capital employed into WACC. Capital employed into WACC. The capital employed will be as per the replacement cost basis. That basically means I can do revaluation of assets and liabilities for computation of the capital employed figure. EVA is to calculate a overall performance and effectiveness. EBIT into 1 minus tax rate or NOPAT, invested capital into WACC. Capital employed is basically debt plus equity plus preference, or you can say total assets minus the current liability. it should be based on economic value. Economic value means replacement cost of the assets or the real value of the assets. Second point, market value added, which is another metric as compared to EVA. But MVA technically can be done in two ways. One is for the firm, second is for the equity shareholder. This is not fully covered in the book. For firm, we use market value of firm minus book value of firm. What is firm values? Debt plus equity plus preference. And this we use MV of equity minus BV of equity, market value of equity minus the book value of equity. Book value is share capital and reserves and surplus, and market value is whatever is the value in the stock market. Generally, market value added from an equity shareholder's point of view only come. The debt and the preference, guys, book value and market value will almost be same. So you can either do firm level or equity level. Preferable to do both in case there are difference in the two approach answer. EVA dividend. EVA is the excess generation by the company. So this can be freely paid. This can be freely paid to the shareholders of the company without any impact on the valuation of the company. Without any impact on the valuation of the company, you can go ahead and pay the EVA dividend. So excess generation can be enjoyed by equity shareholder. If you pay the EVA dividend, share price will not get impacted. And if you do not pay, more reserves, more capital, more earning and higher growth and higher value in future. Next point, how do I calculate WACC? For WACC, we have source, cost, weight, and product. We'll have debt, equity. This has to be after tax if there is a tax rate given in the question. And equity, we will have to do KE calculation, D1 by P0 plus growth rate, or RF plus equity beta into RM minus RF, and then go ahead and do the weighted average. Your cost of debt can be interest into 1 minus tax rate or interest into 1 minus tax by value of debt into 100. Then P multiple adjustment. The P multiple depends on risk. If there is a high risk, you will have low PE. High risk will have low PE. Risk can be measured through business, financial. Business risk depends on what the business the company is doing, what is the market share, what is the market size, all that which we can't evaluate. Financial risk is evaluated through one ratio called debt equity ratio. So if you are having higher debt equity, you carry higher risk and you will ultimately have a lower PE multiple. Ultimately, you will have a lower PE multiple. EVA adjustments, there are certain adjustments which EVA talks about. Advertising, R&D, staff training, treat it as an asset, add it to the EBIT, deduct the amortization on this item, and the net amount to be added to capital employed. We have two types of depreciation, accounting depreciation and economic depreciation. Add back the accounting depreciation, deduct the economic depreciation. Add back the accounting, and for capital employed, add back cumulative accounting depreciation, deduct cumulative economic depreciation. Some non-cash discretionary item like provisions, add back 1 year provision to the P&L and add back the cumulative amount to capital employed. Coming to the tax treatment can be done in three ways. First way, you can say EBIT into 1 minus tax, adjusted EBIT. You have to use adjusted means with those adjustments. Or you can do PAT and add back interest net of tax. Add back interest net of tax. And the third option we have is from EBIT subtract cash taxes. Cash taxes means tax which has been paid, and also subtract tax foregone on interest, because interest is not there, so you will forego a tax part on that, and that also has to be subtracted. Cash taxes, tax foregone on interest, PAT plus interest net of tax. Financial leverage, we learned at CA Inter, that was used in one of the questions. So financial leverage formula we need to aware, EBIT divided by EBT minus PD divided by 1 minus tax rate. Then there are multiple valuation approaches. This heading is wrong. Multiple valuation approaches. Will go one by one. First is cash flow based. In cash flow, I have two types of cash flow. One is called FCFF. Second is called FCFE. In FCFF, ignore all cash flow between company and equity shareholder, preference shareholder, and debenture holder. That is equity dividend not to be subtracted, preference dividend not to be subtracted, interest on long-term loan not to be subtracted, any equity buyback done not to be subtracted, any shares of equity shares issued not to be added, any preference shares issued not to be added, redeemed preference share not to be subtracted, any cash flow between company and these three people. Here any cash flow between company and only equity shareholder. So in FCFE, interest will be subtracted, repayment of loan will be subtracted, preference dividend paid will be subtracted, preference shares issued will be added, loans taken will be added. FCFF is discounted at KO and this gives you firm. This is discounted at KE, gives you equity. This is our preferred approach. Ideally, if the question is drafted properly, you can do this, subtract debt, preference, and get equity. Or you can do this also and add the debt and preference and you can get the firm value. Both should match if the question is drafted properly. Of late, they have been testing this a lot. FCFF, cash flow belonging to all long-term money providers, only to equity. KO, KE, value of firm, value of equity. In FCFF, I start with PAT, add back depreciation, add back interest net of tax because interest should not have been subtracted, and deduct capital expenditure, working capital. If we are doing FCFE, from the PAT, add back depreciation, add back capex, add back working capital, not adding back interest, and maybe loans repaid and new loans taken. Then when I calculate my cash flow, I will have something called as capital expenditure. There are two types of capital expenditure. One is called gross capex, second is called net capex. Gross capex is the increase in gross block, net capex is the increase in net block. Net capex is the gross capex adjusted for the depreciation. Gross capex adjusted for the depreciation. So when you do your cash flow, you can add back depreciation, deduct gross capex, or deduct directly only the net capex. Deduct only the net capex, only the net capex. Working capital, increase in working capital is outflow, decrease in working capital is inflow. Increase in working capital is outflow, decrease in working capital is inflow. This is as far as cash flow is concerned. Okay, another point is I am trying to acquire a company. When I acquire a company, I look at their balance sheet. They will have equity, preference, debenture, current liability, fixed assets, current assets, debtor, inventory, cash. When I acquire a company, my purpose was to only get the fixed asset. So here we do it like a capital budgeting problem where whatever you pay to these guys in cash or other than cash means giving some shares or something, or outflow, you sell all of this, get some inflow, and this net amount is initial outflow. The net amount is initial outflow. In between flow will be given in the question, terminal flow will be given. Calculate NPV. NPV positive, go ahead with the acquisition. NPV negative, reject the acquisition. The purpose was not to acquire the company, the purpose was to acquire their fixed assets. Point number 14, breakup value approach. This is also called SOTP, sum of the parts valuation. Breakup value means break the business into business 1, business 2, business 3. This can be PAT into PE. This can be sales into sales multiple. This can be book value into MV to BV multiple. Some multiple will be there. Value all the three businesses separately, add them together and get the overall value. You can value them using multiple or Walter, Gordon, any approach of valuation. Club them together and get the overall value. Club them together and get the overall value. Next is relative approach of valuation, one which is used for all scenario, normal company, distressed company, startup, consultancy firms, everywhere. In a relative approach of valuation, find out a basis can be, let's assume, EBITDA. Then take any other company value divided by EBITDA, any other company's multiple or industry multiple, or sales, other company value divided by sales, value divided by sales. You can take any other company's metric and use it here, relevant basis into the multiple. Future maintainable profit, FMP approach basically says, in the question you will have something called as a PAT given. This is called reported. Convert this into PBT, make adjustments. What are the adjustments? Minus extraordinary income, because this income will not continue. Add extraordinary loss, minus non-recurring income. So make all these adjustments, and this is called profit from old operation. Profit from old operation. And after this, add any profit from new product and get FM PBT, future maintainable profit before tax. Deduct tax, FM PAT, divide by capitalization rate, and get value of business. Value of business. This is also called earnings capitalization method, FM PAT by capitalization rate. Also, you can do another approach, get the FM PAT. From FM PAT, get FM EPS, and EPS into P multiple is the value of equity. EPS into P multiple is the value of equity. Net assets method and earnings capitalization method. Under the net assets method, we have various assets and liabilities, and we need to do the valuation of these assets and liabilities, make any adjustments if needed. Okay, sorry, we were discussing this net assets method. Write all the assets, all the liability, and do revaluation of assets and liability. All assets minus all liability except debt, equity, and preferences, value of firm. And if you deduct debt and preference also, you'll get value of equity. You'll get value of equity. Be little clear about what are you doing with contingent liability. If there are contingent liability, we may assume that contingent liability will crystallize or will not crystallize, and with that the answer can change. Contingent liability may crystallize or may not crystallize also. Assume in case the problem is silent. Earnings capitalization is the FMP method itself. Then, oh, okay, in one exam they asked a net cash flow approach. This is not a new approach, but specifically for that question we created this concept. Net cash flow with book value. Net cash flow approach is nothing but your FCFF approach. Value is equal to FCFF or FCFE divided by KO or KE. It will be FCFE because it's only for equity in that question. You get the value and get value per share. Second, book value approach means share capital plus reserves minus fictitious asset by number of share. This will give you one value. They'll ask minimum price. Minimum price is lower of the two. Minimum price is lower of the two. Question also asks max price. Max price is maximum consideration. Maximum consideration we learned in M&A chapter, which is value of merged firm minus the pre-merger value of acquiring company. This is the consideration divided by number of shares. And there is something called as a floor value. Floor value is the minimum possible value for a transaction to pass through, and that is equal to market price. That is equal to market price. This concept is specifically created for that one question. Wrong WACC. A question will say valuation is already done. They will have a wrong value which is equal to FCFF by KO minus G. This will give you wrong WACC. Put the wrong WCC as source cost weight product. This will give you wrong weights. Correct the weights, correct the WACC, and the correct value of firm will come. And the correct value of firm will come from there. Computation of per share earning value, not a very logical item. Follow whatever institute says. They've said enterprise value is equal to EBITDA by capitalization rate and divide this by number of shares. It's called per share earning value. When they tested in exam, they did not use the word per share earning value because institute identified that there is some gap in this term. Then funding required for growth. Whenever we are growing, there will be a need for extra funding. So prepare a balance sheet, fixed asset, current liability, equity, debt preference, one current year balance sheet, one next year balance sheet. Whenever there is a growth and if no extra information is there, if revenue growth is 20%, fixed asset will increase by 20%, current assets will increase by 20%, current liability will increase by 20%, and other items have to support the growth. That data will be given in the question. What will increase is only the operating current assets and current liability. Operating means related to the business. For example, I have a current asset called investments. This can't go up just because revenues are going up. Debtors can go up, creditors can go up, inventory can go up. In current liability, I have a short-term loan that will not automatically go up just because revenues are going up. So how much is the increase in these items and where is the money coming from is this concept called funding required for growth. Intrinsic value of equity using shareholder value added approach. Value of equity is equal to value of firm minus value of debt. This approach basically says get the value of firm, deduct the value of debt, but if there are any non-core assets which were not considered in the valuation, add that and increase the equity value. If at all some assets are there which were not added in the cash flow computation under the discounting cash flow approach, please consider those assets. What are non-core assets? Some old building is there, one old building not giving any revenue, not giving any cash flow. So automatically no cash flow, no value, because without cash flow worth is not there. But still, if I sell, I may earn some 2-3 CR. Consider that in the intrinsic value of equity approach. Distressed companies are those which are going through troubled time. They are not able to meet their fixed commitments. Could be they are not meeting interest obligation, are not able to meet their fixed cost, and the going concern assumption is not valid. So when it's a distressed company, the valuation has to undergo a little bit of change because it may or may not even continue, can have a higher discount rate, so ultimately leads to lower value. And if distress continues for a longer period, it can ultimately lead to insolvency of the firm. There are 4 methods of valuation. Modified discounted cash flow approach says do 3 scenario valuation. One is base case, optimistic case, pessimistic case, and do a weighted average. If you are not able to do scenario based valuation, do normal cash flow and adjust some of the cash flow, some years cash flow using 1 minus the probability of distress or probability of default. Adjusted cash flow is normal cash flow into 1 minus probability of distress. Method 2, liquidation value plus going concern value or DCF value plus realizable value. Going concern means company continues, get the value, multiply this with probability of survival, and the other value multiply with probability of default and do a weighted average. Probability of survival, probability of default, and do a weighted average. Third is APV approach, where do the going concern value and add the present value of debt financing benefit, like we did in APV approach of capital budgeting. If it is redeemable, get the interest discounted pre-tax cost of debt, irredeemable amount of debt into the tax rate, and deduct something called as bankruptcy cost. And this bankruptcy cost institute says GC value, liquidation value into the probability of default, into the probability of default. So the third approach is this: bankruptcy cost has to be subtracted in the calculation. Fourth approach, which we are aware of, which is your relative valuation, concept 15. But when we do relative valuation, we take the multiple of the industry as our multiple. Here you will have to adjust the multiple upwards or downwards. Adjust the multiple upwards or, sorry, not upwards, adjust the multiple downwards. Adjust the multiple downwards as the company is going through a distress situation. Sorry, adjust the multiple downwards. Next is startup valuation. For startup, we have one approach called Berkus approach. Here, institute says Berkus approach means some 5 parameters are there. Every parameter put a value. Every parameter put a value and total the value of each parameter: basic value, technology, execution, strategic relationship, consequences. When Berkus came with this approach, he valued every parameter as $500,000. So if you are earning revenue, all 5 are applicable. Not earning revenue, called pre-revenue, 4 parameter, maximum value 2 million and 2.5. This he gave. We can customize this according to our requirement. Cost to duplicate approach means add up all the cost incurred to create the startup till date, all related cost, and value of all cost together is called cost to duplicate. Comparable transaction approach is nothing but our relative valuation approach. Get the multiple for other companies. What multiple? You can get a multiple called value to sales, value to EBITDA, or let's assume I'm doing valuation of WhatsApp. I can have Facebook valuation, and there I can do value per user, any metric, and use that metric for our entity with or without adjustment. Scorecard valuation basically said you have to compare your company with another company and put a score on various parameters like Berkus approach, but compare yours with another company, put a score. Score can be more than 1, less than 1, or equal to 1. That is more than 100%, less than 100%, equal to 100%. Take a weighted average of the score, and the final value is equal to our score into the value of the other entity. Our score into value of the other entity. Team strength, size, product, better than peer, more than 100, weaker, less than 100, weighted average, and final score. First Chicago method is basically modified discounted cash flow approach of distressed company. Arrive at 3 scenarios valuation and do a weighted average of worst case, normal case, and best case. Venture capital method is basically introduced by the venture capitalist who invest in startup. Here we arrive at the exit value. Exit value is what will be the value of the startup after 5 years, 10 years, and exit value is equal to value after, let's assume, 10 years into the probability of survival, assuming it survives, because survival is also a doubt for a startup. That exit value is discounted to today, and we get today's post money value. Exit value is discounted to today, and we get post means post adding my money. Adding my money means venture capitalists are going to invest in the startup. So let's assume exit value is 100, or sorry, value after 10 years is 200, 50% chance 100, today discounted value is 60, and in this I am contributing 20. So pre-money value is 40. Pre means without my contribution. Estimate the exit value, discount to today, post money minus the amount invested today. This is on startup valuation. Then institute also has some discussion on digital platform. Digital platform are items like Amazon or Google, where they are trying to use online infrastructure to facilitate a transaction. You can either follow the cash flow based approach, discounted KE or KO, or you can follow market approach, which is relative valuation approach, EV to EBITDA, price to sales, price to book, or cost approach, which is adding all the costs together. Professional or consultancy firm, like a chartered accountancy firm, when you are valuing a professional or consultancy firm, it says you do the valuation as present value of future cash flow and make adjustment based on key performance indicator. KPI. What is key performance indicators? Our performance could be better than the industry or weaker than the industry in a KPI metric. KPI means something which is very critical. For example, in a CA firm, a KPI metric could be client satisfaction rating. If I have a better KPI metric, I deserve a higher valuation. Weaker KPI metric, I deserve a lower valuation. ESG, environmental factors, social factors, governance factors, consider them in your cash flow analysis. Consider them in your cash flow analysis. If your company is making some environment impact on the negative side, and you want to correct it, you correct it and see what is the impact on the environment, what is the impact on the socialist, the society at a large, governances, taking care of your compliance and other things, and adjust this in the cash flow or the discount rate and complete the valuation with this. Our business valuation discussion is over. Quick discussion to quickly understand the concepts. Any doubts are there, you can send me a message. Thank you, friends. Okay, we move to the last chapter, mergers, acquisitions, and corporate restructuring. Merger is basically an exercise where A and B join together and maybe form a company called AB. Whereas acquisition is an exercise where A acquires B and the merged entity may be called as A itself. Why do merger happens? Multiple reasons. It could be operating synergy, which are benefits related to P&L operations, financial synergy, which are benefits related to either interest cost or the cost of capital or the P multiple or the manager. There could be certain reasons why promoters wanted to acquire a company, which is called managerial self-interest or managerial ego. Now, in order to evaluate a question, we follow a format where we write particulars, acquiring company, target company, and merged. Here we capture PAT. We capture the PAT, divide by number of shares, equity shares, get EPS, use P multiple, MPS, again use the number of equity share and get MV of equity or firm. The number of value of firm is equal to market price into number of equity share, but the real formula is PAT into the P multiple. The real formula for market value of equity is PAT into PE multiple. PAT, number of equity share, EPS, P multiple, MPS, number of equity share, market value. Objective is either to increase PAT or improve the PE multiple. Gain from merger means what is the benefit of the merger. For example, here this is 10,000, this is 8,000. I'm just writing the P multiple 10, P multiple is 5, put together it is 1 lakh, put together it is 40,000, 10 plus 8 becomes 20,000, P multiple is 10 times and the value 2 lakh. Post merger value minus the pre-merger value of AC and TC separately is the gain from the merger. 60,000 is the gain from the merger. 2 lakh minus 1 lakh and 40 arises either if the PAT is better or the P multiple is better. If any question gives you any merger gain, that generally means PAT level gain. That generally means PAT level gain. And if it says there is no gain from merger, it means no PAT level gain. P multiple still can have an improvement and valuation can still improve. So merger gain would indicate synergy gain in a very rare scenario. That's a very rare scenario that it could mean the final gain from the merger. So here, whenever we are evaluating the question, ensure that whatever problems we are doing, take the given gain as the PAT level gain. Very rarely it would mean a valuation level gain. Few questions we did see that. And even if there is no PAT level gain, there can still be a gain from merger because of the P multiple improvement. Third point, what is the consideration we pay? That's called cost of merger. There are two types of cost. One is called gross cost. Second is called net cost. Gross cost could be if you are issuing shares. If you are issuing shares issued into the post-merger MPS. Shares issued into the post-merger market price per share. And if we are paying cash, cash paid into the number of shares of target company, number of shares in the target company. Net cost is equal to gross cost, whatever is the formula, either of the two, minus pre-merger value of target company. Pre-merger value of target company. Logic, everything is there in the detailed video if you want. Number of shares into post-merger, cash paid into pre-merger value of target company. This is also called as gain of TC shareholder. TC means target company shareholder. Gain of TC shareholder. Then Gain of AC and TC shareholder. Gain is very simple. We get the overall gain in concept 2. From that overall gain, net cost of merger. Net cost of merger is the gain of TC. Balance is NPV of merger or gain of acquiring company shareholder. NPV of merger, there's an error, typing error here, target company. Balance is the NPV of merger or gain of acquiring company shareholders. Equivalent EPS and NPS. See, whenever a merger happens, for the AC shareholder, their one share will become finally one share only. But TC, because of the exchange ratio, may not get finally one share. Sometimes they may get a half a share, sometimes even more than one share. So we do something called as equivalent EPS or MPS for a target company shareholder. Equivalent is post-merger multiplied with the exchange ratio. Post merger multiplied with the exchange ratio. How is the exchange ratio determined? To determine the exchange ratio, very simple. You either it is given in the question or you find the basis. Let's take the basis to be MPS. If the basis is MPS, find out the MPS of acquiring company 200, target company 100. In this value, I may do some adjustment. What is adjustment? I want to add extra 20% here. My wish. 200, 120, and exchange ratio is equal to value of target company by value of acquiring company. 120 divided by 200. Post that 20% adjustment. 120 divided by 200. Value of target company by value of acquiring company is the exchange ratio. Only one place the exchange ratio will be value of AC by value of TC as it is. I'll come to that parameter in later. So write the base values and switch means TC comes in the top, AC comes in the denominator. TC comes in the top, AC comes in the denominator. Weighted average swap ratio means multiple parameter basis, get the parameter which could be MPS. The basis is basis is MPS. Get their base value. What is base values? 200, 120. Exchange ratios 120 upon 200. Target by acquiring. Find out shares issued. Do a weight on this and do a product. Shares issued, weight and product. Sum of the product is the final shares issued. Gain or loss computation generally done at a MPS level, can also be done at a EPS level. Whatever the question says, if the question says do at MPS, do MPS, do at EPS, do EPS, problem silent. Gain or loss is computed at the market price per share level. What we do? Particulars, AC, TC, post merger MPS 200. Here 200 into an exchange ratio 160. Deduct the pre-merger 100, 140. Gain 120 and multiply with pre-merger number of share and get the overall gain of AC and TC. And this overall gain will match with the earlier number. Earlier we talked about true cost of merger, NPV of merger. That number and this number will match. Multiply with pre-merger number of share. Please keep it in mind. Multiply with pre-merger number of share. I have done at MPS. We can also do at EPS level. Silent, it is always MPS. Exchange ratio to maintain EPS. If you want to maintain EPS, the basis of exchange ratio should be EPS itself. The basis of exchange ratio should be EPS. That is EPS of TC by EPS of AC, provided PAT gain is not there. You want to maintain MPS of TC by MPS of AC, provided PAT and P multiple gain is not there. You want to maintain BVPS of TC by BVPS of AC if there are no revaluation gain. So if there are no synergy gain, you can use this. If there are any gains in that parameter, do it in the table approach. And whether TC wants to maintain or AC wants to maintain, the formula remains the same. P multiple of the merged firm. Problem is silent. The post-merger P multiple will be equal to P multiple of the acquiring company. P multiple of the acquiring company. Or if they mention something else, take it. They can also do weighted average. What is weighted averages? 10,000 PAT of the first company into its PE, PAT of the second company into its PE, whole divided by total PAT, whole divided by total PAT, whole divided by total PAT. This is called weighted average PE multiple. PAT of acquiring company into its PE, PAT of target company into its PE, PAT of AC plus PAT of TC. And minimum PE multiple to justify the merger is same numerator. Additionally, there can be some synergy gain in the denominator. That is, the denominator can be 20,000 here. This is called minimum P multiple to justify the merger. For weighted average, denominator is 10 plus 8. For minimum P multiple to justify the merger, the denominator will be 20,000. Same, this PAT of AC into P of AC, PAT of TC into P of TC. Valuation of merged firm. Most of the time, if I want to do valuation of the merged firm, we follow a very simple formula, PAT into P multiple. But sometimes I may do AC value, TC value plus valuation gain given or computed. Valuation gain given or computed by us. Valuation gain given or computed by us. Pre-merger value of AC, TC, valuation gain given or computed. Minimum exchange ratio and maximum exchange ratio. If the exchange ratio is given in the problem, okay. Nothing is mentioned and they say minimum, maximum. Minimum means the consideration should be equal to pre-merger value of target company, pre-merger value of target company, and maximum post-merger value minus the pre-merger value of acquiring company. Post-merger value minus the pre-merger value of acquiring company. Decision on sale of share. How do I decide whether should I continue with the company or discontinue and sell my shares whenever a merger or acquisition is happening? This is more from the point of view of target company shareholder. So decision ICI says two things. Opportunity cost given and not given. Not given, calculate gain or loss at MPS level. If there is a gain in the merger, continue with the company. And if there's a loss because of the merger, discontinue and move out of the company. If they give opportunity cost, ICI calculates earning yield. Earning yield is equal to equivalent EPS divided by MPS of TC today. If this is 12%, and opportunity cost is 14%, discontinue and move to the other company. Discontinue and move to the other company because other company can give you 14% opportunity cost. E.g., greater than cost of capital, you are earning more, continue, else discontinue and move. Equivalent EPS by pre-merger MPS of target company. Value of original shareholder. This assumes that the merger will not give any gain. The merger will not give any gain, assuming that 1 lakh plus 40 will become 140. And what is the distribution of this between the two set of shareholder? 1 lakh plus 40 will become 140. What is the distribution? Distribution means AC has 10,000 shares and TCR allotted 5,000 shares. TCR allotted. So distribute 140 in the ratio of 10,000 is to 5,000. That number is called value of original shareholder, assuming the merger does not give any gain. Post-merger EPS, if it's a stock consideration, in the table you will get the post-merger EPS. If it's a cash means EPS equal to PAT of AC, PAT of TC minus post-tax interest cost. Post-tax interest cost. Whenever a merger happens and I am giving a cash consideration, my two PATs will get joined together, and when I'm paying cash, I may borrow and pay or liquidate a FD and pay. So subtract the interest cost. and divide by only shares of AC. No extra shares. No extra shares are issued in the cash offer. No extra shares are issued in the cash offer. Book value per share computation, we are aware share capital plus reserves minus fictitious asset by number of share, or total assets minus the fictitious asset, deduct current liability, debt, preference, everything, and divide by number of shares. Because the book value per share can also become a basis for determining the exchange ratio, and if it becomes a basis, BVPS of TC by BVPS of AC. Free float market capitalization, again used in 5-6 question. Free float means shareholding by non-promoter, total value into percentage held by non-promoter. Percentage held by non-promoter. Sometimes they will have total value in the question, you calculate free float. You'll have free float with the percentage held, you can calculate the total value. Overall value, shareholding by non means public non-promoter. If you do any bonus or split, number of shares will increase, and EPS, MPS, BVPS will proportionately go down. Overall value will still remain same. Overall PAT will still remain same. Bonus has only one implication. It will increase the number of share and reduce EPS, MPS and BVPS. If there is any revision in growth rate, what we generally do is we first calculate KE or KO. Let's take KE only. KE is equal to total dividend divided by total value plus growth rate, D1 by P naught plus growth rate. Then use the same formula again, where growth will change, KE will remain same, D1 will remain same, and the value will go, and the value will go up. Overall dividend by existing value, and interchanging the formula, growth is in the denominator, and get the revised value. Get the revised value. The difference in the two values, the valuation gain due to the merger, is the valuation gain due to the merger. Decomposing of share price. My share price, which is MPS, can be broken down as EPS into PE multiple. The EPS can be broken down as ROE, return on equity, into the book value per share. The ROE, the EPS can be broken down as ROE into the book value per share. This is breaking down. ROE into retention ratio separately can give you growth. Separately can give you growth. Next concept, how is final ratio determined? See, there is a negotiation process going on. The acquiring company wants to give 2:1. Target company wants 4:1. They want more share. If I am the stronger company, acquiring is stronger, final ratio will be closer to 2:1. If the other company is stronger, the final ratio will be closer to 4:1. Closer to lower limit 2:1, closer to upper limit. Intrinsic value is the real worth of the company. If any question you want intrinsic value, you will have to do valuation using Walter, God, and some model. You do not have any data, market price is taken as intrinsic value of the company. Market price is taken as the intrinsic value or the real value of the company. Exchange ratio based on adverse parameter. Generally, exchange ratio is equal to EPS of TC by EPS of AC. TC is 4, AC is 10. So if you have higher EPS as an acquiring company, final ratio will be closer than less than 1. Whereas if I have an adverse parameter, for example, GNPA, gross NPA of TC, gross NPA of AC. Here, if I use this logic, target company has 20% NPA. I have only 4% NPA. The exchange ratio 5 times is not logical, because target company has more NPA. I have lesser NPA. So if it's an adverse parameter, there alone exchange ratio is value of AC by value of TC 4/20. Example, gross NPA, COGS ratio and your expense ratio. We also saw in one of the exam negative value. Negative value will give a negative ratio. Negative value will give a negative ratio. There are two ratios which we need to be aware related to bank merger. One is GNPA percentage, which is GNPA in rupees divided by the total loans given, and capital adequacy ratios. How much capital do I have for the assets which are there? Net worth divided by risk weighted assets. Net worth divided by risk weighted assets. Bonus issue to reduce promoter holding. Now, I have a situation where there are 100 shares, promoter hold 90, minority hold 10. Suddenly, I want promoter to hold only 75% of the company. So then the concept says, let this 90 be as it is. Today, 90 is 90%. But now this 90 should become 75%. The 90 should become 75%, which means overall shares will be 120 and extra shares will be 30. Minorities will be given extra 20 shares for 10 shares. Minorities alone will be given extra 20 shares for 10 shares. 2:1 bonus issue to reduce the promoter holding. Generally, I wouldn't do this. The promoter will do a partial sale of the share so that their shareholding automatically comes down. Fund available for merger. I am trying to acquire another company. Generally, we give a shares consideration, but if I'm giving a cash consideration, do I have the money to acquire? So fund available is equal to, very simple, we find out cash available plus new loan that can be taken. New loan that can be taken. Which cash available? We generally take both the cash, AC cash and the TC cash, because I'll acquire the TC company, use their cash itself. Use their cash itself. What is new loan that can be taken? Very simple. A question will say debt equity ratio. This will tell my maximum debt can be 5 CR. Today I have 2 CR debt. Other company has 1 CR because it will come as part of my company. 3 CR already debt is there. Another 2 crores I can borrow. Another 2 crores I can borrow. So total debt minus the existing debt of AC and TC, available cash and cash equivalent, maximum new debt plus the cash and cash equivalent. Maximum new debt plus the cash and cash equivalent. Then post merger shareholding, if you are having shareholding in both the companies, AC also you have, TC also you have, your existing shares in AC will remain same. TC will be multiplied with an exchange ratio. These are your overall share, and divide by the post merger. Divide by the post merger overall shares. If there are partly paid shares, for example, I've decided a merger, I want to give 25,000 shares. That's all. Valuation done. This needs to be distributed among two people. Fully paid 20 lakh shares, partly paid, partly is 40% paid up, okay? They are 10 lakh. This 10 lakh is equivalent of 4 lakh. So the 25,000 can be distributed in the ratio of 20:4. 20:4. The fully paid guys will get their share, whatever shares they are getting, and you give it to 20 lakh, and balance here, whatever you are coming, you distribute that to 10 lakh people. Convert the partly paid shares into equivalent fully paid shares, and then allot the shares, and then allot the share. Minimum consideration for promoters to relinquish holding. See, minimum exchange ratio set, minimum consideration, pre-merger value of target company or MPS of target company. Promoter may ask for something more. Promoter may ask for something more because he's getting some extra benefits. He's getting some extra benefit. What is extra benefit? He is paying himself extra money. He is paying himself extra money. So here they will need MPS, also compensation for the allied benefit. Compensation for the allied benefit divided by number of shares of promoters. If promoters are getting an extra benefit of 20 lakh and they have 2 lakh shares, extra 10 you have to pay. Again, the MCQ examples itself are sufficient. DuPont framework for computing ROE. ROE, we learned formula is EAES by amount of equity or PAT by equity. DuPont said you can break this as PAT by sales called as NP margin, sales by asset called as asset turnover, and asset by equity called as equity multiply the three and get ROE. PAT by sales, sales by asset, and asset by equity and get the number. Internal reconstruction is your CA inter. You would have learnt about internal reconstruction, where you will have to identify first the capital reserve, where there are items which increase the net worth, items which decrease the net worth, and prepare a revised balance sheet. Prepare a revised balance sheet. These are all you're aware. Valuation of debt and equity, not a logical item, but question institute, very simple calculation. You have two companies, value their debt separately, value their equity separately. What is debt separately, equity separately? Debt value is the weighted average of the various values, and equity values is the weighted average of the various equity value. Add the debt of two companies, merged company debt, add the equity values of two company, merged equity value. With this, I've discussed all the chapters. Again, I'm saying the purpose is very simple. Purpose here is to quickly go through the concept. Detailed understanding is needed. You need to go through the detailed video. With this, I am done.